Climate change is one of the defining issues of our time and presents significant financial risks to business and society. Since the signing of the Paris Agreement, finance has stepped up to be at the forefront of our global transition to a sustainable, net zero carbon world. As finance practitioners, we each have our roles to play in ensuring we have the relevant skills to address these challenges. That's why many of the world's leading financial services professional bodies and trade associations have joined together to support the first Green Finance Education Charter.
This charter is a clear and welcome commitment from chartered and professional bodies in the UK and overseas that green finance and sustainability must be integrated into their curricula. The achievement we're celebrating will enable practitioners in the sector to respond with sharper skills to the challenge of strengthening our finance sector, building a cleaner and more resilient economy, and lighting the road to the UK hosting COP in 2021.
Meeting the objectives of the Paris Agreement means green finance must become the mainstream of finance. As a result, there is an increasing need for the finance sector globally to develop new capabilities through relevant education and training in green finance principles and practice.
Understanding the financial risks posed by our changing climate, as well as the opportunities presented by green finance, are vital skills for all financial sector practitioners today. That is why at the Green Finance Institute, we're pleased to play our part supporting the professional bodies and the trade associations in building the green finance skills of their members.
Our world-leading professional bodies have key roles to play in developing the capacity and capability of the banking, finance and professional services sectors to mainstream green and sustainable finance. The Green Finance Education Charter sets out our collective commitment to incorporating green and sustainable finance principles into the education and training programs of professionals worldwide.
We acknowledge the collective responsibility of the global finance professions to deliver the Paris Agreement and the UN Sustainable Development Goals. Committed professionals with an understanding of the critical role of financial services to support the transition to a low-carbon world are vital. Now is the time for our vast global network to play their part.
With your help, the pathways to a prosperous future are green.
Today we live in a new world. A world where making the right choices has never been more important. Important for our families, our communities, and our planet. We need to make the right choices to help us build, grow, and thrive. Choices that allow us to invest in everybody's future. And today, finance isn't just about where you save or allocate your money. It's about commitment and continuity. It's about people and places, enterprise and ethics. Thinking beyond GDP and profit towards happiness, inclusiveness and well-being. It's about finance with purpose. The Global Ethical Finance Initiative believes in using finance for positive change, enabling transparency and choice that facilitates a more sustainable, responsible and stable financial system. A system that is both innovative and fair, that benefits the local and global community. We believe in the values of our environment and the worth of an individual's well-being, in enterprise that is ethical, in growing portfolios but not at any cost. We believe in profit with purpose and finance for positive change, and strive for system solutions to global problems. Founded in the historic city of Edinburgh, we draw inspiration from the Scottish Enlightenment figures who position Scotland as a leading centre of entrepreneurial spirit. Today, Scotland is home to accelerating startups and respected financial institutions. It is very much alive with innovators and creative thinkers, generating fresh ideas and new perspectives. At the Global Ethical Finance Initiative, we look outwardly to our partners from around the world, amplifying, collaborating and inspiring, enabling us to harness this combined knowledge for the benefit of our network. And how do we do this? through our key pillars of advocacy and building ecosystems, which together encourages and facilitates the cross-pollination of ideas that helps grow and develop both individuals and institutions. The advocacy of ethical finance is achieved by bringing people together, achieved via a series of world-leading events, both virtually and in person. Every year, our Ethical Finance Summit is attended by the world's foremost financial, political and faith leaders. These experts dive into themes such as responsible investing, sustainable banking, inclusive growth, and rethinking capitalism, all aimed at ensuring that positive change is at the heart of our financial system. Change that supports targets such as the Paris Agreement and the UN Sustainable Development Goals. Our award-winning discussion series, the Edinburgh Ethical Finance Roundtable, established in 2010, attracts stakeholders and thinkers from all walks of life, including asset managers, asset owners, banks, regulators, charities, universities, governments and faith groups. People from across our network uniting to share perspectives committed to the development of a better world. We build ecosystems that encourage collaboration. Our pioneering work with the United Nations Development Programme helps drive private capital towards SDGs. And our 2-year programme is a journey focused on investment analysis and identifying market opportunities. The Edinburgh Declaration, the world's first interfaith collaboration on ethical finance, is a shared values framework that shines a light on common purposes and values, and can inform financial professionals and institutions on creating a values-based culture. And our Ethical Finance Hub campaigns for the positive influence that ethical finance can bring to Scotland through market campaigns and capacity building. At the Global Ethical Finance Initiative, we have an experienced team with an in-depth knowledge of finance, law, research, advisory, marketing and public relations, and event curation. Our journey has begun, and momentum is gathering. The case for ethical finance is beyond doubt, and with the help of our global network, we have developed award-winning initiatives, hosted world-class summits that have influenced policymakers and helped map the ethical finance landscape. We provide governments with research and advise banks and asset managers on how to invest responsibly and in line with the UN Sustainable Development Goals. We are a founding stakeholder endorser of UN principles for responsible banking, and we help provide a platform for ethical finance that delivers profits with purpose. Our global community is growing, and we want you to be a part of it. Join us and make a difference.
Good morning, ladies and gentlemen, or whatever part of the day it is with you. And on behalf of the Global Ethical Finance Initiative, or GEFI as we usually refer to it, a very warm welcome to everyone joining us for this third and final day of our Ethical Finance Summit 2021. My name is Graham Burnside. I'm currently a director of GEFI and indeed have had the privilege of being involved with the organisation since it started. We've been delighted by the level of interest and participation over the last 2 days, which I'm sure is a tribute to the contributors we've been privileged to hear from. And I'm confident that our final day will not be any less engaging. Our overarching theme today is Beyond Climate. Yesterday's theme was, of course, sustainability, and this morning we will be focusing on two further S's, namely the SDGs and the S which appears in the middle of ESG. The first of these, which we will be moving on with very shortly, is surely one of the key topics of this event. There is, I think, increasing consensus that alignment with the SDGs presents the best roadmap for positive progress, bringing together as they do climate, biodiversity, and the full range of ESG issues. While estimates vary as to just how many trillions of dollars will be needed to finance the SDGs, there can be little doubt that the bulk of the heavy lifting on this will have to be undertaken by the private financial sector. There's a lot to talk about, therefore, as to how this can be achieved, and who better to inform the debate than the administrator of the UNDP, Achim Steiner, who I'm very pleased to say is our first speaker this morning. This session will also take a detailed look at how one particular sector of the financial industry, namely Islamic finance, is engaging with the SDGs, something in which our sister organisation, the Islamic Finance Council UK, has played a significant part. Our second session today will be looking at what is perhaps the least explored of the elements which go to make up ESG, namely the S for social issues. In addition to a panel of distinguished speakers, including Dr. Reza Bakir, the Governor of the State Bank of Pakistan, who will be looking at the topic as a whole, we will be hearing from one organisation prominent in the field, Tobacco Free Portfolios, on its activities and achievements. The final session of the summit addresses a topic which, in a sense, draws together all the separate strands which have gone before, namely leadership, and what will be required of it if we are indeed to meet the multiple challenges of the climate crisis, biodiversity, and achieving the SDGs. If we were in any doubt on the matter, the pandemic has surely graphically demonstrated the vital importance of informed and resilient leadership in the face of a crisis, and indeed the consequence of its absence. And the transition to net zero can only present an even greater challenge. Our session this afternoon includes presentations from a number of senior leaders from around the globe, who I'm sure will be bringing us much to reflect on as we draw our conference to a close. So, thank you for being with us once again, ladies and gentlemen, and can I conclude by wishing you an enjoyable and stimulating final day at our Ethical Finance Summit 2021. It's now my pleasure to hand over to George Littlejohn, Senior Advisor to the Chartered Institute for Securities and Investment, who will be chairing today's proceedings and introducing the individual speakers. Over to you, George.
Hello, and my name is George Littlejohn, Senior Advisor at the Chartered Institute for Securities and Investment, the CISI, and I'm delighted and very honoured to be your Master of Ceremonies for Day 3 of Ethical Finance 2021. Really great thanks, Graham, to you and your excellent team for this superb event. It's a real triumph in these still difficult times. And it's, of course, part of Jeffy's much broader and deeper work, of which we'll be hearing more later. I'm sure people have been admiring your tie, Graham, which is in the special Jeffy Sustainable Development Goals tartan, and full details of how you can get a similar tie or anything else you like True's made, are on the Jeffy website. The team at Jeffy has brought together nearly 100 speakers and panelists, an extraordinary half from outside Europe and North America, nearly half of them women, and 3,800 delegates from 90 countries. That is an extraordinary achievement. This is where we usually say, welcome to Edinburgh, welcome to Scotland. Let us tell you a bit about our beautiful cities, Glasgow, of course, as well as Edinburgh. As my friend and colleague Simon Thompson, CEO of the Chartered Banker Institute, pointed out yesterday in his welcome to day 1 of this summit, Scotland is the home and headquarters of ethical banking and finance, including the home of Jeffy, the Global Ethical Finance Initiative, and of course Simon's Institute, the Chartered Bankers. If we were in Edinburgh, we'd be just 30 miles, 50 kilometres or so, from where COP26, the Global Climate Summit, will be held in Glasgow in a few months' time. But this year, of course, things are different. The past 12 months have been extremely difficult for all of us, wherever we are in the world. They remain challenging for individuals and families, businesses and communities, countries and regions struck by and still struggling to recover from the dreadful COVID-19 pandemic. That means we can't meet in Scotland in person this year. I'm in London, though I have some flowers specially delivered from my cousins in Scotland to remind me of home, so thank you, ladies. But this also means that we can make Ethical Finance 2021 more global, more inclusive, and more relevant than ever before. Firstly, by bringing together online an incredible diversity of leading speakers and panelists. If you had a chance to join us on the first day for our Global Regional Showcase sessions on day one, you'll have heard from finance and sustainability experts from Africa, Asia, and Australasia. And if you missed them, don't worry, you'll have the chance to watch the sessions later on our EFX platform. Secondly, by attracting delegates from right around the world, many of whom would not have been able to come to Edinburgh in person, that's added much to the summit. As I mentioned, we have some 3,800 delegates from 90 countries joining us this year. So Ethical Finance 2021 is a truly global event with global leaders, global insight, and a global audience. And a global community of finance professionals committed to embedding ethical and sustainable finance in their own professional practice as individuals, across their organizations, and across finance as a whole. So wherever you're joining us from today, you're very welcome. Now, building on those first day's regional showcases, our theme on the second day yesterday was sustainability, divided into 3 sessions: global trends in sustainable finance, the role of finance in delivering net zero, and remember, it's only 140 days now until the UN Climate Conference, COP26 in Glasgow, and finance for nature. We have, of course, just celebrated World Ocean Day and World Environment Day, and last week saw the formal launch of the Task Force on Nature-Related Financial Disclosures, TNFD, another acronym we'll all have to remember now. This was a topic covered in depth yesterday. Now, you'll have the chance to put your questions too during a couple of the panel sessions today. Just use the Q&A function on the screen during the sessions, please. If you're joining us by mobile or you can't see the Q&A for another reason, just email your question to events@globalethicalfinance.org. That's events@globalethicalfinance.org with the subject line EF 2021 question. And wherever you are joining us from, please join in our conversation via Twitter by following @Finance4Change, Finance4, numeral 4 change, and using the hashtag #EthicalFinance2021. So we've done some really excellent sessions over the past 2 days, and if you missed any of them, don't worry, you can see them on EFX Global soon. Today, we move beyond climate onto 3 really important themes. Firstly, how the world can finance the Sustainable Development Goals. Secondly, the S in ESG, why it matters more and more. And thirdly, at strategic business and sustainability leadership. Now, each session lasts for about 2 hours. There'll be breaks between them to allow you to gather your thoughts and grab a bite to eat or some refreshment after learning from our incredible lineup of the most senior, the most expert, the most well-informed speakers and panelists. You'll have the chance to put your questions to many of the panelists too during the 3 live panel sessions. Just use the Q&A function, as I said before. And please do tweet us. Now, it's my great honour now and privilege to welcome Scotland's First Minister, Nicola Sturgeon. Nicola is here to give our closing day a great send-off. First Minister, thank you for joining us and welcome.
In just 5 months' time, the eyes of the world will be on COP26 in Glasgow. That summit represents the best opportunity the world has to take urgent action to address the climate crisis. Scotland, as a proud host nation, will do everything we can to make it a success. We will work with the UK Government to deliver a safe and secure conference. And above all, we will try to lead by example. Scotland already has the world's most ambitious framework for emissions reduction. We have pledged that by 2045, our net greenhouse gas emissions will be 0. and we are trying to ensure that our transition to net zero is a just one. Individuals and communities must not be left behind by the transformation that lies ahead. To achieve our ambitions, the Scottish Government is making significant investments. For example, last year we launched a new publicly funded National Investment Bank. But we know that government investment on its own won't be sufficient. The UK Committee on Climate Change has estimated that 85% of the finance required for our net zero ambitions will need to come from the private sector. That's why the Scottish Government is working with business. For example, we've created a green investment portfolio to help investors identify green opportunities here in Scotland. That portfolio includes £3 billion of projects. And we're also working to make Scotland a global hub for ethical finance. In fact, we've just established a task force to help with that aim. And there is a strong historical echo here. Scotland has been a centre for financial services for centuries now. Back in the 18th and 19th centuries, Scotland's investment community helped to finance many of the innovations that led the world into the industrial age. Now the financial services sector has an opportunity and, I think, an obligation to help lead the world into the net zero age. And so for Scotland, that mission speaks to our past as well as being essential to our future. I believe we can also take some hope and perhaps a sense of perspective from far more recent events. During the past year, all countries have faced an unprecedented crisis. But for all the trauma that the COVID pandemic has brought us, it has also reminded us just how much the world can achieve. The creation of vaccines, the establishment of testing infrastructure, the transformation of businesses. In the next year, as well as continuing to tackle COVID, we must show similar urgency in addressing the climate crisis. If we do that, then when we meet in Edinburgh for next year's summit, hopefully in person, we should be able to look back on a year when the world took decisive action to address the climate crisis and when ethical finance helped to play a central role in that. My hope is that today's virtual summit can contribute to that vital purpose. So I'm delighted that so many people are represented here. I hope the Scottish Government will continue to work with you in the run-up to COP26 and beyond. I wish you well for all of your discussions.
I apologise, I've been on mute. First Minister, thank you so much. That was an inspiring, encouraging welcome to our final day. You stressed both Scotland's financial heritage and also its present commitment to sustainability. The way business, finance and the public sector as well as education work together as a shining beacon to all watching today and the rest of the world too. So let's build on that great record as we move into our first session on financing the Sustainable Development Goals. Scotland, as the First Minister proudly said, has long been home to some of the world's biggest fund managers, and you'll be hearing from a number of them later. They've never been so vocal about how they plan to vote in annual shareholder meetings. It's not a coincidence that these newly noisy investment giants are increasingly backing shareholder resolutions against company efforts to maintain the status quo when it comes to climate matters in particular, but also on a range of other SDG-related issues. Exxon was the most recent public example, as shareholders backed the appointment of 3 new directors despite the company's strenuous objections. The financial world is very sensitive to market shifts. It feels the new climate and it's repositioning itself accordingly. The big asset managers of the world and many of their smaller, perhaps more nimble competitors are getting more aggressive, more forceful about voting in favour of not only climate-related issues, but also social measures around, for instance, racial equality. From a purely financial standpoint, this trend makes sense given the enormous investment flows into ESG funds, and that's environmental, social and governance, one of the many acronyms you'll hear today, and also looming mandates from regulators. Just for instance, in America, more than $100 billion has poured into exchange-traded funds alone, focusing on ESG factors in the past 12 months, huge amounts of money. And the same trend holds true in most of the rest of the world. Meanwhile, regulators around the world are making plans that will force mandatory corporate disclosures on topics such as biodiversity and workforce diversity, on top of existing plans on climate risk disclosures. The writing's on the wall. Big mutual fund and pensions managers are increasingly quick to say to companies, we want you to care not only about profits, but about people, planet, and profits. So those three, people, planet, and profits. The new Task Force on Nature-Related Financial Disclosures, TNFD, another acronym, of which we heard much yesterday, for instance, is just one facet of this. Much like big business is being reimagined to support the transition to a low-carbon economy, in the same way that TNFD is intended to help reorientate the flow of investment and capital expenditure to activities that support rather than destroy biodiversity. Biodiversity, and we heard from the great guru of this yesterday, the very modest Sir Partha Dasgupta, biodiversity represents the breadth and variety of life on Earth and the multitude of ecosystems that sustain it. The data available to measure biodiversity are limited, and there are currently no high-level government targets for nature akin to the Paris Climate Accord's well below 2 degrees Celsius objective. In fact, the topic is so complex it may not be easy to have one number that all stakeholders can rally behind. Unlike when we talk of climate change, biodiversity is deforestation, it's water, it's air, it's food, agriculture, pollution, invasive species, and so on. So there's much to be done. And in the next hour and 50 minutes, we'll be hearing from a range of global experts on how we tackle this key challenge of moving beyond the ever-present climate challenge, well, climate crisis, actually. The First Minister spoke of the strong historical echoes that ethical finance has in Scotland. We have a long tradition here of looking to the future, of considering future generations of being or trying to be good ancestors. We're going to hear first from Kat Feldinger. Kat's worked in economic development for the best part of a decade, is now heading up the investment finance division for Scottish Government, responsible for creating the conditions for large-scale private investment in Scotland, promoting investment opportunities in our beautiful country to global markets, including through the government shareholding in the Scottish National Investment Bank. Kat's originally Danish, but came to university in Edinburgh, the first of a number of our speakers today who attended that fine institution. Now, Kat's here to speak with one of our most distinguished guests today, and this is a very strong field. That person is Achim Steiner, the UNDP administrator. Mr. Steiner is also the vice chair of the UN Sustainable Development Group, which brings together 40 entities in the UN system that work to support sustainable development. Kat, welcome, and thank you both for joining us today.
Thank you for that kind welcome, George. It's my pleasure today to welcome a man who barely needs an introduction, really. Achim Steiner is the administrator for the United Nations Development Programme and has held that role since 2017, alongside a role as vice chair of the United Nations Sustainable Development Group, which unites 40 entities of the UN system that work to support sustainable development. But his heritage in seeing finance as a route both to human development and to environmental protection extends far beyond this, with his work over 3 decades in this field, including past roles at the United Nations Environment Programme, across the globe, and in academia at Oxford University. So for what I'm sure will be a fascinating session on going beyond climate, Achim, the floor is yours.
Thank you for your kind introduction, Kat, and thank you to the Global Ethical Finance Initiative team for the opportunity to speak to you today and to join you for this event. Excellencies, ladies and gentlemen, the 2021 Ethical Finance Summit is taking place at a critical moment. For the first time since 1990, global human development is going backwards due to the impacts of the COVID-19 pandemic, and with the poorest and most vulnerable being hit the hardest. The pandemic has also exposed deep inequalities, weak health and social security systems, and the digital divide. At the same time, our planet's precious ecosystems continue to be degraded and destroyed. With it, biodiversity is withering before our very eyes. Almost unbelievably, up to 1 million plant and animal species now face extinction, many within decades, because of our activities as human beings. And climate change continues its relentless march. The pandemic has also triggered an extremely challenging environment for development finance. As a result of COVID-19, the SDG financing gap may balloon from $2.5 trillion to $4.2 trillion. And yet, the sustainable finance challenge is not simply one of filling financing gaps. After all, reallocating just 1.1% of the total assets held by banks, institutional investors, or asset managers, some 4.2 trillion, would be sufficient to fill the gap in SDG financing. Rather, I see two key areas that require our immediate focus. Firstly, national financing strategies need to encompass the right policies to mobilize finance towards the SDGs. To drive forward progress in this area, the United Nations Development Programme is implementing a support program on integrated national financing frameworks today in 71 countries, in cooperation with the European Union, the International Monetary Fund, and other parts of our United Nations system. This effort is helping to contribute to the fact that financing for the COVID-19 recovery is fully aligned with the SDGs and the Paris Agreement. And UNDP is now the secretariat to the G20 Sustainable Finance Working Group, co-chaired currently by China and the United States. It is playing a key role in examining the major gaps and barriers to mobilizing sustainable finance. Secondly, the private sector has a pivotal part to play in driving finance towards the SDGs. Therefore, SDG Impact, a flagship initiative of UNDP, is engaging directly with businesses, investors, and policymakers to develop the business case for the alignment of their activities with the SDGs. The ultimate aim is to foster more inclusive and resilient economic growth. And its SDG investor maps now offer accessible local market intelligence on sustainable investment opportunities. That includes openings in vital sectors like food and agriculture and renewable energy, or look to UNDP's SDG impact standards for bond issuers, for instance. It supports the integration of the SDGs into business and investment decisions. The standards were used by the New Development Bank recently in China to issue a Sustainable Development Goals bond valued at $767 million in March of 2021. With groundbreaking initiatives like SDG Impact, our objective as UNDP is to help to mobilize historically new levels of finance towards the SDGs. Very much what this event is about, and that many of the distinguished speakers yesterday and today that you have brought together are addressing. At this global turning point, such efforts will help countries and communities to build forward better from this devastating pandemic and ensure that this does become a decade of action for the SDGs towards a greener, more inclusive, and more sustainable future. Thank you so much.
Thank you very much, Achim. There's so much to pick up on in that speech. And I suppose where I'd like to start is really at the top level. So even before the pandemic, only a few countries were on track to deliver the SDGs by 2030. And we've now seen a deepening of inequality, a weakening of health systems and social security, and increasingly links between health, ecology and climate. So can we genuinely do this? Do we start thinking about extending targets, or is there a sequence that we need to look at the SDGs in where they start to unlock progress on each other?
Well, let me begin by answering that certainly meeting the SDGs has not become easier. And I think we are experiencing setbacks right now that will literally not only take away what we have already accomplished, but in fact set us back by a number of years. But as always in our very diverse world, there are very different pathways. First of all, countries have, entered this pandemic in a very different state of national economies, but also of social protection systems and ecological policies. And I think what we certainly should not do is to be tempted by this notion that, are the SDGs, because they have become more difficult to achieve, therefore less relevant. On the contrary, I believe the SDGs are precisely the compass that we need right now in order to be able to get out of this pandemic tail end that is quite long and very brutal in some countries. And at the heart of this is really an appreciation that it's not the trade-off of one sector against another. It's not the trade-off of one population group or a region against another. It is how national economies can recover where both environmental sustainability and social equity are drivers of economic recovery. That's precisely at the core of the SDGs. And I would argue that if you look at climate change today, we are in fact in June of 2021, closer to perhaps meeting the Paris Agreement targets than we were 18 months ago before the pandemic, because things have changed. Politics has changed, public attention has changed. We have seen announcements that would have been unimaginable from some countries just a few months back. So let us not take setbacks as a reason to abandon the goals, both in their objectives, in the targets we've set ourselves. They are not just things that you can choose to ignore or not. They are rooted in reality, in international agreements, in science. What we need now is acceleration, scaling up, and also investing every dollar, every euro, every pound in a way that generates more than just a singular benefit and outcome. That is part of the SDG ingenuity also, designing investments that yield multiple benefits.
Great. And obviously you spoke there about making sure that we make the most of the funding that does go into this, but you've also mentioned that the financing gap has increased really substantially here from 2.5 to just over 4 trillion. And yet you're talking about essentially a system of values that can go on to create value. So the challenge in that is for whom that creates value, who ought to pay for them, and why that should be the case.
Well, let us first of all recognize that at this very moment, in many countries across the world, we are facing extreme fiscal space constraints. Mainly put in other words, countries are just running out of money in terms of public budgets. So the ability to first of all manage the crisis, but also to invest in stimulus packages to come out of it are severely constrained. And in fact, in a recent research paper that UNDP put out, we echo also the messages of the International Monetary Fund. The debt issue is beginning to become a severe problem, not only in terms of the immediate management of the crisis, but also in recovery terms. So we have to address underlying issues such as debt. And therefore, the debate that is currently being conducted with the G20 and in the International Monetary Fund are critical, particularly for the countries that are most vulnerable to, in fact, become unable to service their debts. And, you know, there are countries such as Zambia today where 40% of the national budget actually goes towards paying interest and repaying loans. I mean, certainly this is not a way in which you can manage a recovery. Having said that, the world is wealthier today than it has been at any time in history. In fact, our financial markets and investors and funds are desperately looking for ways to invest money. Interest rates are at record lows. So you would expect that there is a unique opportunity, a window of opportunity also to leverage and attract significant private capital in alignment with the SDGs to invest. And here, let me use the term invest deliberately. It's not just an argument in favor of public budgets and funding, which means you have to raise taxpayers' money and revenues, and then you reinvest them, so to speak, in the economy. We're talking about genuine trillion-dollar investment economies that are emerging with the transition to low-carbon economies, but also with continents such as Africa, well over 1 billion people right now. By 2050, perhaps a 2 billion people market. These are opportunities right now that I think we need to help the world's financial system that is sitting on extraordinary wealth and is looking for ways to invest, to be able to find ways in which, through good governance policy, good regulatory frameworks, good governance, we actually create opportunities to invest in sustainable development, because ultimately that's what's going to keep the economies of the 21st century going. And that is the unique moment in time, but also the confluence that I think we all need to work towards right now.
And so obviously we are seeing markets making a really significant shift towards ESG investment generally, and in some instances also towards SDG specific investment. But most of that is still bypassing a lot of the developing world. And so if we were going to pick a couple of things that would help reallocate that 1.1% of assets towards the SDG goals, are we talking about making it clearer that you're avoiding failure costs? What are the things that will make this possible for financial institutions?
Well, as always, it takes two to tango. So there are those who are capital owners, and then there are those who are seeking to essentially attract capital. And I think much of what UNDP, as the development program of the United Nations, does is to help countries look at how they can be more attractive investment destinations. First of all, by helping them to address the incentives for financial markets, and beginning with domestic financial markets, in fact, to invest in opportunities that have to do with access to electricity, educational services, health services, but also infrastructure related to mobility, agricultural productivity. I mean, these are all sectors that are not beyond the purview of a private sector investment logic. On the contrary, much of our global economy, in fact, is based on private sector investment and business. The challenge we face is that many of these countries, first of all, are small. They are not as attractive on the international highway of investors in order to focus on them as particular cases. And I think what we're doing right now, for instance, with SDG Impact and the investor maps is precisely to bring public policymakers and private investors together to recognize an opportunity. Let me give you a very simple but powerful example: food waste. More than a third of everything we produce on our planet every year in terms of food is never consumed. It's either lost between farm and market, or it is just thrown away. This is an extraordinary, not only macroeconomic waste, but an environmental disaster, and in a world where hundreds of millions of people don't have enough to eat. Now, in a major economy like Brazil, we have seen that a lot of that loss of food actually has to do with lack of storage and lack of connectivity of producers to markets. Both of these, i.e. the transport sector and essentially the real estate sector, building storage, grain silos, are eminently private sector investable in. So getting government to put the right incentives in place and then mobilizing significant amounts of private capital to expand the storage capacity of the Brazilian economy, and to get the transport sector to add the last 5% of the capillary structure of transport, connecting producers to markets, could significantly cut one of the world's major food producers' losses in food waste. And this is the kind of public policy, incentives and regulatory analysis that is needed, and then the private sector to step up and actually seize the opportunity. And so this is part of the work that we are trying to do in many of these smaller, least developed countries, low-income countries, that on their own will struggle to attract the interest and the attention of international financial markets. And at the end of the day, it's a form of de-risking through smart, transparent public policy, but also of incentivizing and engaging with private sector investors, because many of them, in part, have never invested a minute in understanding what might be the opportunities of these countries. And I think in a world that is increasingly riven by inequality, this is not just something within our own societies. We have a world right now, not least with the digital economy emerging, that could be on two very different tracks. And if the majority of the world's population is not part of the world's financial system in the sense of an investor, then we are in trouble.
So if the SDG Impact work is sort of helping to make the business case for investment by really exploring local viability issues, local market viability issues, what does ambition look like here? Who is using the SDGs really well as a brand to drive investment? And what does saturation look like? So how do we get beyond the big companies that are going to do it themselves and right down to as you say, smaller countries and down to SMEs?
Well, it may seem a little bit surprising, but to me, in the 5 years since the SDGs were adopted in the General Assembly in 2015, perhaps the most surprising sector that began to really engage with the SDGs was the financial sector. If you go to the World Economic Forum in Davos, for example, in January every year, although this year it obviously didn't happen, one of the striking things last year, the year before, was that all over Davos you saw the Sustainable Development Goals logo. The financial sector, banks, funds were in fact looking at the SDGs as a way of globally de-risking the economy. Because if you can address issues such as poverty, unemployment, discrimination, but also environmental hazards, climate change risks, you are de facto creating a more stable investment economy. So just to pick an unusual example, the finance sector was one of them. And then there are countries that obviously at very different levels are leveraging the SDGs. I mean, we worked, for example, with Mexico last year when it issued a bond on the European financial markets, an SDG bond, the first ever, and invited UNDP to provide, in addition to its own transparent prioritization of SDG-related investment priorities, the United Nations Development Programme as a partner in order to validate also the SDG approach. We saw recently, and this is part of the work that SDG Impact has done by developing these standards for the issuing of bonds. We saw the New Development Bank actually launching an SDG bond, again about $800–900 million, that fully apply these norms that we have developed. And part of what we're doing here is to give governments also a degree of self-discipline, transparency, and a template with which to approach the financial markets and say, we are borrowing in order to invest in the development of our country according to SDG parameters. And in both cases, they were oversubscribed. So I see enormous potential, as we all do, in that broader sense of impact-oriented investments, because both financial institutions have enormous demand that they're getting from their clients in order to invest in areas that actually, help solve problems as opposed to amplify them. And secondly, governments have recognized that this is a way in which they can capitalize also investment programs in their countries in ways that yield multiple benefits. And we often talk about climate change. It's one entry point into an investment proposition. You could also say access to clean energy. In Africa, 600 million people have no access to electricity today. So the same investment could be rated as a climate change investment from one perspective. On the other side, it is what African countries need right now, which is capital to invest in electricity generating infrastructure. And suddenly we have a unique opportunity to co-invest here. Clean renewables on the one hand, providing hundreds of millions of people with access to electricity, vital driver of development. On the other hand, getting a continent like Africa to embark and invest in a energy matrix that is fundamentally different from that of Europe's last century. 2 billion people emulating Europe in this day and age would be the end of the Paris Agreement. And quite frankly, we really would surrender to climate change as a given.
So you mentioned sort of the role of essentially how we develop the Global South and all of this. And you've mentioned also China's development bank issuing SDG-led bonds. We have a number of other development banks taking part in the summit, and obviously Scotland has just launched its own one in the Scottish National Investment Bank. So what role do you think development banks need to play in supporting countries move towards the SDGs?
I think national development banks have an extraordinarily important role to play. Depending on which part of the world, in which country you look, sometimes they're very much in the front line of also, trying to help realize the role that they can play in influencing financial markets and public investment portfolios. Last year in Paris, we had a summit of over 100 national development banks from around the world. And I think it was an eye-opener to many that, in fact, these are institutions that are embedded in not only national economies, but also able to operate in domestic and international financial markets, are part of national development policy and priorities that are, essentially decided by countries on where to invest. Getting national development banks to become key players, both in influencing national financing, but also in leveraging private sector capital into an investment pathway for a country, I think is enormously important. And so for UNDP, this is a group of institutions with which we work, and certainly Scotland's mission-led development bank has been a great example and inspiration, not just to us, but I think to a number of national development banks that are rethinking their role in not only times of a pandemic, but indeed of the Sustainable Development Goals challenge.
That's great. Thank you very much, Achim, for your time and for your provocation of our thoughts.
It's a pleasure to join you. Thank you so much, Kat.
Goodness, that was fascinating. Thank you both so much. I find it particularly reassuring that Dr. Steiner is now more optimistic than he was before the pandemic about meeting some of the key targets, although obviously with concerns about the huge fiscal constraints. I was also personally intrigued by his views on bringing the SDGs to bear on de-risking economies and markets, particularly in the exciting emerging and frontier markets on which much investment hope rests. We will be returning to many of the themes he and Kat raised over the course of this excellent day, but thank you so much for a great start to it, both of you. Okay, I now confess that like Kat, I went to Edinburgh University and studied economics there. So it's my particular pleasure to welcome two seriously brainy economists, unlike me, from the IMF, the International Monetary Fund. Dora Benedict and Alexander Thiemann are both Deputy Division Chiefs in the Fiscal Affairs Department at the Fund. They're going to be giving us an economist treat, a post-pandemic assessment of the Sustainable Development Goals. They'll be sharing their assessment of the current state of play on funding SDGs in 5 key development areas: education, health, roads, electricity, and water and sanitation, using a newly developed dynamic macroeconomic framework. This economist, and I'm sure everyone else, very excited in what we're about to hear. Alexander and Dora, a hearty welcome to Ethical Finance 21.
Thank you for the kind introduction, George, and thank you to the Global Ethical Finance team for the opportunity to speak here today. As Achim has outlined, the Ethical Finance Summit is taking place at a critical time when the COVID-19 pandemic is slowing SDG investment. We agree with Achim that there's a need to reinforce the importance of the SDGs and unlock the financing required. In this context, the G20 Roadmap for Sustainable Finance and the UNDP's work on SDG impact are both very welcome developments. This morning, Dora and I are presenting a closely related work. This work is basically on a model for SDG financing. Now, the IMF has been involved in the Sustainable Development Goals agenda for a while. With other international organizations, we have a close relationship where we often discuss the Sustainable Development Goals as a long-term goal for low-income developing countries. And we've also published previous work. I would point to a paper in 2019 where we looked at the costing of critical SDGs. So we actually looked at how much would it cost for a country to achieve its SDG targets. Now, the numbers that came out there were large. They were in the order of 15% of GDP of investment needed in low-income countries every year between now and 2030 in order to meet the SDGs. In this, we take the macroeconomic perspective. This is very much something that the IMF does. When we go into countries, we look at macroeconomic stability. But there we saw a missing link, and this was assessing development financing in a macroeconomically consistent way. Our work today is filling this gap. We basically have developed a model that allows us to look at SDG financing options. And the model allows us also to answer questions like how much has the COVID crisis set back development, and what can governments do to advance their SDG agenda? And lastly, when can they realistically achieve their SDG targets with and without additional donor funding? Now, meeting the Sustainable Development Goals requires extraordinary efforts from all stakeholders. We know that. In the post-pandemic environment, even more than before. In our work, we assess the current state of play on funding the SDGs in 5 key development areas. This is education, health, roads, electricity, and water and sanitation. And we do this using a newly developed macroeconomic framework and applying it to several case studies. It gauges the resource needs, incorporating the impact of the pandemic, and looks at policy options to meet these needs. The note focuses on whether and how the SDGs can be achieved under different policy scenarios and financing options, including domestic revenue mobilization, private sector funding, and support from the international community. The SDGs represent important benchmarks for human development. They encompass broad areas of human and fiscal capital with an emphasis on sustainability and inclusiveness. While advances have been made on the SDG development agendas in different countries, further progress remains paramount. Poverty remains widespread, and many low-income and developing countries are lagging progress on their SDGs. Even on pre-COVID-19 pandemic trends, the world was not on track to meet the SDGs by 2030, as it set out to do in 2015. Then the pandemic struck, sickening people around the world and killing over 3 million, and likely many more that have gone unrecorded. The pandemic also hit the development agenda hard. It plunged the world into a deep recession. A renewed commitment to pro-SDG public policies will therefore be critical to avoid a permanent setback. Now, the IMF and other donors stepped up, greatly increasing lending to low-income countries. But the needs were far larger than even this stepped-up financing. As I mentioned before, in this work, we developed a novel long-term macroeconomic framework to assess development financing strategies. This, in our knowledge, is the only existing framework that allows country teams and policymakers to develop coherent and consistent development strategies. The framework allows the simulation of various development paths consistent with domestic policies to increase available public and private funding for development and with alternative scenarios for donor contributions. The focus is on the 5 SDG sectors for which a costing exercise has been carried out. And during this presentation, when I say sustainable development goals, I mean the SDGs in these 5 areas in particular. The 5 areas are education, health, roads, electricity, and water and sanitation. These sectors are key for development in any country, and they usually represent a large share of government outlays. And the framework can be used to develop realistic development strategies and assess the long-term impact of shocks. The framework focuses on the real economy and the fiscal sector, is fully dynamic and has a long time horizon, in this case 2050. The key relationship in the macroeconomic framework is between investment in human capital and infrastructure and economic growth. The global coronavirus pandemic and the ensuing economic crisis is having severe adverse effects. Globally, over 100 million people are estimated to have been pushed into extreme poverty in 2020 alone. And government support has saved life and livelihoods, but governments have had a hard time paying for it. Just as their spending increased, revenues collapsed. And even though most low-income developing countries received rapid support, the needs far outstripped that support. The impact of the crisis on government debt and deficits is therefore massive. And as lockdowns hit particularly the service and education sectors, they affected women, low-skilled employees, and younger cohorts disproportionately. The World Bank estimates that globally more than 90% of all students had their education disrupted. This is costly and the impact is very long-lasting. And by disproportionately hurting women and low-income and low-skilled households, the crisis is also exacerbating inequalities. The IMF's World Economic Outlook estimated that the average Gini coefficient would increase by about 2.6 percentage points for emerging markets and developing economies following the pandemic. That is equivalent to wiping out improvements in equity since 2008. We illustrate the impact of the pandemic on the development agenda through 4 country case studies. We look at Rwanda, Nigeria, Pakistan, and Cambodia. Each can be seen as representing a group of countries with specific characteristics. And all of these countries have made progress on development over the last decade. But progress in Rwanda and Cambodia has been more than in Nigeria and Pakistan. And those 2 countries are also doing relatively better on the 5 SDG sectors that we focus on. Of course, all 4 countries have been severely affected by the COVID crisis, and they've all been pushed into recessions. Now, what has been the effect of the crisis? Well, the additional funding needs to meet the SDGs were already substantial even before the pandemic, but the crisis further increased them. Using our model, we estimate that the additional annual financing need due to the pandemic is about 2.5 percentage points of GDP on average in our 4 countries, mainly resulting from lower tax revenue and higher interest expense. When extrapolated to all low-income developing countries, this would imply additional needs of some $59 billion per year. This is our baseline case. Without additional resources to offset the cost of the pandemic, the SDGs will be delayed by about a year for Cambodia and about 5 to 6 years for Rwanda, Pakistan, and Nigeria. The possible effects of permanent economic scarring would be even more damaging. This is not our baseline case, but rather a what-if scenario. We calibrate the growth impact in the downside scenario so that the long-term growth returns to only about 3/4 of its pre-pandemic potential. On average, such economic scarring would add an additional 1.7 percentage points to the country's financing needs. Of course, it would have even more pronounced effects in the long run.
Thank you, Alexander. Let me now say a few words about what countries can do to actually improve the odds of meeting their SDGs. So as you have heard from Alexander, most countries face an enormous challenge regarding the SDGs. and government policies have a crucial role to play in advancing the development agenda. Structural reforms can boost growth and thus generate more resources for development. Domestic revenue mobilization after the crisis has subsided and improvements in efficiency and governance can also help to finance development. The public sector can also strengthen institutions and improve the business climate that would then enable and catalyze private investment. Spurring growth through structural reforms is crucial. Over the long term, growth is perhaps the most important source for development funding. The 2019 paper that Alexander mentioned estimated that doubling projected GDP per capita by 2030 would reduce the additional spending needs by about 4.5 percentage points for countries. Still, even in the medium term, for many countries, the SDG needs exceed potential domestic public and private resources that point to the vital role that the international community can play in advancing development. So many low-income and emerging markets have relatively low level of tax revenues, as you can see on the left-hand side chart. And with appropriate policy changes, revenues can be increased over time. Raising the tax to GDP ratio by about 3 to 5 percentage points over the medium term through comprehensive policy and administration reforms is certainly an ambitious, but it is an achievable aspiration for many countries. However, mobilizing additional tax revenues will have to await a solid recovery after the crisis. Besides taxes, governments can also increase revenues from other sources by stronger management of government assets. Previous cross-country analysis suggests that a better management of state-owned enterprises, which are actually prevalent in low-income developing countries, so better management could yield about 1 percentage point of additional revenue. Increased efficiency of public spending can also help financing the SDGs. Analysis suggests that the average low-income developing country loses more than 50% of the return on its investment to inefficiencies in its public investment management process, as you can see on the right-hand side. The private sector has a crucial role in developing countries in generating jobs, investment, and government resources. Private investment can make a significant contribution to economic growth and development. The potential for external private finance remains largely unrealized in spite of some promising developments in the last decade, and only a small fraction of institutional investment takes place in low-income developing countries. Policies should therefore support a favorable business climate to catalyze higher private finance. For many projects, public sector support may be required, and countries also need to build up a solid pipeline of infrastructure projects that would be available for private sector financing. So low-income developing countries face a daunting challenge in achieving the SDGs. To illustrate the depth of this challenge, we assess how much a set of illustrative comprehensive reform scenarios can contribute to the financing needs and boost the development agenda. Pursuing tax and structural reforms, spurring private investment, together lowers the financing gap by almost 6 percentage points of GDP. Still, this implies that to reach the SDGs by 2030, on average, the 4 case study countries that we analyzed would need to find additional resources amounting to almost 8.5% of GDP per year. You see the breakdown if you look at the left-hand side chart. While the reforms would not suffice to achieve the SDGs by 2030, they would allow countries to meet the goals eventually. For example, for Cambodia, the reforms would enable the country to meet the SDGs by about 3 years delay, and for Rwanda and Nigeria by about 10 years, a decade later, around 2040. In Pakistan, achieving the SDGs would take even longer, but you still see the impact that the comprehensive policies would have on the per capita GDP on development by 2050. So as you have seen, additional donor support is critical for the SDG agenda. Donor country support has been fairly constant as a percent of their gross national income at a level which represents about half of the UN target. Donor countries have also been hit hard by the pandemic, and that put constraints on their fiscal resources. However, gradually building donor support towards the UN target of 0.7% of gross national income over the next decade would release about $200 billion for development. Combined with domestic reforms that I just outlined above, scaling up this donor support to the UN target would make a big difference. It would allow Cambodia and Rwanda to fill their remaining SDG financing gap in the 5 sectors that we mentioned by about 2030-2031. Of course, the impact on individual countries depends on how the development aid is distributed across countries. So to sum up, what we have described today is that low-income developing countries face a daunting challenge in achieving the SDGs. The pandemic has further increased the financing needs, and the long-term economic scarring would make the challenge even more difficult. In a baseline scenario, without further reform efforts, the 4 case study countries on average need additional resources of over 14% of GDP every year between now and 2030 to be able to meet the development goals in the 5 key sectors. Without at least some of these additional resources, some of these countries will not meet the goals even by 2050. An ambitious reform agenda could raise long-term growth and mobilize domestic revenues, while also enhancing equity and addressing climate change. We estimate that ambitious domestic reforms can generate enough resources to fill up about half of the country case studies' SDG financing needs. But even with such comprehensive, ambitious domestic reforms, the SDGs would be significantly delayed without further action. Increased donor funding and continued leveraging of international financial institutions' balance sheets could help fill much of this remaining financing gap. Supporting development with both funding and capacity development is in the self-interest of all. More than half of the world population growth between now and 2050 will come from sub-Saharan Africa, potentially transforming the continent to the most dynamic market in the world. Supporting low-income developing country populations in achieving better lives and livelihoods and getting development back on track is therefore in the interest of all. And finally, just to say a few words about the next steps related to this work that we have been doing. So Alexander described this novel framework that we have developed, and currently we are working on developing an intuitive online interface where the public could also access this novel framework. We are also organizing outreach seminars and workshops to country authorities, regional associations, and international organizations. And here you see the website. We have a dedicated website to the SDG financing work that we have been doing. So on this link, you will actually find relevant material, including the paper that we have described today, the country case studies, and previous papers. And we will keep updating this website. So anything that we produce, including the online tool, we will publicize through this website. So I encourage you all to go and visit the website. Thank you for your attention.
Dora and Alexander, thank you for laying out so clearly the daunting challenges that so many emerging economies in particular face in meeting the Sustainable Development Goals and some of the pathways to development that we might follow and help them follow. You mentioned Pakistan, for instance. We'll be hearing shortly from the governor of the state bank there on how his government is tackling some of these issues. But thank you both very much indeed for a fascinating analysis. You've made this Economist Day. Now, how does all this translate into business on the ground reality for financiers around the world? How do we work towards mobilizing that 1.1% of assets that Dr. Steiner suggested near the beginning to the SDGs. To help answer those questions and many more, it's my great pleasure shortly to welcome an especially strong panel from far and wide, from Nigeria, Malaysia, Saudi Arabia, and yes, of course, Edinburgh, with a quite stunning group of expert practitioners from a range of different backgrounds. Thank you all for coming. Now, I'm going to go around the screen as I see it in my order. I can see myself just now, but we have on the top left on my screen, and I hope this works for everyone, Sarah Norris, who's Investment Director at Aberdeen Standard Investments from Scotland. We have just below her on my screen, if this is working for everyone, we have Dr. Hayat Sindhi, who's Chief Scientific Advisor to the President of the Islamic Development Bank in Saudi Arabia, although Hayat is currently in London, as I am, and a lucky woman heading to Edinburgh tomorrow, which is a good thing always. To her right on my screen, we have Abu Bakr Abu Suleiman, CEO and Managing Director of Sterling Bank in Nigeria. Abu, welcome. And last but far from least, from Malaysia, Arshad Ismail, Group Chief Executive Officer of Bank Penban Gunan there. So thank you very much all for coming to join us. Now, to the audience, I mentioned earlier, you have the chance to put your questions to our panelists using the Q&A function, which will appear on your screen shortly. If you can't see it, if for instance you're joining us by mobile or you can't see it for any other reason, please do email your question to events@globalethicalfinance.org. So events@globalethicalfinance.org with the subject line EF 2021 question. So thank you everyone for joining us. We've got a great turnout today, a great audience, and particularly a great panel. I'm going to give them as much time as possible to bring their massive brain power, experience and passion to bear on this pivotal issue. The way we're going to do this is by asking them to introduce the theme from their perspective for about 5 minutes, say a little about their own journeys to this critical point in human life on Earth, then open the floor to questions from you. And I'd like to start with Dr. Sindhi from Hayat, from the Islamic Development Bank. I could have done with you on my side a few months ago when I wrote an editorial in our CISI Chartered Institute for Securities and Investment magazine saying that grey is the new green. And what I meant was that green was now rather old-fashioned, and that the grey of science, the grey of the sort of medicines, the machines that make the medicines which were saving us, the testing machines which made sure how long we had to live and if we needed some help to continue to do that longer, all the science which has been brought to bear this past year in saving the world from the pandemic. And it's great to have a proper person who knows what she's talking about on, I hope on my side here, not necessarily saying that grey is the new green, but I'd love to find your take, Hayat, on the importance of science in achieving the Sustainable Development Goals, and welcome.
Thank you very much, George. Bismillah ar-Rahman ar-Rahim. Good morning, good afternoon, everyone. Thank you, George, for this nice, kind introduction. On the behalf of the Islamic Development Bank, thank you very much for inviting me to this important panel to address and discuss the global perspective of on SDG finance. With COVID-19, as you mentioned, crisis, there doesn't seem a more critical time to consider the future of ethical and sustainable financing, and how countries and their financial partners can rebuild more resilient economies for people, for our planet, and continue the progress toward SDGs. Our president, Dr. Bandar Hajjar, His Excellency Dr. Bandar Hajjar, always focus on addressing the root causes hindering development. And sustainable development goals can only be achieved through a new business model, which creates partnerships and financing mechanisms that attract new type of investors and allows competitive growth. His Excellency, with his new business model, put SDG as the umbrella of the whole ISDB, Islamic Development Bank activities. And when SDG was launched in 2015, was a new path was illuminated by UN as a universal call to all of us to look after our planet. But also UN realized that we need to have STI, science, technology, innovation, at the heart of SDG. And this unites the vision between scientists and policymakers to address the challenges to achieve SDGs. As you know, it's not easy to accomplish no hunger zone or poverty or renewable energy and quality education without innovative ideas, without technology, without science, without innovation. And that's why bring us to the power of science, technology, and innovation, what I want to focus on this, my 3-4 minutes introduction. His Excellency realized, because all our work is development work, so he put science, technology, and innovation at the heart of our organization as the key pillar for our strategic also partnership. So we established Science, Technology, Innovation Department. We are the first multilateral bank to establish that. And we're advancing in the science, technology, and innovation in the 3 main tracks. The first one, we're assisting our member countries in developing strategies and policies that support the establishment of STI ecosystem using SDG index. Second, we're integrating STI and SDG into the whole business model of the ISDB and projects. And that's also when we come to a point of how we do impact finance. Also, we're providing seed money, which is very critical to the entrepreneurs and an innovator to fulfill their own potential and develop solution, local solution, which is really now with COVID-19 highlights how much we lack local innovation to address SDGs. And bringing together a partner to work together to create enabling environment to transfer technology from advanced nation to less countries. So integrated approach to science, technology, and innovation is critical to global development. And that's why we established, first of all, in 2018, 2 important initiatives. One of them called Engage Platform, which is a digital hub aligned with UN SDG calls. And this is main function of this Engage Platform to transfer of technology, matchmaking, and also call for innovation to address challenges for 6 SDG, food security, quality education, health, renewable energy, water, sanitation, and infrastructure. And to have that sustainable, we need fund. You know, if you want to call for innovation, it's good to have ideas. So we created another initiative called Transform Fund, and from the name Transformation, with $500 million. And for the past 4 years, we've been getting an amazing ideas from the globe. So regarding of nationality or religion or sector, it's a win-win situation. We challenge scientists around the world. We challenge institution to come with ideas to address the challenges, and we tap to the local innovation. And so far, for the past 3 years, we have about more than 95 innovative solutions addressing challenging in the 6 focus area. And also we address sustainable cities. When we start the Engage Platform and Transform Fund, a lot of people said to me, you're a dreamer. In a developing world, people face, sorry to say, you know, depression, famine, catastrophe, wars. And amazing, we received more than 4,000 entries for the first year and gradually 5,000 and 6,000. An amazing idea, George. An amazing idea. We can talk about that later, about the example. And that's exactly what we need to do, especially with the crisis. Because it's no drug company going to give you full license to move that to the most deprived world. But you need to tap to the local talent, to health expert talent, to understand how we can establish R&D and focus on technology transfer and to develop vaccination. My last point before I finish, also we reorganized the whole scholarship program, which is I'm responsible for, under sustainability science. And that's critical, but also can give help to women to have science and technology attractive to them. Because with the Sustainable Development Goals, when you have sustainability science, we study for 3 months what will be the main skills we need to equip our students from our member countries to help their own country to build the right infrastructure. So for example, you can do chemistry, but think about pollution of microplastic. You can do engineering, but think about renewable energy. So we establish or re-establish the whole scholarship program and the sustainability science, and so far we invested more than $200 million for the scholarship program. I stop here, George, to give a floor to the rest of my honorable panel, and then we'll come back if you have any more questions. Thank you very much.
Thank you very much, Hayat. Can I ask you one? Can I jump in chairman's privilege and ask you one question, which is about, you set up the Transform Fund 2 years roughly before the pandemic. How has the pandemic affected your investment decisions, I wonder?
A great question, and it's exactly the power of the digital platform of Engage and Transform Fund. We wanted to, we wanted to be part of the global address of the challenges. So we direct last year, 2020 and 2021, we directed the call to whole scientific institution to come with the ideas for low diagnostic, because diagnostic is the key thing for prevention, and how we can build the whole value chain of health system. And amazing, George, what we get. For example, we picked top 30 amazing scientists from all around the globe. As I mentioned, 173 countries, from Europe, from Africa, from Asia, from Middle East, from the whole the globe. And one of the examples, for example, this guy Karim, who from Canada, but he created this portable X-ray to be taken to whole Pakistan to be able to test for the ventilation system and how he can, and if he can need to be admitted to hospital and if he's responding to drugs. Another one, he developed an amazing digital chip for DNA diagnostic in Nigeria. And some of our students with EduCast who changed his like a telemedicine, who are reaching 100 million people and women in Pakistan to be able to be diagnosed and have this telemedicine type of treatment, so saving millions of lives. So that type of innovation, and can be scale up. It can be, we invested in like a proof of the concept idea to scale up to commercialization. And one example of when we invested in 2018, with before COVID, a guy from, his name is Zora from London, he developed a solar refrigerator from the local innovators from Uganda and Mozambique to help them for refrigerate the crop, which is 80% of it is go wasted. And now AstraZeneca and another company contacted him to be able to use this refrigerator to store the vaccine. So how could you see that? I mean, you see that how we can develop the innovation to really adjust that to social, and that's what we call social innovation. When how you can link science and society and develop something to address the need and the challenges. And it's a more example, but
I would love to hear more examples. Let's come back to them later on, but I think you're proving my vague point that grey is the new green with some facts behind it for one. So thank you very much indeed. Can we move swiftly eastwards now to Malaysia? Arshad, you've been on a different journey, of course, a different kind of institution at your bank. Can you give us a bit of the background to the bank and where you're moving now, please? And welcome, of course.
Thank you, George, for the kind introduction. I'm with Bank Pembangunan Malaysia, also known as the Development Bank of Malaysia. So for those who don't speak Malay, it's just easier to refer to as the Development Bank of Malaysia, wholly owned by the government. And I'd like to talk about our journey. Back in 2019, we were focusing on our then so-called 4 mandated sectors, namely infrastructure, oil and gas, maritime, as well as technology. And we also had a fund known as the Sustainable Development Financing Fund. And under this fund, we made it a point to support projects in line with any of the 17 SDGs. However, I have to confess, we didn't have a really structured way to measure how these projects were supporting these SDGs, but it was just a broad mandate that we had under the fund. Also in 2019, I had a conversation with one of our most important stakeholders. And during that conversation, they said that as a development financial institution, we have to pay more attention to the impact of the projects we finance and propose to finance. And they said that based on their assessment of how we were operating back then, we weren't doing that. And that was, I would say, a wake-up call for us. And as a consequence of that conversation, we took a critical look at our operating model. And we knew that we had to make changes fairly quickly to remain relevant as a development finance institution. And we also knew that there were people we could turn to for assistance. And in this regard, we reached out to the World Bank. And the World Bank, as everybody is aware, has been focusing on impact financing for quite some time. So we reached out to them, and together with a team at Bank Pembangunan, we spent 6 months developing an impact assessment framework. Now, at the very beginning of this project, the World Bank team asked us two basic but fundamental questions. Which of the 17 SDGs does your bank want to focus on? And that question took me by surprise. We then spent a bit more time discussing this, as I said, very basic but fundamental question. And we decided to look at our then portfolio and map the portfolio against all 17 SDGs. And as a consequence of that analysis, we discovered that 5 of the 17 SDGs were most relevant to our then portfolio. So the question then was, do you want to focus on just these 5 SDGs, or do you want to focus on all 17? We decided to start by focusing on these 5 SDGs. The SDGs that we decided to anchor our assessment framework to are SDGs 7, 8, 9, 10, and 13. And of course, I will mention later why we probably need to enhance our framework, because as we run more and more projects through our assessment framework, we often realize that there are other SDGs that are relevant, but because our framework as currently constructed does not assess those SDGs, we might be losing out on the impact assessment. So that was the first basic but fundamental question. The second basic and again fundamental question that we had to answer was this: if a project we run through the assessment framework does not meet or does not achieve a minimum score, do we turn those projects away? Again, we spent a fair bit of time together with the World Bank team, and we decided that we needed time to understand how this assessment framework was going to work, how it was going to impact our decision-making process at the bank itself. And we also needed time to educate our customers, because I can tell you that trying to explain to our customers why is it that we're asking for so much more information than what a traditional bank would ask for is very much necessary for our assessment or evaluation process. We finally decided that at this point in time, whilst we will use the assessment framework to measure the impact of projects we propose to finance in a structured manner, we will not turn away projects that might not achieve a certain minimum score. Of course, in the near future, I do hope, and it is our ambition, to be able to say that if projects don't achieve a certain minimum score based on the assessment done using this framework, Bank Pembangunan will turn such projects away, but not just yet. There have been some challenges, of course, in this journey. We piloted the assessment framework back in January of 2020. So we've been running it for about 1.5 years now. And as I said, it was not just about educating our customers, it was also about educating ourselves. Because as bankers, we were quite used to evaluating projects based on the usual financial criteria. So although we have read about and attended conferences that focused on SDGs, but it was a different thing altogether to be involved in an evaluation process that had SDGs or the impact assessment at the core of the evaluation process. So having gone through the process for about 1.5 years, some of the challenges that we have discovered include educating our clients. As I said earlier, our clients have been quite used to furnishing us and other banks with the usual information. But when we need to run these projects through the assessment framework, the list of questions can be quite extensive and unrelated to the usual financial criteria or evaluation aspects. So that's one. And as I said, educating ourselves is probably more important. So it's not sufficient for just our board of directors. It's not sufficient for just members of the senior management to live and breathe the SDGs and to understand what the assessment framework is meant to achieve. Everybody in the bank needs to internalize the concept of impact financing. And I would like to think that we have had a lot of success in educating ourselves, but a lot more work needs to be done, because we need to be in a situation whereby when any member of the organization is asked about our commitment to impact financing, he or she will be able to, or should be able to, speak eloquently on the topic. So that's where we need to get to. Let me talk about how this has impacted our decision making. Although we are a development finance institution, we don't give grants, we give financing. So whilst we are meant to support various sectors of the economy, it is also important for us to ensure that the financing we grant will be repaid so that we can continue supporting other sectors and other customers. But because we have the assessment framework, sometimes we are able to make a considered decision to support what would otherwise be viewed as a weak credit. But because of the high social and environmental impact, we are able to make a conscious decision to nevertheless support that project and acknowledge the fact that we are doing so notwithstanding the heightened risk that perhaps an ordinary bank that doesn't focus on impact financing might be inclined to turn away. I'll stop there for now, George, and I'll be happy to take questions if there are questions on what I've just said. Thank you.
Arshad, no, thank you very much indeed. I'm intrigued that there are 2 people on this call who've chosen 5 as the right number for prioritizing the Sustainable Development Goals. The other one is a man, and I'm not going to name who he is. I won't spoil the surprise. But I'm interested in this question of education and about educating the board in particular. I'm not talking about your board, of course. We're talking in generalities here. But sometimes one of the problems in this whole area is in the governance of it and ensuring that the board's mindset is right. What sort of advice might you offer to other institutions you used the word education a number of times there, in helping educate very senior people understand what the purpose, the mission of the bank is?
Well, when I say education, of course, I'm starting with myself, because I'm not an expert when it comes to sustainable financing. So it has been quite a journey for me educating myself. I am fortunate in that my board members are committed to sustainable financing, and they themselves are learning the intricacies of sustainable financing, the mechanics of sustainable financing. But I'm fortunate in that the commitment is there. So once you have the commitment at the highest level, it's not too difficult to put the pieces together.
Thank you, Arshad, very much indeed. Can I turn now to, time is marching on, so can I turn now to Abu? Abu, can I just say before you start that I'm hugely impressed by your website, in that it genuinely, I've been looking around all of your websites, of course, maybe not Aberdeen Standards, because I know the firm reasonably well, but in the case of Sterling Bank, it seems to want to help me genuinely and enormously. I walked into a bank in London a few weeks ago to pay in a cheque, which for younger viewers is a piece of paper with figures written on it and a sum of money and a signature at the bottom from an American organization. And I found it quite hard to pay in the cheque because somebody was desperately trying to sell me a mortgage. Now, I don't have a mortgage. I don't want one. I used to have one. I'm too old to have a mortgage, but it didn't stop them trying to sell to me. But your website is great because it really was assuming that I was looking for help in trying to do things and made me good offers based on what I was looking at. So thank you. Abu, welcome. And I wonder whether you might be the person with 5 sustainable development goals as your objective.
Interestingly, we do have a 5-sector focus. Our journey into sustainable goals and our journey into sustainable financing was actually not one that we set out to. We set out with a completely different set of objectives, and our objective was that we were doing financing in a country where the size of the financial services to the real sector was very small, and we wanted to find out why financing wasn't growing. And our conclusion was that we seemed to be all waiting down the stream, waiting for the water to flow, that there were major issues upstream that needed to be resolved to essentially create the growth that we could bank. So we were working towards a business reason to do what we were doing. We wanted to find out what were the most impactful sectors where if you bring in financing and some level of knowledge, you could have the highest growth. And then we found ourselves tied to goal number 2, goal number 3, goal number 4, and goal number 7. And suddenly we realized that the problem we're trying to solve, which is how do you create growth in a country with the sort of population that we have, were fully aligned with the sustainable goals. And so we took it up from there. Again, as we went through the journey, we realized that the concept of sustainability and sustainable financing actually started in form of an activism, and with people saying that this is the right thing to do. And then from there, it went into government when people started to legislate for the right thing to do. And it went into development institutions who then said this is the right place to be. And now we're at a point where we are trying to bring investors into the fold to say this is where to put your money. But we realized that there are 2 significant stakeholders that have not been brought to the center of sustainability, as it were. One, of course, is the consumer and the power of consumption and what it can do to change people's behavior. But the other one is actually the manager or the business leaders or the corporate world, not the investors, but the people who go to business schools and come out to run businesses. And this matters because at some level, they are in a unique position to aggregate all the other stakeholders who are interested in the SDGs to say, look, this can be done differently. So our approach is we've approached this to say the best way to create long-term economic value for our institution is to solve the biggest problems of the society. And it so happened that those goals are actually aligned with the biggest problem that SDGs are trying to focus on. So how does this happen for us? If you look at it from a business and from a what I would call an economic perspective, in Nigeria, and I think this is true of all emerging and frontier markets, there are sectors where there is a significant gap between what the environment is able to provide or what the supply is and what the demand is. One good example is education, where, for instance, the total population of students in Nigerian higher institutions is 2 million, and the population of the country is 200 million. So clear demand-supply gap, and therefore, if you figure out a model to provide these services at an affordable cost, you know it will scale. Same is true of healthcare, same is true of power. We have one of the most ineffective power systems in the world, one that was not built on legacy systems that are fossil-based. Therefore, our decision, for instance, to go into renewable energy was driven by the economics of it rather than just the fact that it has social impact. So we ended up funding healthcare, which we think is a massive opportunity for our country. We ended up funding education, which I have just explained. We ended up in agriculture, which again ties into sustainable goal number 2. We then ended up funding renewable energy, which is the number 7. And then we ended up funding transport, which is, to our mind, ties all the other goals together. And we call that the heart sector. So it's health, education, agriculture, renewable energy, and transport. But the beauty of what we've done is that rather than try to pursue specific projects that would come under the sustainable goals, we have decided to allocate portfolios. So you take 20% of your entire lending portfolio, I'm going to put it in the hard sector. And then you set goals to say every 2 years, I'm going to increase that by another 5%. So we are migrating the entire institution to focus on the sustainability as a core. But that is not where the victory came from. The real victory was that we're able to convince our shareholders, and our shareholder base cut across the entire world, with banks like State Bank of India as a shareholder in Sterling Bank and quite a lot of private money. We convinced them that this model is actually a far more superior model than what we've done today, which is to pursue quarterly reporting and focus on the what I would call the instant gratification. They now believe that if we run this model successfully, we'll have a long-term viable business that will compete favorably with any other business. And the second point is that we've now put the hard sector at the core of the bank. And therefore, we are spending a lot of money building capabilities in these sectors. Once you have the knowledge, once you have that capabilities, once you have the relationship with the sector, bring it together with finance and technology, and then you can actually start to have real impact. So our real victory is that at the heart of the hard sector, if I may say that, at the heart of our own sustainable financing, it's the business leaders themselves who have brought the investors to the table, who have brought the board members to the table, who have connected with development finance across the world. We're now connecting with government and convincing them that this is the way to go. And obviously, the last leg of that is that we connect with both the consumer on one side and hopefully global investors on the other side. Our tripod, which is a business on one side, government on the other, and those who are looking to do impact on the third part, that tripod, we believe, is the winning way to bring money into sustainable financing.
Abu, thank you so much. That's fascinating. Can I ask you a question about education, about this thing you mentioned about the supply-demand imbalance on high-level education, 2 million places, 200 million population. How can you work with the industry to provide to help encourage higher levels of provision of education in that way? How might that work? How does it work? I'm sure you are working on it right now. How does it work in practice? Can you give us some practical examples, please?
So we have an interesting model where we said that we need to first of all figure out how to deliver the education that is required at the price that we can afford, right? So clearly the current model, for instance, of 4 years in university, average cost of $5,000 per annum doesn't work for us. We have now found a model where we're collaborating with Nexford. Nexford is a 100% online university that is originally registered in the United States and is now working with the Nigerian University Commission. We are then collaborating with them to offer a 3-year pathway to a bachelor's degree. But what makes this different is that in those 3 years, there is a partner, right, a corporate partner, where the students will then intern for 3 years. So you get to have the benefit of 3-year work experience in a sector of your choosing while you get the education. But also more importantly, we're able to deliver this education at under $2,000. We believe that for the entire 3 years, this education will cost less than $2,000. The student will get paid a stipend because they are interning somewhere and therefore they're able to take care of their other needs. But more importantly, this has now made it financeable, because the amount involved is far less than what it would have cost to go to a traditional university. It's now possible to bring in financing into this space. What we are hoping for is that partners from across will start doing some risk sharing or some liquidity facility to enable us scale this. And obviously, because it's an online university system, our capability to scale is so significant that we can add 100,000 or 200,000 a year or two and hopefully scale into millions. So that's one example of how to, first of all, deliver the education that we need at the price that we can afford. We're also doing the same thing to deal with the out-of-school children, which is a significant issue in Nigeria, by saying it is very difficult to scale both education infrastructure as well as teachers. However, let's recognize that if we take the fact that there are a lot of adults that can serve the purpose of teaching at the initial stage, the parents, for instance, the home where you grew up, what if we represent educational content such that the mothers suddenly become teachers because they are able to educate the children in the basic things? And that way, we effectively pull out a lot of the people off the street first into some kind of semi-school, but it's exactly the same content that they would have learned if they were in the primary school. So we're building content for that. And once it is demonstrated that the quality of education arising from that is as good as what you get in the primary school, then hopefully we can scale it to millions of homes rather than trying to build thousands of schools.
Abu, thank you so much. When we're all allowed to travel again, one of my first objectives would be to come and visit all the great work that you three are doing in different countries around the world, which I would love to revisit. Thank you all. Now, last but very far from least, and in a country which I will visit, even before flying is allowed, Sarah Norris, Investment Director at Aberdeen Standard Investment. Sarah is in fact in the west coast of Scotland, not in slightly better connected Edinburgh, but we may get her back by voice sometime soon rather than by video. I do apologise, and Sarah, we hope you can rejoin us. We've had a number of questions in about measurement of impact investing, but I wonder if I might... Sarah's back. Can you hear us? Sarah, welcome.
I can, apologies for that.
Not at all. I've just explained that you are a lucky person to be in the west of Scotland, where the biggest and half of it oldest firms in Scotland. We heard the First Minister of Scotland, Nicola Sturgeon, talking this morning about Scotland's great heritage in this field. Standard Life, vast, been there forever, since before any of us were born, even me. Aberdeen Standard, a newer firm, very nimble, very big indeed, and the combination, really terrific, powerful force. How has this whole field worked for you over the decade in which you've worked in this industry? And thank you for rejoining us.
Oh no, apologies. As you say, being in Scotland, it's a great privilege, even though we don't necessarily have the best connection at all times. But I guess our journey in impact investing has very much been to try and be a partnership and complementary to a lot of the presentations that you've heard earlier, because we developed a strategy that is impact investing in listed equities. So we're very much impact aligned rather than investing in specific projects. And I think we heard both Abu mention it and also Dr. Hyatt talking about how we should be focusing on investments to deliver the Sustainable Development Goals and really looking at unmet needs, which I think Abu said eloquently, and it's a phrase I always use, is unmet need translates to unmet demand, and therefore that should be returns enhancing. You're investing in a project where there's a natural demand, and that's how we think about impact investing, and that we are looking to use the Sustainable Development Goals as a lens for defining unmet need and prioritizing the significant issues the world faces, both from an environmental perspective and from a social perspective. And using this lens, we have taken the Sustainable Development Goals and translated them into investable themes from a listed equity context, because we know that the Sustainable Development Goals aren't for corporates, they're for countries, but corporates have a role to play in achieving the Sustainable Development Goals. In the prior presentation, I think the presenters were talking about a funding gap and mentioned about 8% of GDP in one instance, and to put that in context, the UN has estimated that there's a $2.5 trillion funding gap in emerging economies to meet the Sustainable Development Goals. And so with stretched government balance sheets and there's a necessary partnership there between governments, development banks, and other actors, as well as corporates, to delivering these Sustainable Development Goals. And those strategies make up a spectrum of capital, I think, that can be quite complementary, filling different gaps and able to contribute to the ultimate goal of delivering the Sustainable Development Goals. And so that's really what we're trying to do. We're looking to invest in corporates that fit into one of our 8 themes aligned to the Sustainable Development Goals, half of which are environmental and half of which are social, looking at sustainable energy, the circular economy, food and agriculture, and real estate and infrastructure, all the way through to financial inclusion, water and sanitation, and health and social care. And really looking at companies that are investing in products and services that are going to drive a measurable impact in each of these different areas. And that, I think, is the key focus, is looking at companies that are investing. We don't want to look at companies that are just aligned to specific themes. We want to see companies that are mission-led, really investing in products and services that are going to tap into that unmet need and that unmet demand, because we do think that there is a business case for delivering profit with purpose, I guess is the phrase that we always use. So I'll stop there, because I'm sure there are quite a few questions, and I'm actually quite interested to hear what the other panelists have to say as well.
Sarah, thank you very much. We're getting a torrent of questions in, and there's a particular focus on measurement of impact. How do you go about evidencing the sort of impact that your investments in listed companies have on the sustainable development goals? And then I'd like to go around the rest of the panel asking them the same question about measurement. How do we measure the impact?
So we have set key performance indicators for each of the different businesses that we invest in and each of the different themes that we've identified that are aligned to the Sustainable Development Goals. Because we very much don't want just to say we've taken X number of cars off the road or contributed to a reduction emissions equivalent to X number of flights between New York and London. I don't think that really tells you anything. That's not impact. We instead want to look and say, okay, how is a company actually affecting the financial inclusion gap in a specific country? What are the financial accounts that they are creating? What are the interest rates that they're charging? What are the churn rates? And deep diving to be able to link back the impacts that the companies are having at a specific country level. So I guess a good example is a company called Kornit Digital, and they operate waterless printers for the textile industry. And so we know that the textile industry contributes to 30% of water pollution globally, and 10% of microplastics in the ocean come from textiles. So Kornit is really trying to eliminate that water usage in the printing technology that it offers, and is then able to report that reduction in water usage back up to the big businesses that use it, whether that is an Amazon or a Nike or an Adidas, and really driving home how water use is changing in a specific country. So you can see where your water stressed areas, is there printing there, and the reduction in volume in water, and how that contributes to some of the goals, specifically around water usage and sanitation.
Sarah, thank you very much indeed. Dr. Hyatt, may I turn to you now? I just wonder, is it naive of me to think that measuring impact from a new investment in something innovative might be easier than measuring impact from, say, an equity investment in an old established business? I think that probably is naive of me.
Not at all. It just like, as Sarah mentioned, people sometimes use index and some certain indicators. But if you are from if you are a developing bank, you don't look at the maximum the profit impact. You look at how you can maximize the impact of the development. And we are a unique position for the ISDB that we can finance SDG directly. We can make the best use of our business model. And I was hearing Asher, and I was hearing also Abdul and Sarah when they mentioned regarding the gap, financial gap, and I agree. Between 2.5 to 3 trillion gap. How are we going to achieve that? So if we're going to go with the traditional model, as Asher mentioned and Abdu, we will going to have no sustainable future, because we cannot rely just on one source like government for the main source of economic empowerment. So with the Islamic Development Bank, the way we do the investment impact investment, and also how we measure that, and we come with a new business model which is involve more tapping to that competitiveness and advantage of each country with the whole value chain approach. And that's also using a new innovative financial model, what we call blended finance, coined by 5 Ps, which is coined by His Excellency Dr. Badr Hajjar. 5 Ps, public, private, philanthropic, people partnership. And that's to create the whole stakeholder to tap, because you need to invest in people, you need to have private sector, you need to have public, you need to have government, and also you need to create the right environment for the public sector to invest. So our developed effective report really showed there the real impact and the real measurable of what we do in our developing country, and for the whole also the rest of the other NDBs. And also I'm in a position when I'm running the science, technology, innovation. I'm running the STI strategy division, which we are studying there on the ground. We are 57 countries, 1.7 to 1.8 million. So we have effect in every 5 people. We have effect on one on 5. So we have 11 hubs, and we developed this toolkit or index for SDG to measure the impact and how we can progress that. So it's not an easy, straightforward, but also you can see the impact when you have investment in scholarship, and it's like what we did in the Transform Fund, the impact on that, and how that now our technology and our transformers, we've been asked by WHO to have their own ideas to be mainstream in their own offices on the ground and on the developing countries. So that's a whole way of looking to approach in more comprehensive way, and tap to the new business model, which involve the whole stakeholder with the blended finance, and see how we can from the start see the impact of that. Because when Dr. Badr Hajjar arrived in the bank, he canceled many projects that he cannot see the real impact for that, because you can tick in your sheet, I've done, we built 10 universities, but how many people really have the impact of them? How many people really graduate with the right degree that can offer help and can build the infrastructure of their own government or society? So we look at the whole value chain. When you build a school, when you help for the entrepreneurship, when you help for a scholarship, when you have business model, when you have partnership, when you are helping the private sector to invest in country, what type of environment, what type of the end result, the outcome of that to help the development and have the economic stability for their society.
Thank you, Dr. Hayat. Brilliant. May I next turn to Abu from a commercial bank to look at how you go about these measurement issues, and then afterwards, may I turn to Arshad, looking both at the measurement issue and perhaps moving on to how, related to this COVID-19, what COVID-19 has changed about investing in impact. But Abu, measurement in the commercial sphere, as opposed to development banking sphere.
I guess for us, the single most important and direct measurement for us is to see how much of our resources we've dedicated and committed to the sectors that then fit into the SDGs. So straight line measurement is how much of my loan book is going into healthcare, education, agriculture, renewable energy, and transport. And what has happened is I've seen that grow from less than 5% and is now approaching 20% since we started this journey. What we expect is that more than half of all of our lending will go into the sectors that fit directly into the SDG. That's sort of straight line. The other thing that then matters to us is we're measuring the number of people that we're getting onto platforms, because we also concluded that the way to have real impact is to combine finance and technology. And the way that combination works out is in the terms of the platforms that are very useful in reducing the cost to serve, at the same time getting the services to those who are currently excluded. So we have platforms that solve this. One example is we have a platform that is dedicated to connecting the farmers in the village to the users of their commodities, because in between their harvest and when they actually virtually sell this to, say, the FMCG or the exporter, a lot of value is lost. And a lot of value is also extracted by people who had not invested in the process. So we created a platform. Key objective, make sure that the farmer can directly take their commodity to storage facility from where they can directly sell to the person who uses the commodity, integrated with the transport infrastructure so that they don't have to worry about transport, tokenize the commodity so that it's very easy to speak the same language. So once you see a commodity, you know the quality, the standard, and the age of the commodity. So again, how many people are on those platforms? That's another good measure. Essentially, it's a measure of inclusiveness. But at the end of the day, though, I think we need to also go back and ask, are we really transforming these sectors? Are we doing the business in such a way that other businesses, either in our industry or in other industry, are paying more attention to the sector? Do we have more people replicating our model? Because the greatest, really, truly, when we would be able to look back and say we've succeeded, is when the concept of having a hard sector strategy or such similar strategy that speaks to what institutions care about becomes a standard. We need corporates to be able to say, this at the core of my strategy are this set of commitments that then drives impact, that then drives sustainability, that then drives the SDG. So we would like to see that. We've seen a couple of small organizations that are beginning to think that way and copy some of our thinking, but we'd like that to become the mainstream way that strategy is done across Africa for a start.
Abu, thank you very much. Arshad, before turning to you, can I just forewarn you, we've got 5 minutes to go. I might ask people for final words and for a final point when we get to the end. There's another question in Arshad before I ask you about the question about the impact of the pandemic. Someone saying even before the pandemic, not a single country was on track to complete the Sustainable Development Goals within the decade. And given rising rates of inequality, food insecurity and climate change, as well as the pandemic, where does that leave us? How are we on the trajectory to meet the Sustainable Development Goals? Then I'll ask other panelists to answer the same general point about meeting the SDGs, given all these issues, food insecurity, climate change, of course, and general inequality, before making any final points. Arshad.
Should I address the question you just posed, George?
Essentially, with most of the countries, in fact, virtually no one is going to meet the Sustainable Development Goals by the end of the decade. And given growing levels of food insecurity, the issues around climate change, and other problems that we've been discussing this morning, where does that leave us? Do you think we might, on a general front, achieve the Sustainable Development Goals in large parts of the world by the end of this decade?
Well, what I will say is that there's definitely an urgency, and the fact that we don't expect all countries to achieve the objectives by the end of the decade should be an alarm bell for all of us. And as I mentioned earlier, financial institutions do have the power to change behavior in society, and it is therefore important for financial institutions to focus on doing what needs to be done. As I said, we don't have the luxury of time. Governments, of course, can set policies, but can actually accelerate the execution and implementation of those policies. So that is what I would say as a direct response to your question, George.
Thank you very much, Arshad. Sarah, what do you think? Can we accelerate the progress towards Sustainable Development Goals?
I would agree with Arshad that there's definitely a sense of urgency, and something that has been phenomenal to see is over the last decade, the perception of the greatest risks that the world faces has overwhelmingly transformed from being political or economic to being environmental and social. And so I think there is a heightened awareness. I call it in the UK the David Attenborough effect. We know where our food comes from, we know how our clothes are made, and there's an agitation from consumers as well as an increased political will from our regulators around delivering the Sustainable Development Goals as best we can. And I think we can't wait for perfect, because if we wait for perfect, we'll never get there. So we do have to start acting now. And I think that action is starting to accelerate, but coming back to the point that one of the ways that we deliver the Sustainable Development Goals is buy-in from every actor in society. We can't wait for just regulators. We can't wait for just NGOs or rely on just NGOs. I thought Hayat's P's were brilliant in terms of how you phrase that. And it is very much every level of society that will have to deliver the Sustainable Development Goals, and everybody has a role to play, whether it's a corporate, an individual, or a development bank.
Sarah, thank you very much. Development banks, Hayat, what's your view on this about likelihood of achieving them?
Thank you, George. It was luckily I was delivering a talk yesterday on OECD country about SDG index, and I'm just going to read the fact to all of you just from my note from yesterday. We did this analysis of all our member countries regarding SDG. So 2020, ISDB member countries has an SDG index score of average 61.6 on a scale of 100. So that's, you can see, is below average, and is not even distributed evenly among the 57 countries, because 21 of 57 least developed countries. So we have to really take into consideration the infrastructure of each country. But the most SDG that being is performed relatively well. SDG number 13, which is climate change. SDG number 12, responsible consumption and production. And SDG number 4, quality education. And you're right in terms of the facing important challenge. SDG number 2, which is zero hunger. SDG number 5, which is quality, gender equality, and SDG number 9 for the whole globe, a developed or a developing country, which is the innovation and infrastructure. So we need to we tap into that, and the Transform Fund and Engage. Yes, when we ask people to address challenges in the whole 6 SDG, we found certain country, they are really good in health. And when we did this landscape of calling a local or national competition, we find, for example, in Bangladesh, most of the IP coming to us is in textile, and for example, in Niger, agriculture, and for example, in Pakistan, health. So that type of data, which is a unique data we collect, give us the right chance and channel to tap on why, for example, other SDG not being addressed by this country. What are really the main challenges they're facing, and how we can address that with the whole value chain of country, policymakers, decision makers, investors. So we are trying to use that index also, even though we're happy to see most of the innovation in agriculture, but what about the rest? And that gives us indication of how we can channel that. And we believe science, technology, innovation could help here, innovative finance, innovative ideas, tap into the local talent, especially with COVID-19, building R&D. We are in a critical mass. You're right, 2 main sectors affected badly by COVID-19. We know health, of course, but farmers, agriculture, and education. And now we are putting a program with about $2.3 billion, which is called 3 Rs: response, restart, and rebuild, where the 2 main functions of this program is, like, of course, for the emergency response, like a mask, a ventilator, but also the second part, how to build the infrastructure, how to help with the SMEs that have been hindered very badly by this, how we can help the financial stability, how we can tap to the other sector that have been hit badly. So we need to do a lot of work, but I believe we're doing the right track by getting this special data and putting decision maker in the back, really putting the right resources at the right time with the right people. Thank you.
Thank you very much, Hayat. Abu, before I turn to you with the same question about achieving those goals, last year at this time before the event, I'd just finished reading a brand new book by John Kay, brilliant Scottish economist, on radical uncertainty, which I find fascinating. This year I've been reading a book about how you become a good ancestor, what we should do to think long term, to think about our, in my case, grandchildren as well as children. But can I segue you, Abu, into an absolutely final question about, with a brief answer please, about how we become good ancestors, but sustainable development goals, which is part of that. Can we accelerate the process in the coming years to achieve the objective?
Yes, I do believe that we missed out a very important segment when we were trying to create the environment for sustainable goals. And that is the people that end up becoming leaders in businesses. So when you go to a business school today, there's a significant amount of education on how to deliver returns and all the other things. But very little is done to actually prep people so that they're thinking holistically. And that doesn't mean that you are underperforming. It just simply means that you're thinking about all of what constitute returns, all of what constitute return on investment. Right now, it's so skewed to financial return that there's very little conversation. The team that has made it possible for us to do what we do today, a team of very young people who took it upon themselves to be interested in the future, essentially people who themselves are barely old enough to start a family, who have then taken on the ancestor thinking, who are now thinking about sustainability. And in a way, our generation should be ashamed of that. I shouldn't be able to go around saying to people that the only people who are interested enough in sustainability and impact to join the team I'm building are the people who are as young as my own children. We should be the other way around. We are the one with the responsibility for building that future to hand over to them. So I think we should begin to think about how we train leaders and how we put funding behind schools that are interested in infusing a significant amount of education to business leaders so that they come out of school ready to balance the returns that they're going to pursue. That was one. The second part for me is that, and I think Dr. Hayat has been quite explicit about this. There are small ideas with big impact that needs to be supported urgently. So I'll give you an example. About a year and a half or 2 years before COVID, Sterling Bank supported a platform called Tremendoc. A couple of young boys who wanted to build a telemedicine platform because they realized that access to medical infrastructure, even where it exists, was so inconvenient for older people and for people in cities where traffic is bad. So why not telemedicine so they can have online consulting? We gave them a small amount of money, $200,000 out of money. And in the year of COVID, they had over 60,000 consultations. So you get a sense of how much 200,000 in investment can do if you put it in the right place. That kind of thinking, that kind of scaling is what I hope development institutions and government will support us to do, because it may not be economically viable in the short term, but that platform can become a massive platform for impact in the healthcare that will rival spending $10, $20 million in infrastructure. So I think that kind of thinking, in other words, I believe that because we have the technology we have now, if we articulate ourselves very well and focus our effort, we can have the results we're looking for, irrespective of all the other big issues that are happening around us. And finally, the same way we think of climate change and we think of carbon credit, we need to start to think of credit that are associated with people that focus resources on sustainable financing. So that if I were to approach a development bank, for instance, for some reason, I should have an advantage in accessing them and their fund, either in terms of pricing or in terms of the parameters that I use to access me, because I've done previous investment in the sustainable goal or in SDG related areas.
Abu, thank you so much. We're running out of time here, but can I ask maybe for a one-liner? You're all very far from being ancestor age, unlike me, but can I start with Sarah, then Arshad, then Hayat? Any one or two liners on what we should be doing to become one of these good ancestors? Sarah?
I guess from my perspective, it's very much how you allocate your capital, how you make your investments, how you set yourself up for the future. We all have investments, we're all investing for our future and for our children's futures. And I think we have to really remember that it's not just the financial returns that we're investing for, it's also in the planet that we are investing. And I think that there are wonderful opportunities to align your investments with your ethical and moral beliefs, and impact is a brilliant way to do that. And we now can do it in a listed equity context. I mean, we've seen a 12% increase annually in capital allocated to impact strategies and a 33% increase in equity strategies. So I would really urge everyone to think about how they're setting up themselves up financially for the future, and if they can align that with specific social and environmental targets as well, because I do think the two go hand in hand. Investing in an unmet need is unmet demand, and that should be returns enhancing. So being able to allocate capital towards those priority areas does not mean you have to sacrifice a return. It actually is a way to benefit society and the future.
Brilliant, Sarah. Thank you very much. Arshad?
George, perhaps as professionals, we need to behave more like human beings. What I mean by that, as a human being, what kind of a planet do you want to leave for your children? So why can't you adopt that thinking as a professional? And I think it's a matter of acknowledging our responsibilities as professionals, as human beings, and taking responsibility for doing what is necessary, and also being responsible for the authority and the power we have in our respective organizations to drive the right behavior.
Arshad, thank you. Now, Dr. Hayat, finally, to you.
Yes, it's about how we can create this platform, integrated platform, how we can create that type of facilitate the whole collaboration and partnership with all sectors of society, and how we can really provide a chance and give a chance to provide the right tools to community. Because I believe, and through all the experience with the bank and before that, and what we see in the bank, when you give people the right tool to build their own sustainable future, they do it with pride and honor, and because you are tapping into their full potential. So we need to really create that platform of engaging the whole sector of society as the 5 Ps I mentioned, and facilitate that, and also with innovative way of looking at finance. But the key thing also here, how to have a real and passionate and align with you partners, because without partnership, you cannot do that by yourself.
Dr. Hyatt, thank you very much. Thank you all. I'm afraid I'm going to have to come to an abrupt end because otherwise the organisers will turn me into an ancestor sooner than I'd anticipated, but it's been a really brilliant event. I've learned so much. I'm going to watch the video again. You've all been great. I will thank you personally by email, but thank you so much. Been great.
Thank you very much.
You.
So thank you
for having us.
Thank you.
Thank
Bye.
you all. And enjoy the rest of your day. So thank you all for watching. I'm sure you saw great insights from our terrific panel there, and I really am going to watch the tape when I get it from my colleagues this evening. Now we're going to turn to Islamic finance. I'm going to welcome my good friend Sultan Chowdhury, who's one of our members, the Chartered Institute for Securities and Investment. We are a 50,000 member body, and Sultan is one of our most distinguished members. He's the former chief executive at Al Rayyan Bank, which was formerly Islamic Bank of Britain and effectively the first, Western Europe's first authorized Islamic bank. He is, like me, a chartered accountant. None of us is perfect. And he previously worked at Barclays and Deloitte. Sultan is now executive chairman at WACfinity, which is an impact-focused Islamic finance ecosystem, and it's very interesting indeed. He's a member of various community and advisory groups and has contributed significantly to the development of Islamic finance in the UK. Sultan will introduce his panelists, but I just have to add a personal word of thanks to them. Stella Cox is one of the stars in our firmament. She's been hugely successful and influential in the development of Islamic finance in Britain and also in our own Islamic finance qualification since we launched it, 15 years ago. And John Glenn, Economic Secretary of the Treasury, has supported not just our qualification and the field, but also the development of our Green Finance Education Charter, which is supported by the main 12 UK financial professional bodies. John was at the inaugural meeting and has been unstinting in his support ever since. So thank you both from my heart. Now, running late a bit, but Sultan, salam alaikum, and over to you.
Assalamu alaikum, everyone. George, thank you for your kind introduction to our session on the Global Islamic Finance and the UN Sustainable Development Goal Task Force. I'd like to begin by briefly giving you an introduction to the work of the UK Islamic Finance Council. We're a specialist Islamic finance body established to promote the development of a global Islamic finance industry. We're headquartered in Glasgow. The UK IFC is led by an advisory board whose members are internationally recognized experts in their relevant Islamic finance sectors. We specialize in key advisory activities of Sharia governance, executive training, ethical finance, and government policy advisory. One of the key initiatives that the UK IFC initiated last year was the Global Islamic Finance and SDG Task Force. It's a unique collaboration between the public and private sectors, and it's spearheaded by the UK IFC, Her Majesty's Treasury, the Islamic Development Bank, and we're ably assisted by the Global Ethical Finance Initiative. As we heard today, we face a huge challenge in mobilizing the finance required to deliver and achieve the SDGs. With assets expected to reach $3.8 trillion in 2022, Islamic finance is one of the fastest growing sectors in the global financial industry, offering the potential to reduce the $2.5 trillion per annum financing gap, which is required to deliver the SDGs. Now, although the principles of Islamic finance, which are underpinned by the Maqasid al-Sharia, which is the purposes of the Islamic law, and they strongly overlap with the objectives and the aims of the Sustainable Development Goals, there has actually been limited engagement by the global Islamic finance sector towards the SDGs. The UK IFC therefore launched a global task force with the aim of increasing awareness, promoting understanding and encouraging adoption of the SDGs amongst Islamic financial institutions, but also facilitating the sharing of knowledge and experience amongst task force members. And we are also identifying the resources required to directly assist Islamic financial institutions to successfully engage with the SDGs. So what's our progress been to date since the summer of 2020 when we started this work? Well, we've held 2 task force meetings last year, bringing together almost 80 Islamic finance stakeholders from over 9 countries. The inaugural meeting was in July and was hosted by the UK's Economic Secretary to the Treasury, more from him later. And we also had an important address from the President of the Islamic Development Bank. The second meeting was held in November, and that was hosted by the State Bank of Pakistan. We've had numerous, over 20 separate meetings between the UK Islamic Finance Council and the members of the task force, and we've received excellent feedback on the practical focus and the senior level of global support and engagement shown at the task force. So what have we done? We've got 3 working groups. Firstly, the Education and Awareness Working Group, which has really ambitious plans to launch a global survey to analyze consumer understanding of Islamic finance and its link to the Sustainable Development Goals, something that hasn't been done before to our knowledge. Secondly, we've set up a Reporting and Disclosure Working Group, where based on the shared experiences of task force members with respect to the UN PRB, the Principles of Responsible Banking, the group is focused on developing a framework for the disclosures required by the UN Principles of Responsible Banking, tailored though for Islamic finance institutions. And we're trying to produce a toolkit of practical guidance and templates to encourage engagement with those principles. And thirdly, a highly significant working group focused on Pakistan. The working group, with the commitment and support of the State Bank of Pakistan, is engaged in promoting the adoption of the UN Principles of Responsible Banking amongst Pakistani banks through sharing international experiences and developing technical tools and targets to assist in the banking sector there, furthering the SDG agenda. And finally, that working group will be preparing a country-level state of play report, which we look forward to seeing. I'm pleased to announce that today, the UK IFC is launching a report in partnership with the International Sharia Research Academy for Islamic Finance and the Global Ethical Finance Initiative, providing quantitative and qualitative analysis on responsible banking in the Islamic finance sector. And here's some of the headline findings from that report. So only 8 of 57 OIC, that's the Organization of Islamic Cooperation countries, only 8 of 57 states contain organizations which are PRB signatories. And despite that, despite OIC member countries collectively having 24% of the world's population, only 10% of the PRB signatories are based in the OIC countries. 38 PRB signatories offer Islamic finance, and that equates to just over 17% of the PRB signatories. The bottom line is engagement is lacking at the moment. So for more information on that report, which has been issued today, you can get that on the Ethical Finance Exchange website, efx.global. It now gives me great pleasure to hand over to the UK Economic Secretary to the Treasury, the Right Honourable John Glenn MP, for a pre-recorded address.
Hello everyone, and thank you to the UK Islamic Council and to the Global Ethical Finance Initiative for the opportunity to speak to you today. I'm only very sorry that I can't be with you live to participate in your discussion. But let me start by saying something uncontroversial. It's been a year of extraordinary challenges. The government's priority throughout has been to protect people's jobs and livelihoods, while also supporting businesses and public services in the United Kingdom. The financial services sector has been key to that. just as it has been key to the economic recovery. And that's why, as a government, we continue to be so outspoken in support for the industry. We have a clear and forward-looking vision of a sector that is global, open and competitive, which is pioneering in its use of financial technology, and which is unapologetically innovative in the way it deploys finance to tackle climate change and accelerate the shift to a net zero future. Greening the financial system is a crucial step in bringing us closer to that future. The UK has sought to lead the charge, starting back in 2019 with our Green Finance Strategy. Since then, we've driven home the importance of finance to the transition by making it a key pillar of the Prime Minister's 10-point plan for a green industrial revolution. But importantly, this is not just about managing risk. I'd go so far as to say that the transition to net zero presents the investing opportunity of a lifetime. And we want the UK to seize that opportunity by being a leading centre for green finance. And at the end of last year, the Chancellor outlined some of the ways we can do just that. For instance, the UK is the first major economy to commit to making disclosures aligned with the Task Force on Climate-related Financial Disclosures, and making those fully mandatory by 2025. The UK will also implement a green taxonomy to create a shared understanding of which economic activities are green. And we've also set out plans for the UK's inaugural sovereign green bond to be issued in the summer, and are planning a green retail savings bond, which will give UK savers the opportunity to take part in the collective effort to tackle climate change. And finally, climate change considerations have now been added to the remit of all of the UK's financial regulators. But tackling climate change is something no country can do on its own, which is why we'll be working hard to inject our thinking on green finance into this year's COP26 and G7 summit. A once-in-a-generation opportunity to put sustainable finance at the heart of the international agenda. So that's a flavour of what we've been doing on green finance. But it runs in parallel with work we're doing to build on the UK's strengths in the wider sustainable and responsible investment space. The reality is that the pandemic has revealed and in some cases deepened social inequalities. The costs of rebuilding economies and communities, building back better, will be considerable. And there is an important role for private capital to invest alongside the public sector. Investors are increasingly looking to strengthen their ESG offering, and many are taking this further by engaging in impact investing. In 2020, net retail flows into responsible investing trebled. As a government, we want to enhance expertise in this area and to provide leadership on the way ahead. The UK is already a world leader in stewardship standards. And in November, the Asset Management Task Force, a forum that I chair, published a report recommending how the UK government, regulators and industry can improve stewardship and consideration of ESG factors across the UK's investment sector. A third piece in the puzzle is Islamic finance. And if we're to achieve our ambition of the UK being the most open and dynamic financial centre in the world, then Islamic finance has a big part to play. Leaving the EU has given us opportunities to form closer trading relationships with nations for whom having Sharia-compliant finance products will be very attractive. Expanding our Islamic finance sector also provides alternatives to the UK's Muslim population looking to access financial products in line with our commitments on financial inclusion. The issuance of our second sovereign sukuk at the end of March tells you everything you need to know. At £500 million, it was more than double the size of the first issuance in 2014 and signals, I believe, the UK's position as the leading global hub for Islamic finance outside of the Muslim world. I'm personally delighted to be involved with the Islamic Finance Sustainable Development Goals Task Force, which involves close to 80 senior practitioners from Islamic finance across Africa, the Middle East, South Asia, and Southeast Asia. And it was a pleasure to join the Islamic Development Bank President, His Excellency Dr. Bandar Hajar, at the inaugural meeting in July. And I look forward to joining the task force again later this year at COP26. So, ladies and gentlemen, it is a fascinating time for what we all know is a crucial industry. And the growth of sustainable and ethical finance is something for us all to be excited about. The government and I are determined to do what we can to help the sector go from strength to strength. Working together, I'm confident that that's exactly what we'll do. So thank you very much and good luck with your discussions.
On behalf of the UK IFC and Ethical Finance 2021, I would very much like to thank John Glenn, Economic Secretary for the Treasury, for his ongoing commitment to the Islamic finance industry in the UK as a whole, and specifically his ongoing support for Global Islamic Finance SDG Task Force. I very much look forward to seeing him at the task force meeting at COP26 in Glasgow in November. I'm now really pleased to invite someone who is one of the early pioneers and advocates of the Islamic finance industry, both in the UK and internationally, stretching back over 30 years. Stella Cox, CBE, Managing Director of DD-CAP Group, to talk about the task force initiative. Stella and the DD-CAP Group are a founding task force member and have been long-term supporters of the UK Islamic Finance Council and the Global Ethical Finance Initiative. Welcome, Stella. We're really looking forward to hearing from you about your experiences with the task force. Let's start with why DD-CAP and yourself became involved with the task force.
Well, thank you, Sultan. Thank you for your kind introduction. It's such a pleasure and a privilege to be here today. DD-CAP has indeed been an early and a strong supporter of the UK IFC SDG Task Force. Since our founding back in 1998, we've become known as a provider of asset facilitation services across a diverse range of Sharia-compliant products and instruments. And we've also initiated development of automated financial system solutions to support the offerings. Now, at DD-CAP, we've always aimed to be a first mover in our space and to lead by example. And we're committed to developing a more sustainable, equitable and prosperous world by connecting the Islamic financial marketplace responsibly. So we very much support the view that those in business must adopt strategies that go beyond delivering financial results to achieving positive social and environmental outcomes. So having made our own commitment to Sharia standards with the establishment of our Sharia Supervisory Board in 2013, for us it felt that the natural next steps were to work towards best practice standards for sustainability and responsibility. So we took a gradual path to adopting that. We progressed gradually through looking at internal policy and procedures and shaping our business so that it supported our own corporate aspirations. And interestingly, we also have appointed an SRA champion, Sustainable and Responsible Actions champion, Dr. Mohammed Akram Laldin, who sits within our own Sharia Supervisory Board. So the development of our SRA policy has been shaped externally as well. It's not just been a matter of the internal work. We've linked into multinational initiatives to promote responsibility and sustainability and the increased awareness of ESG concerns, including the UN SDGs, which we align specifically. So through the task force agenda and its outreach, we're actually finding opportunity to build upon our own policies and extend our existing engagement with various multinational networks and frameworks. And I'll give you an example. DidiCap became a service provider signatory to the UN endorsed Principles for Responsible Investment in 2016. And at that time, it's 5 years ago, but we were proud to be the first Islamic financial sector service provider to be awarded signatory status. And at that point, we were amongst just 3 signatories from the Islamic financial industry. More recently, we've become stakeholder endorser of the UN Principles for Responsible Banking. So we've made a commitment to promote the PRB within our networks and support its implementation and encourage the banks within our sector to become signatories. So Sharia compliant financial practice has this really long history of alignment with financing for social impact. And as we lead up to COP26 in 2021, there's been a real conscious effort to embrace this opportunity to bring focus to the environment with firms, including my own, looking at ways that we can improve our impact and improve our footprint individually, assist our stakeholders, but also collaborate with like-minded organisations to do the same. And as the task force has developed, it's provided such an important forum for our industry discussion and debate. But it's also been inclusive in as much as it has its observers and supporters that extend beyond our core industry as well. So that's enabling us to connect and share experiences and best practices with a view to developing a more consistent approach among Islamic financial institutions to disclosure and reporting. And Sultan, you spoke just now about the 2 working groups within the task force. Our engagement with the disclosure and reporting working groups presenting us with a great opportunity to further our commitment to the PRB, again, particularly in this lead up to COP26. So we feel that our sector's alignment along that of its banks and institutions with the PRB, or indeed the PRI as may be appropriate, is a key first step to committing to the continued development of Islamic finance as a more sustainable sector.
Stella, you're clearly very involved in the task force, and DidiCap are contributing greatly. How do you see that the task force initiative is different, maybe from other projects?
Well, I think where there's been an engagement by the Islamic financial industry and its participants with the SDGs until now, it's tended to be more on the S or the social of ESG, with less emphasis typically on environmental considerations or on initiatives like UN endorsed PRI or the PRB, which are clearly supporting governance. So the SDG task force has been positioned to help address this disconnect, which you mentioned just now, and promote engagement with and adoption of the UN SDGs by Islamic financial institutions globally. It's been encouraging actually to see how many Islamic financial industry stakeholders and influencers, including our own infrastructure and standard setting bodies and best practice organisations, and I'm talking about SIBAFI, for example, and AOFI, have embraced its formation from concept through launch and into mobilisation. Further support, of course, has been extended by the Islamic Development Bank, and I think the bank in itself has really pushed the envelope in recent years in terms of its own commitment to funding and investment for impact and sustainability. And since the launch of the UK task force or the UK chapter, I might describe it, in 2020, it's been very evident how the industry support has increasingly mobilised across our footprint, and it now involves representation by governments and figureheads within public and private sector organisations from Islamic finance's key territories within South and Southeast Asia, the Middle East and Africa. So in support of developing and accelerating a more rounded contribution by the industry, the work of the SDG Global Task Force, or the working groups in education and awareness and reporting and disclosure, really distinguishes it because it's so vital in promoting the E and the G, particularly again as we come up towards COP26. So we've also been very strong supporters of the working groups and their goals, because through those working groups we can help to create the pathways for greater practical engagement by our industry IFIs and also understand actual and potential consumer demand. So that's a real practical element, because through the work of the groups, it's going to help us educate consumers and clients so that we in turn can highlight to institutions where the demand for SDG-linked financing is. And that in turn, we hope, is going to really prompt the opportunity to develop more SDG-focused instruments and financial solutions across our banks and financial institutions.
And so you challenges in your answer, Justin, around extending the S to the E and the G. Do you see that there are other challenges for Islamic financial institutions in this space, and what are the opportunities, more importantly, that they could take advantage of?
Yeah, it's a great question. The key tenets underlying Islamic finance, which differentiate it from conventional practices, provide us with a very natural alignment to the SDGs and their targets, or should do. For example, humans being the stewards of the planet. But as I think you mentioned, research has shown that there's actually limited engagement by the global sector with the SDGs, as well as more broadly with sustainable finance. So even if you take example, if you look at the Islamic capital market and our nascent green sukuk market, the proportion of green standard issuance is still really a long way below that of the conventional market. And whilst there's growing demand for an offering of retail and SME banking SDG-linked products, the same offering is not always made available in our Sharia-compliant space or through Sharia-compliant structures. The UK Islamic Finance Council has put its assessment on our industry financial assets pushing up towards $4 trillion next year. And Islamic finance has begun to demonstrate innovations and financial engineering to support the creation of those new instruments and solutions that will attract and deploy capital to deliver against the SDG objectives. We have the capacity to mobilise funds to address the $5 to $7 trillion annual funding gap to meet the 2030 target. But through the efforts of the task force, as we move through this year, we have to focus on the interconnectivity of the 17 SDGs, and particularly how climate change, with COP26 on the horizon, is going to impact our progress to meet these goals and has to be addressed. I took on board your points about Maqasid al-Sharia being the objectives and purpose behind our compliance and how we put that into practice. And SDG alignment supports the tayyib or wholesome concept, and that in turn supports the focus of Islamic financial products and services being for broader societal impact. But recognising the enormity of committing to an undertaking that would be tasked to rise to this challenge, whilst at the same time accommodating the many different perspectives and priorities of, and I don't describe us as niche, but a specialist industry sector with an extending global footprint to deliver practical outcomes. Look, at times it's been disconcerting. But at the same time, we can see now that our industry leaders and influencers have been very diligently exploring for some years the nexus between Islamic financial market disciplines and practices and those of other responsible and sustainable financial market subsets. And the purpose of that exploration is to make sure that we can contribute fully and effectively to the global agenda and to action. So the outcome of the debate and discussion has resulted in various Islamic financial sector initiatives, but amongst them, it's translated into the formation of the SDG task force. Already, I think from that, the UK chapter has been effective in demonstrating thought leadership and also pioneering proactivity through its approach to championing consistency through global best practice and standards alignments, which is really very important if we are to bolster our industry sector's approach to sustainable and responsible financial practices that are going to serve to deliver against the requirements of the SDGs. I'd say in conclusion to this that Islamic finance really does have its own unique identity. I truly believe that. It still does. It has an ethos that results from being a faith-based subset of responsible finance and investment. But the call to action for firms to contribute to wider positive impact is one that, in my opinion, we can't afford to ignore.
Thanks, Stella. And That's fascinating, because it sounds like there's a clear prerogative for the Islamic finance industry to get involved, but there's also a clear opportunity, to benefit as well as an industry, as well as benefiting the society as a whole. So, I think the task force is pioneering and blazing the way with making that opportunity clear to the industry as a whole. So that's fantastic. And finally, our chance to promote UK PLC. I know this is a question that you've probably been asked more than anybody else in the world, I suspect. Can you summarize how the UK has become the Western hub for Islamic finance?
Yes, I'd love to. It's been such a long while now. We've worked together for a long time too, Sultan, that it becomes difficult to summarise it. But if I'll try and do that, I'd say that one reason that the UK has achieved such prominence in Islamic finance is because of supportive government policy. And I'm not just saying that because we've just heard from the EST, but I think to a great degree, the UK government sought to create a level playing field for Islamic and conventional financiers through its endeavours to ensure that nothing in terms of financial legislation and regulation actually prohibits the availability of financial products and offerings. Now, it hasn't always been a smooth path, and we know that the UK has had a proactive role to play in supporting the development of contemporary Islamic finance since the mid-1970s. But actually, if we trace government initiatives back to 2001, when motivated actually by an agenda of financial inclusion, the Bank of England convened a working party to investigate the barriers to development of Islamic financial services in the UK, and then embarked on this process of legislative reform to make sure that Sharia compliant products and services weren't impaired. And that sort of led to the authorisation of the first Sharia compliant bank in the UK, which happened in 2004. But in terms of us as practitioners, London's always been very important for developing Islamic financial services. I started my career in Islamic finance right back in the 1980s, and I was working at an investment bank structuring short-term trade and commodity investments for Islamic banks here, utilising our market infrastructure and particularly the London Metal Exchange environment. And we know that since then, the London Stock Exchange has become an important platform for Sharia compliant capital market instruments. So also our related professional services available from the UK's legal and advisory firms have complemented not just product and business origination, but it's also extended our global outreach. And we've contributed, and George is here this morning, through the Chartered Institute for Securities and Investment. We have this Islamic finance qualification, which is statistically supported as the most successful professional qualification in Islamic finance that's been launched to date. So over the past 20 years, the UK government continued to develop policy and shape strategy that's been generally supportive of Islamic finance. And we've had our high points. We had the inaugural sovereign sukuk that was issued in 2014. And since then, as recently as this year, Her Majesty's Treasury has come back to the market again with its second sukuk, doubling in issuance size, which is always very positive. But it's this collaborative approach by public and private sector. And a couple of years ago, private sector established the UK Islamic FinTech panel in response to the momentum that was being created here within the entrepreneurial approach to creating Sharia compliant FinTech. And it's very interesting because actually London's status as a global international financial centre, combined with the UK's prominence in FinTech, has helped us position as a leading Islamic FinTech hub. So what is very important right now is to see that with the coexistence of so much Islamic financial sector capacity and capability, it's created a lot of significant additional benefits for the UK itself. It's made the UK a very attractive destination for Sharia compliant investment, and particularly we know the inflows that historically have come from the GCC and Southeast Asia. But during the past year, despite the pandemic, we've seen quite an acceleration of foreign direct investment, and that's been accompanied by an elevating interest by major asset and wealth management firms that offer Sharia compliant investment services and products that embody sustainable, responsible and ESG considerations. So these investment flows, which have historically been deployed towards real estate and infrastructure, are also being targeted towards eligible securities, including equities and ETFs that have sustainable approaches attached to them. But it's also serving to support the development of our UK halal economy. And I have to say that we have some really exciting Sharia compliant firms here in media, in fashion, leisure, food, pharmaceuticals. And we rank pretty impressively amongst our global counterparts. But in terms, just to wrap up again on this point, I think I would just like to highlight as I finish, because I'm from the financial sector, that the Islamic or Sharia compliant digital banking and financial solutions from established institutions, but also these new disruptors that we've been talking about, have such potential to increase financial inclusion, working from the UK, but across the OIC, encompassing all sorts of different opportunities to embody SMEs, medium-sized enterprises, businesses that are being developed by women and for women, and a lot of the work that is happening from these firms here is actually going to serve to meet the objectives and the targets of many of the SDGs. So I think I'll wrap up on that point. So I could talk about the UK for a long time.
I was going to say, Stella, you could talk for hours on it, and that's why you're the best person to answer that question. And at UK IFC, the Islamic Finance Council, we've witnessed this over the decades, and very much appreciate your contribution to that growth in Islamic finance in the UK and beyond. So many thanks, Stella. We're kind of out of time now, and it's been a really enlightening discussion. You've clearly got passion and commitment still for our wonderful industry. And of course, my gratitude on behalf of the UK Islamic Finance Council to the Economic Secretary to the Treasury, John Glenn, for his pre-record, and of course the Global Finance Initiative for putting on such a wonderful conference. So thank you very much, everybody, and from the task force, Assalamu alaikum.
Goodness, thank you both very much, Shukran, Sultan and Stella. Stella, you never miss a beat in terms of promoting our Islamic finance qualification. It's so kind of you, and Sultan, you two have been such a huge help over the years, and the Minister too, we're very grateful indeed. Now we're about to have a short break until 12:10 when we have the Governor of the State Bank of Pakistan joining us, but that does bring us to the end at the moment of our first session today on financing the Sustainable Development Goals. I don't know about you, but these 2 hours seem to have flown past, and there's been so much to reflect on from our quite incredible range of speakers, and individually and from our panel half an hour ago. And I'm sorry I had to cut them a bit short. Of course, if there's anything you'd like to share with the rest of the audience or reflect on after hearing our speakers and panelists, remember to join the conversation by Twitter by following @Finance4Change, finance numeral 4 change, and using the hashtag ethicalfinance2021. I've had a few questions, in fact more than a few, half a dozen or more in the past half hour about a book I mentioned in the session I chaired, which is Good Ancestors. Now, I can actively promote this book. It's truly excellent. I don't know the author. I've spoken to him, but he's not a friend. He's not an enemy either, but it's a really superb book. The Good Ancestor, perhaps the best praise I can give you for it is on the top of the back page when Professor Martin Rees, the Astronomer Royal, who is universally acknowledged to be the most intelligent person ever to have walked the face of the universe, Professor Rees says it deserves to be, Lord Rees says it deserves to be widely read by policymakers and indeed by all citizens who care about the prospects for their children and grandchildren. I'm now an age that I want to be that good ancestor to look after my grandchildren properly and leave them with a planet that's worth living on. We're going to take a short break, back at 12:10 with the Governor of the State Bank of Pakistan. Please do join us, and thank you for watching this morning.
Today we live in a new world. A world where making the right choices has never been more important. Important for our families, our communities, and our planet. we need to make the right choices to help us build, grow and thrive. Choices that allow us to invest in everybody's future. And today, finance isn't just about where you save or allocate your money. It's about commitment and continuity. It's about people and places, enterprise and ethics. Thinking beyond GDP and profit towards happiness, inclusiveness and well-being. It's about finance with purpose. The Global Ethical Finance Initiative believes in using finance for positive change, enabling transparency and choice that facilitates a more sustainable, responsible and stable financial system. A system that is both innovative and fair, that benefits the local and global community. We believe in the values of our environment and the worth of an individual's well-being, in enterprise that is ethical, in growing portfolios but not at any cost. We believe in profit with purpose and finance for positive change, and strive for system solutions to global problems. Founded in the historic city of Edinburgh, we draw inspiration from the Scottish Enlightenment figures who position Scotland as a leading centre of entrepreneurial spirit. Today, Scotland is home to accelerating startups and respected financial institutions. It is very much alive with innovators and creative thinkers, generating fresh ideas and new perspectives. At the Global Ethical Finance Initiative, we look outwardly to our partners from around the world, amplifying, collaborating and inspiring, enabling us to harness this combined knowledge for the benefit of our network. And how do we do this? Through our key pillars of advocacy and building ecosystems, which together encourages and facilitates the cross-pollination of ideas that helps grow and develop both individuals and institutions. The advocacy of ethical finance is achieved by bringing people together, achieved via a series of world-leading events, both virtually and in person. Every year, our Ethical Finance Summit is attended by the world's foremost financial, political and faith leaders. These experts dive into themes such as responsible investing, sustainable banking, inclusive growth, and rethinking capitalism, all aimed at ensuring that positive change is at the heart of our financial system. Change that supports targets such as the Paris Agreement and the UN Sustainable Development Goals. Our award-winning discussion series, the Edinburgh Ethical Finance Roundtable, established in 2010, attracts stakeholders and thinkers from all walks of life, including asset managers, asset owners, banks, regulators, charities, universities, governments and faith groups. People from across our network uniting to share perspectives committed to the development of a better world. We build ecosystems that encourage collaboration. Our pioneering work with the United Nations Development Programme helps drive private capital towards SDGs. And our 2-year programme is a journey focused on investment analysis and identifying market opportunities. The Edinburgh Declaration, the world's first interfaith collaboration on ethical finance, is a shared values framework that shines a light on common purposes and values, and can inform financial professionals and institutions on creating a values-based culture. And our Ethical Finance Hub campaigns for the positive influence that ethical finance can bring to Scotland through market campaigns and capacity building. At the Global Ethical Finance Initiative, we have an experienced team with an in-depth knowledge of finance, law, research, advisory, marketing and public relations, and event curation. Our journey has begun, and momentum is gathering. The case for ethical finance is beyond doubt, and with the help of our global network, we have developed award-winning initiatives, hosted world-class summits that have influenced policymakers and helped map the ethical finance landscape. We provide governments with research and advise banks and asset managers on how to invest responsibly and in line with the UN Sustainable Development Goals. We are a founding stakeholder endorser of UN principles for responsible banking, and we help provide a platform for ethical finance that delivers profits with purpose. Our global community is growing, and we want you to be a part of it. Join us and make a difference.
Hello, I'm George Littlejohn, your host for Day 3 of Ethical Finance 2021, and what a great day it is. Some really tremendous speakers and more to come. We've had more than 90 speakers over the 3 days and panelists, and now some 3,800 delegates from 90 countries. This really is a great global event. We've brought together, the Jeffy team has brought together global leaders and global insights into some of our greatest ethical, environmental and financial challenges. And we've got a great global community of finance professionals committed to learning more about and embedding ethical and sustainable finance, not just into their organizations, but also in their own individual professional practices and across finance as a whole. A great group achieving great things between us all. So wherever in the world you're joining from, whether you're joining us for the first time or attending one of the earlier sessions, you are, of course, very welcome indeed. And the earlier sessions will, of course, appear shortly on our global EFX platform, so you won't be missing anything if you missed earlier ones. Now, this is the second of our 3 sessions today that we're going into in the subject of beyond climate. And this time we're looking at the importance of the S, the social, in ESG. Our session will last for about 2 hours, beginning with a presentation from the Governor of the State Bank of Pakistan. We then have a fantastic expert panel chaired by Tom Kendrick, Head of Social Banking at NatWest Group. And we finish with our second initiative spotlight, this time looking at tobacco-free portfolios. You'll have your chance to put your questions to Tom and his panel during our session. Just use the Q&A function on the screen. If you're joining us by mobile or you can't see the Q&A box for another reason, please just email your question to events@globalethicalfinance.org, events@globalethicalfinance.org, with the subject line EF 2021 questions. And wherever you are, remember you can join in our conversation, and please do join via Twitter by following at Finance4Change, finance numeral 4 change, and using the hashtag Ethical Finance 2021. Now, we're going to finish promptly at 14:08 BST, British Summer Time, and we'll then have a short break. We're very good at short breaks in this program, before reconvening at 14:25 BST for our sparkling final session of the summit on strategic business and sustainability leadership. Now, on the leadership front, I'm delighted and honoured now to welcome Dr. Reza Bakir, Governor of the State Bank of Pakistan. Dr. Reza Bakir was appointed as the Governor of the bank, the State Bank of Pakistan, by the President on 4th of May 2019. Before his appointment, Dr. Bakir had 18 years of experience with the IMF, and we heard 2 senior people from there first thing this morning, and 2 years of experience with the World Bank. He was the head of the IMF's office in Egypt and senior resident representative since August 2017. He's also held positions as IMF's mission chief for Romania and Bulgaria, division chief of the IMF's debt policy division, overseeing IMF's vital work on debt relief and sovereign debt restructuring, head of the IMF delegation to the Paris Club, very appropriate for this, deputy division chief of the IMF's emerging markets division, overseeing IMF's loans and policies in emerging markets, and IMF resident representative to the Philippines, and numerous other positions. Dr. Bakir, it's a great honour to welcome you. Thank you for joining us.
Thank you, George, for the introduction. Let me begin by thanking the organizers of the Global Ethical Finance Initiative for inviting me to share my thoughts with today's global audience. Before I begin my talk, I must also acknowledge the enlightening and very informative discussions by the preceding speakers on financing the Sustainable Development Goals. I hope many of you take away from these discussions an enriching and innovative set of ideas and are also able to turn them into action. Now, the overarching theme of this summit stresses some of the key developments that are taking place at a global level and reshaping the financial services industry and its role in the economy. As we are all aware, as an aftermath of the global financial crisis, it has been recognized that the financial system must not only be sound and stable, but also based on ethical, sustainable, and responsible principles. The general understanding is also steadily evolving. The central banks should support sustainable finance as part of their efforts to advance the sustainability agenda and to integrate such considerations into their policy framework. It is encouraging to note that the central banks globally are increasingly embedding ESG objectives into their mandate and mainstream activities. For my remarks, I was asked to speak about the S in ESG and why it matters. As a central banker, I will therefore talk about the social considerations for a central bank, particularly, and will illustrate how the State Bank of Pakistan, Pakistan Central Bank, is contributing towards a better society through incorporating social dimensions in its mandate. To this effect, I will first speak in general about how global thinking amongst policymakers is evolving about the appropriate role and mandate for central banks and the extent to which central banks should pay attention to social dimensions. And second, I will illustrate from the experience in Pakistan how Pakistan's central bank, the State Bank of Pakistan, has endeavored to give special attention to the social aspect in its policies and especially during the response to COVID. So let me begin by talking a little bit about how the thinking about central banks' role and mandate is evolving, particularly in the context of social issues. Traditionally, I'm talking about, say, 20 years ago, the view of central banking was that it should remain confined to the core areas of price and financial stability, and that it should remain confined to using these traditional instruments such as interest rates, exchange rates, and the regulatory and supervisory framework to achieve these goals. The global financial crisis that started after the collapse of Lehman Brothers in 2007 started a wave of a widening of the toolkit of central banks. And as some of you may recall, it was the first truly global occasion when central banks, and especially advanced economy central banks, widened their arsenal of tools and especially used quantitative easing to try to give an effective response to the global financial crisis. So that was a widening already in the tools that central banks use. But concurrent with the developments since that crisis was the debate that emerged, particularly in the Western economies, about the need to pay attention to inequality, and a debate about whether the growing economic pie, whether the benefits of the growing economic pie were being shared with some sense of proportionality across the different income quintiles. Now, while these developments were already going on about the widening of the toolkit of central banks, the growing awareness amongst policymakers of the need to pay attention to income inequality, on top of all these developments, we were struck by COVID. And the response then that central banks had to give to COVID accentuated this debate. Not only did central banks use more of the quantitative targeting and quantitative tools in general that were available to them, but central banks also had to think about the social issues in designing the policy response to the economic catastrophe caused by COVID. As has been well documented, the COVID pandemic accentuated inequalities, whether in the health or economic dimensions, across countries and also within countries. It has at the same time become incumbent upon policymakers, whether fiscal, monetary, or other policymakers, to give due attention to these social factors. I expect this trend to continue and for the debate amongst policy circles to continue to enrich itself to define the appropriate role for central banks in these areas. I think one thing has become clear, that central banks cannot afford to ignore the social dimension of the policies that are undertaken. Now, this was the first few thoughts that I wanted to share about how the global thinking about the role and mandate of central banks in the S in ESG is evolving. I want to now make this a bit concrete and talk a little bit about how the State Bank of Pakistan has endeavored to reflect social considerations in its actions. Now, our thinking at the State Bank starts with the recognition that the financial sector can serve as a conduit towards equitable access to opportunities. An inclusive financial system can therefore help derive immense social value in a society and lead to improved parity across different strata. Therefore, as a part of the strategic objectives of the State Bank of Pakistan, we have the strategic objective to promote inclusive economic growth in the country. And to this end, the State Bank of Pakistan adopted a 5-year comprehensive National Financial Inclusion Strategy 2023. Under this strategy, we prioritized areas such as branchless banking. Branchless banking is where we promulgated regulations and gave a framework where branchless banking agents can bring banking to those areas where it was not accessible before. Similarly, in the National Financial Inclusion Strategy 2023, we had other important initiatives such as digital payment systems and allocating targets to enhance financing to agriculture, SME, small and medium enterprises, and low-cost housing finance, while also promoting Islamic finance and reducing the gender gap in financial inclusion. Amongst all of these areas that are in the strategic objectives of the State Bank of Pakistan, let me emphasize one area that I believe has particular relevance from a social dimension. And this is the area about helping people, particularly those who are not well off, to realize their dream of owning a house. In Pakistan, over successive years, over successive decades, market failures and other factors have led to a lack of inclusive housing development. And today, we are faced with a gap that is estimated of more than 10 million housing units. Addressing this gap and facilitating financing through mortgages has the promise not only to help people realize their dream of owning a house, but also has tremendous spillover economic benefits by promoting employment in the housing and construction sector, which draws large employment, particularly in the informal sector. To this effect, and as part of the government's vision to promote housing, the State Bank of Pakistan launched a comprehensive dialogue with banks and other stakeholders to address the market failures in this area. Amongst other areas, the State Bank has also allocated mandatory targets to banks to extend mortgage finance and to extend financing to developers and builders. Banks have been required to increase their housing and construction loan portfolios to at least 5% of their private sector advances by December 2021. I'm glad to share that after this intervention, banks' housing and construction portfolios increased by 37% over the last 9 months and have reached $1.3 billion. Before this intervention, total housing and construction finance had remained stagnant for decades in Pakistan. The State Bank of Pakistan, in coordination with the government, is also implementing a plan whereby the government provides a subsidy in the cost of borrowing for low-cost housing. Under this facility, subsidized financing for the construction of houses or purchase of already built houses is being provided to individuals who currently don't own a house. This is an area that is happening for the first time in Pakistan. And because it's a new area, at the beginning, the emphasis that we have placed working in partnership with banks is to put in place a framework as well as targets that will allow the financial sector to play its part in helping people realize their dream of owning and living in their own house. We remain very committed to this goal, and over the coming months look forward to making it possible for those who are not well off in Pakistan to own their own house. In addition to housing, the State Bank has also direct programs to promote access of finance to other sectors which have been left out due to market failures. And in particular, I want to point out 3 areas where we have ongoing interventions: SMEs, agriculture, and access to finance for women. I will not have space today to go into each of these areas, but I do encourage the viewers and the participants to today's event to look at the website of the State Bank of Pakistan. Just type it in Google and you can find it, and to get information about our various financial inclusion initiatives in these areas. Now, I want to transition from talking about in general the programs that the State Bank of Pakistan has to give attention to the S in ESG through financial inclusion, to talk specifically about how the State Bank of Pakistan endeavored to prioritize social considerations in its response to the COVID crisis. Now, when the COVID crisis struck in February, March of last year, like other central banks, the State Bank of Pakistan also reduced its policy interest rate from 13.25 to 7%. It was one of the largest cuts across emerging markets. Like other central banks, we also used quantitative measures to try to stimulate investment. These effects have begun to show a turnaround in the economy, and the revised growth for this year in Pakistan is projected to be about 4%. But today, I would like to talk about the social dimension of 3 particular interventions that the central bank made during the COVID crisis. The first was a program for a voluntary deferment of the principal and interest payments on loans and their restructuring. When the COVID crisis struck, it was first and foremost a crisis of liquidity, whereby we thought that for a temporary basis, some people might be unemployed and some businesses might not get their regular volume of sales. To try to ensure that liquidity problems don't lead to solvency problems, whether at an individual level or at a business level, the State Bank of Pakistan worked with the Pakistan Banks Association to implement a voluntary program to defer repayment of principal amounts on loans by up to 1 year, and to encourage the rescheduling and restructuring of the interest component of the loans where the borrower was interested. These programs were voluntary in the sense that a borrower had to apply for it and the decision rested with the bank. But as a regulator, we used our moral suasion, as well as we collected weekly data to ensure that the presumption would be to extend the loans unless there were good reasons not to do so. In any crisis, banks typically become very risk averse, and as a regulator, we were concerned that if they remain highly risk averse and become more risk averse, then even solvent clients may not get this deferment and may become insolvent due to their liquidity problems. I'm glad to say that through this scheme, banks approved about $5.8 billion worth of deferment and rescheduling for 1.8 million borrowers. But here is the crux of the social dimension of this intervention, which is that 95% of the borrowers availing this deferment and loan restructuring facility were individuals and borrowers from microfinance banks. Microfinance banks typically cater to those who are not as well off in society. And so 95% of the beneficiaries of this intervention supported those who were not as well off and in the lower strata of the society. And this, we believe, helped many individuals avoiding bankruptcy by providing them with liquidity if temporarily they had lost a job due to the COVID crisis. So that was example number one, where the central bank prioritized the social dimension in its intervention during COVID. Example number two is a program called a payroll financing scheme. In Urdu, the word is rozgar, which means employment, whereby the state bank explicitly targeted the goal of preventing layoffs. It's one thing in general for a central bank to pump liquidity where the benefits might accrue to the owners of businesses who may, in the end, nevertheless still go ahead and do layoffs. But we designed a program where any business could get a concessional working capital loan from a bank, a loan that was underwritten by the central bank and where the liquidity was provided by the central bank. However, the key condition to get this concessional working capital was that the borrower had to commit that it would not lay off any worker for 6 months. I'm happy to share with you today that due to this intervention, more than 1.8 million jobs of about 3,300 businesses were saved, and a total amount of $1.4 billion was disbursed to pay salaries for such employees, and this was underwritten by the State Bank of Pakistan. And here again is the crux on the social dimension of this intervention, that not only was this a direct intervention targeted to prevent layoffs, but more than 70% of the borrowers availing this $1.4 billion of working capital were SMEs, that is small and medium enterprises. The third example that I wish to share about the State Bank's intervention during COVID that had a social dimension was a direct concessional loan facility for the health sector to support its ability to fight the COVID pandemic and in general to support the provision of good health care in Pakistan. State Bank introduced a refinance facility, that is an on-lending facility, whereby hospitals and other health facilities could use concessional finance to purchase COVID fighting equipment such as ventilators, hospital beds, testing kits, protective gowns, masks, and other such equipment for combating the COVID pandemic and for hospitals to enhance their ability to provide medical care to the people of Pakistan. Under this scheme, about $80 million have been approved for strengthening the provision of health services in Pakistan, particularly to fight COVID. So these were three examples I wanted to bring to your attention about how the State Bank of Pakistan tried to give priority to the S in ESG. And to summarize, the 3 points that I wish to convey in my remarks were: number one, that the thinking about the role of central banks of the social dimension in policy making is evolving, and I believe evolving in the right direction. There is no choice but for policymakers, including central banks, to pay increasing attention to these issues. Number two, to share with you that the State Bank has been espousing these goals through its strategic plan and through several of its ongoing initiatives, including the initiatives to promote housing and access to finance for SMEs, agriculture, and women. And finally, I had wanted to illustrate through some specific examples about how the State Bank of Pakistan tried to keep the social dimension at the forefront in its interventions and support measures during the COVID pandemic. In the end, I would very much like to thank all of you for being here today, for your valuable time. I'm sure the Ethical Finance Summit 2021 will present us with lots of new ideas and thoughts to overcome the current challenges that we face and to make new leaps of growth towards a sustainable future. Thank you.
Thank you, Dr. Bakir. I've been fortunate enough to spend some time over the past decade working with opposite numbers in Pakistan and involving the state bank, and it doesn't surprise me one little bit that the bank is plainly showing clear leadership in this as in many other fields. Very impressive. Thank you for joining us today. Now to some of the crunch issues nearer home with the S Factor. Tom Kenrick is Head of Social Strategy and Impact at NatWest Group. Part of the sustainable banking function, Tom's team lead and coordinate the bank's approach to social issues and to the SDGs. Their focus areas include financial capability, human rights, modern slavery, vulnerable customers, and controversial sectors. The team also leads and delivers the bank's flagship MoneySense financial education program. Tom's the chair of NatWest Social and Community Capital, which is a bank-supported social finance charity which lends money to community businesses and social enterprises. He's also a trustee of the Coutts Foundation and a fellow of the RSA. And Tom is our next Edinburgh graduate. Today he holds a first-class master's degree in chemical engineering and European studies, which sounds like proper hard work. I think he's number 4 today and more to come. Now, Tom has brought together a great panel with really solid insight, as you'll hear, into the world of ESG. And do remember, please keep those questions coming in the panel, which will appear on your screen shortly. And the earlier you get them in, the more chance of they're getting to the top of the queue. Tom, welcome, and thank you all so much for joining us today.
Good afternoon. Thanks very much, George. Yeah, plenty of Edinburgh graduates around. Anyone would think that Jeffy, is based in Scotland. Welcome to this lunchtime panel. If you are in BST time zone, hopefully we'll entertain you while you snack on whatever it is that you're currently feeding yourself. And while you're eating your sandwich or taking in your soup, you might be thinking about the climate impact, or even maybe the biodiversity and water impact of the food that you're eating. But are you also thinking about whether there's any modern slavery in the supply chain that brought that food to your plate today? Are you thinking about whether the farmers got paid fairly for the food that makes up the ingredients within your lunch? And that is the S in the ESG. And over the next hour, I, along with 4 people that know a good deal about this topic, are going to knock some of the ideas around the S and ESG and hopefully bring some of it to life for you. So I'm going to dive straight in and engage our speakers. Andrew Cave is the head of governance and sustainability for Baillie Gifford, and actually, I must admit, used to be my boss, so I have to be very polite. Andrew, we'll come to you first. You wrote a book for your clients about corporate responsibility and sustainability, and you actually suggest in that CSR, modern sustainability, actually started from the S, from human rights. Do you want to just describe that in a little bit more detail and how we've got to where we are today, where the E seems to be dominant?
Yeah, thanks, Tom, and delighted to be here speaking at GEFI today. So yeah, the project to do a sort of short history of ESG started with our clients repeatedly asking me several years ago about, where does ESG come from? Because it sort of skyrocketed to importance sort of post 2015 and became a sort of mainstay of investment for asset owners and asset managers. So thereafter, but as some of us have been in the kind of field a bit longer know that there's a much longer heritage to ESG. And when I started looking back into it, what you find is the kind of early funds and the kind of early work was almost always on S issues. So S was the original issue. And a lot of the kind of early interest in responsible investment came out of human rights issues. So you had the Universal Declaration of Human Rights produced just after the Second World War. And that provided the kind of foundational framework to look at different kinds of issues around the world and gave a sort of, literally universal baseline in terms of expectations. The S issues really come to the fore, though, with the Vietnam War, when you start to get protest movements in the US, and you get a number of investors interested in setting up funds which actively divested from some of the corporations which were involved in kind of Vietnam War effort. So corporations like some Dow Chemicals who were involved in manufacturing Agent Orange. It was used as a as part of some tactical warfare. So you get the first kind of responsible investment funds coming to the market where you can put your money in safe in the knowledge of putting money into those kind of corporations. And that kickstarts the modern responsible investment industry as we now know it. So not long after that, you get the first stewardship funds appearing in the market and sort of various screened ethical products. And what I would say is that it remains a very niche market for a long time. So it's right up until the last of the 10 years that's a small corner of the investment sort of market in terms of assets under management. But then when you get to really 2015 is the inflection point with the Paris Agreement and then the UN Sustainable Development Goals coming online as the successor to the Millennium Development Goals, you get this huge tailwind of kind of interest in responsible investment. And the S in ESG is still there, but by this point, it's been somewhat crowded out by E, which has clearly become a sort of pressing global crisis. So quite understandably, environmental issues and climate change in particular come to the fore and have become probably the most commonly cited issue we talk about with our clients. But that is changing again. I think the pandemic has reframed how people think about social issues, and it's shone a spotlight on some of the inequalities in the economy and across economies. Just look at the debate right now about the distribution of vaccines globally. So S issues have really sort of come back to the fore with the refocus on public health priorities and just actually the importance of international cooperation to address issues. One thing the pandemic showed us was you can't fight these things on your own. No country is an island. So I think there's a renewed interest in S issues. And if you look at the agenda for the G7 meeting coming up in Cornwall, tax and some tax harmonizations on the agenda and cooperation on a whole range of different social issues. So I think really exciting times, and certainly in our line of work in asset management, we're beginning to get straight in terms of what we need to do with our clients in E. But I think S is very much up in the air because, as we'll get onto today, S is hugely complex and culturally relative. So I think I'll probably stop there as a way of intro.
That's really great, Andrew. Thanks very much. Brilliant whistle stop tour. And several of the things you mentioned there, right the way back to the Universal Declaration of Human Rights, the Paris Agreement, the UN SDGs, those are obviously big global frameworks. And then one of the things you mentioned towards the end there was that's what's the kind of regional element to that. And turning to Leslie Ann, who you've worked across continents, I mean, what's your experience in terms of how the balance between E and S and perhaps G differs in the different places that you've worked?
So my journey started with S for sure. I was part of the original M-Pesa team back in 2005, and we used some corporate social responsibility budget from Vodafone to kickstart the whole of what we know today as the kind of inclusive payments industry. And certainly S is a big part of the conversation. However, when you're in Africa, the reality is that climate change is a big conversation, and there's a need for resilience to crop failure. And the conversation is potentially more about the business impact and the social impact of some of the climate change that's happening more than some of the conversations we have in the UK around environmental factors. But it's an incredibly important conversation. And I mostly work in the financial inclusion space, and so a lot of what we'll talk about today when I talk is about kind of what's going on with financial inclusion. But there is innovation in InsurTech around agri. There is all kinds of private sector innovations. And what was amazing in the panels that I listened to earlier this week from both Asia and from Africa is actually there's some common foundations that both are talking about. So some of the things that I heard that I completely resonate with: cash is king. The amount of cash in the economy is huge, and that changes the game in terms of what you can do with things like data and how you can serve the informal sector. Bricks and mortar are not enough. We we are, even in the UK, thinking about the role of branches post-COVID, but we've been thinking about that in an African and Asian context since 2007, when actually the true innovation of M-Pesa was the fact that people could go to their local corner shops to do some basic banking. And it gave people back their time, and time is the economy. If you have to close your shop in order to go and do some basic services, such as work with your microfinance institute and go to your group meetings and all these things, it means you're not earning money. A big topic across all of the conversations was women's financial inclusion and how entrepreneurial women are. When we talk about SMEs, a lot of them are actually businesses being run by women, and that there are inequalities across that kind of space. And access to finance when you are a small trader and a woman, it's not simple. And the role of the informal financial sector is immense in that. My personal mission these days is with an organization called Modulit Foundation. That's where we take the G and we look at the fact that we need public-private collaborations, and we need to look at what is the role of digital public goods in getting innovation plus regulation and consumer protection all together. And actually the role of payments rails, real-time push payments rails in the COVID crisis has been an immense conversation in the industry. How do you get those disbursements to the people who need it most when they're not banked? It's part of your resilience response, and there's a way to do it by thinking about how do we act better together. One of the really interesting conversations for me that I heard this week is about the concept of blended finance and how public finance is really important, but often in an African context, this came out from the team that talked on Monday, it's not enough. And actually we need to think about innovative ways to unlock private sector finance and to work in a blended way. And so they talked about a fantastic initiative that is helping across 9 countries think about water resources, crop resistant to climate change. And I think there's more of that to come in the future, a way for us to do some blended public-private collaborations in this space. But it really did strike me how much there is a common theme when it comes to financial inclusion and customer and serving customers well, and how that by thinking about social issues, you are actually thinking about governance issues and about environmental issues as you go.
Yeah, very, very good point. And with all these things being so interconnected and intertwined with one another, I think it possibly sometimes very difficult to then draw them out and treat each one separately. So Elena, coming over to you and your role for the PRI, how does the PRI deal with that kind of interconnectedness of all the different information, and how the for a global framework, how does that work if you're looking at organizations on different continents, for example?
Yeah, it's definitely a challenge, but not something that makes it impossible to work on the S of ESG. I think, well, in our case, well, and as Andrew mentioned, I mean, the Universal Declaration of Human Rights obviously is a huge step for thinking of the S, and that's the approach that we're taking at the PRI. So we're using the UN Guiding Principles for Business and Human Rights as our global framework to look at S, at social issues. And this is because, well, I mean, it is an internationally recognized standard. It's been unanimously ratified by many countries around the world, including those where social issues are quite important and quite, just very relevant as well. And in that sense, I mean, it's a good framework because it makes investors to think about, well, what is their policy around human rights? And then obviously goes through a process of due diligence, which means understanding what are those human rights that are more severe in their operations and in their portfolios. And that's where the regional or localized angle comes from. So it's for them to understand then how their approach needs to change depending on the severity of these issues and depending on the sector, depending on the geography as well. So it is very much regionally dependent, but there is a way to look at this in a universal way. And the universal approach is that we need to ensure respect for human rights. Independent of the duty of states to protect human rights, investors do have a responsibility to respect human rights. So that's the way to see it universally, but obviously that will have implications locally. And in terms, I mean, I think comparing it to environment, we like to put things in boxes, but obviously there is a lot of linkages between them. I mean, even for the Paris Agreement, you have the concept as well of just transition that is included in there, which is a social aspect of climate change. And it's like, as we talk about stranded assets, just transition talks about stranded communities, and it's that how, as we move to a low carbon economy, then what do we do with those employees and workers that are going to be left behind, because their industry is going to become obsolete if we try to go to a low carbon economy. So there is a lot of transition implications that we need to think about that will have a social component. And the same when we think about climate change, it's about livelihoods of people, and it's about climate migrants, for example, is something that will be an issue for companies and investors to think about. So I think everything comes together, and even though the classification helps in thinking through the issues, it is important that we think about the linkages as well, and just to know that they don't work in silos. I mean, social activities will have implications in the environment and vice versa. Or thinking about renewable energy, which obviously many investors are very interested in, because it has a very positive component when it comes to the environmental side of things, like actually allegations of human rights violations in the renewable sector have been increasing over the years and have becoming worse. So it's something for investors to think about when they put money behind renewable energies, to also consider the social implications of that. And in terms, yeah, I mean, it is a complex topic, and we said like measurement is difficult, but again, that doesn't make it impossible. And this is what due diligence help with. I mean, after you go through the process of due diligence, then you can think about, well, where is the gap and why is this gap there? And then what should be our strategy and the objectives and targets? And from there, think of indicators that you need. And yes, there is a myriad of indicators, but you can always think about what are the most important ones and try to follow on those. But obviously, I mean, I think, yes, standardization is an issue, but the more investors ask for this information and the more companies report on it, the quality of this information will be better. So waiting for that standardization and waiting for that perfect information, I think it would be a mistake. And also because we say that environment is easier, but not necessarily. I don't think we have a standard way of measuring climate change or standard way of measuring environmental impacts. And even within environment, you have a lot of linkages in terms of strain on natural resources. So for example, when you produce cotton in a region where water is an issue, and then that cotton is exported to Europe, yeah, so then who, I mean, you are also, even though the water is not from Europe, you are also exporting basically that risk and that water scarcity to that continent as well. So obviously there are a lot of interlinkages, and I don't think it's that straightforward as people would like to see. So, and I don't think it's something to say that we need to wait for perfect to start measuring social issues. It is something that investors can do right away. And I would suggest, yeah, the UN guided principles as a way to do it.
That's really helpful, and you've touched on a lot of topics that we'll probably come back to. Fabulous. That will run through of lots of different things in there. And I think this idea of trying to keep our buttons in the boxes, and in reality, you need to access all the buttons. It was something that came up very clearly in Professor Dasgupta's talk yesterday. This point about things like water, which are a global public good, and whether they're in the common areas like the high oceans or in political states, and how we adjust the economics to take those things into account are ultimately social factors. But Leslie Svengadal, who you are a VP at MSCI Research, I saw you nodding when Elena was talking about measurement, and obviously that is very much your bag. And again yesterday, Andrew Mitchell from Global Canopy pointed out that climate has a rather easy time of it, in that they have a ready-made currency in terms of tons of carbon, but that's absent from lots of other areas. And I think the social areas is a very good example where there isn't a clear single metric that people can collect around. How at MSCI are you going about measuring the S in ESG so that it's easier to make direct comparisons between companies, regions, sectors?
Sure. Thanks very much, Tom. Yeah, I think you're absolutely right. This is a significant challenge for the S. And I would even add that this is also a prejudice against the against the S, and that's why I was noting when Elena was talking. I think typically the S pillar is seen as more subjective, soft, and less consensual than its environmental and governance counterpart. And I think this image is actually only partially true, because you can quantify the S even if it's difficult. So what we do at MSCI when we evaluate a company's capacity to mitigate social risk, we of course rely on the company's public disclosure, but not only, because as you mentioned, this would differ widely from one region to another. So to overcome that gap, that bias, we leverage as much as possible what we call alternative data sets. Those are third-party sources that can complement the corporate narrative. For example, when you evaluate a food producer or a pharma company on product safety and quality, we actually leverage food and drug regulatory databases, which are much more comprehensive and exhaustive than corporate disclosure when you want to look at product recall and the severity and the frequency of those product recall. Similarly, when we look at health and safety performance and the actual level of injury and fatality that can happen within a company's operation, we find really useful to leverage National Health and Safety Agency database in certain markets where corporates tend to be really timid when it comes to that type of disclosure. And another example that I'd like to mention on that front, on the mitigation practices, is around the food producers again. This is actually the sector that I cover, so you'll see why I keep on referring to that industry. And really, if you know well that industry, you would know that all those companies would say that they are transitioning towards a healthier food, and they will claim that they've reformulated their products with less sugar, less fat, less sodium. But actually, if you take a closer look at their product portfolio and you measure their products' health against independence and scientific nutritional criteria, you would see that this is not completely true. And what we do at MSCI is really not only relying on the company statement, but actually evaluating ourselves the healthiness of the company's food product portfolio. So we really screen the company's products against nutritional criteria from recognized health organizations, and we look at the type of products and whether it can be considered as a basic product. And by basic products, I mean a product that can contribute to the daily intake of essential nutrients, and whether it has acceptable sodium, fat, and sugar level. And based on that independent assessment, we identified that only 34% of the revenues of the food products constituent of the MSCI ACRI index were aligned with such independent nutritional criteria. So that gives you, a different level of picture from the corporate disclosure. So that's what we do to complement the corporate narrative when we look at the mitigation practice. And how the company reduced the social risk. But another very important thing that we do within our ESG ratings, and that is not specific to the social pillar, is that we don't satisfy ourselves in just evaluating the company's policies and programs. Every time we look at a social or an environmental risk, we want to see what's the specific exposure of the company to these risks, based on its unique business footprint, taking into account the company's revenues and assets breakdowns per geography, but also based on operating segment or how large the company's workforce is. And when we cross-reference this company's data with our own proprietary database, where we have more than 1,000 business activities and hundreds of geographies that we have mapped with specific sectorial, regional social data based on third-party sources, academic literature, and regulatory database, that really gives us a much more granular information on how vulnerable the company is, because we know that the level of labor unrest will be very different from one region to another. The level of labor violation will also differ a lot depending on which business operation you're focusing on. And maybe just to give you another example for measuring the exposure of a company to a social risk, if you take privacy and data security issues, we would be able to identify, even if the company does not disclose any information on that risk, how exposed the company is to regulatory risk if it operates in countries with stringent or strengthening privacy and data security regulation, but also based on the percentage of revenues that comes from business activities that typically rely on handling a lot of personal data on consumers, as well as being exposed to a high level of cost of data breach using third-party data. So all in all, we have almost 45% of our ESG rating signal that comes from those alternative data sets, and social is definitely not an exception to that.
That's fascinating, because one of the things that is regularly kind of leveled at social issues is that they are more qualitative, as I said. And to hear that very scientific approach where you're looking at sort of independent nutritional data and comparing the stats around sugar and fat and things like that is fascinating. Elena, just coming back to you, I know you were recently part of a working group trying to do some myth busting around the S in ESG, and that was one of the points that you made. This combination of qualitative and quantitative is hugely important in social. Is that something that you really are seeing significant development in the ability of analysts to look at both of those sides of things?
Yes, definitely. I think we've seen an increase of interest in qualitative data and understanding, and I think investors as well, as they gather data, I mean, they don't just take one source of data as the whole truth, but do try to gather more information from different sources, and especially for social issues and where the impacts occur as well. It is important for investors to gather data from situations on the ground. So we also see investors looking at information that is not necessarily just coming from the companies. And as Leslie was mentioning, I mean, it's a similar approach, and it's also looking at local NGOs, local human rights groups as well, just to understand then, yeah, what is the other story coming from the ground, or even you have a lot of sites and even data providers that are looking at information such as allegations against the company that come through the media or different regulatory bodies as well. So definitely there is an appetite to look at more than just quantitative data. And also because if you think about situations on whistleblowing programs, for example, if you have an increase on allegations, it's not necessarily a bad thing, even though it sounds bad, but it might be, I mean, you need to dig deeper to understand whether it's because the situation is getting bad, or is it because actually the system is getting better. And therefore people feel more empowered to come forward with their own issues and problems. So actually, like, having more allegations might be a positive thing and might be a change in attitude and culture within a company. So that's why it's important to balance the qualitative and quantitative. And I think, yeah, finance is very used to quantitative, but definitely, I mean, we do see a shift in that perception, and we do see a shift in the use of more qualitative data when looking at social issues.
I really like that point about when something looks worse, but actually that means it's better. And I think one of the examples that is quoted regularly in that space is around modern slavery, and historically it's not been very well identified or picked up, and so there was lots of reports with zero in them, and Tony's and others, Tony's Chocolonely and others have taken the approach that, well, it's there somewhere, so we just need to work harder to find it, and that's kind of really changing the approach. Andrew, as an asset manager yourselves, and looking at that kind of sort of qualitative, quantitative, I'm just interested in stepping back to the point that was made earlier about the link between all of the different issues. And I read recently somebody was saying that the renewables revolution will be built on mining, and mining is obviously an industry which is fraught with social issues. Is that something that Baillie, I know Baillie Gifford have got really some very forward-thinking investments around the renewables revolution, so that must be something that you've got your eye on.
Yeah, absolutely, Tom. And I mean, your question is spot on and shows the linkages across these pillars. To ESG as a sort of shorthand acronym that sort of helps people sort of divide up reports, but in practice, there's almost total overlap across all three, of course. And that's a good example where we have some tough sort of choices and conundrums ahead of us as we think about this sort of low carbon transition. And that most of the technology we will need for the transition is already there or emerging, but it's the ability to do it in a way which is just and fair and respects to human rights and other kind of issues, which is probably the biggest challenge. So if you just take energy transition, doing that in a way which is not detrimental to the lowest socioeconomic groups who pay the most for their energy is absolutely key. So this is one example of an S issue being embedded with an E. But the point you mentioned is fundamental. So a lot of the technologies we're going to need a lot more of over the next 20 to 30 years will depend upon mining. And at the moment, the mining sector is something of a pariah for responsible and ethical funds. Very few hold miners and are willing to hold mining companies. And I think that is problematic, because we need products like copper, coltan, cobalt as some of the key sort of building blocks for the sort of battery and electrification revolution, for electric vehicles, for the kind of technologies that will enable us to be much more resource efficient across entire industrial processes, Internet of Things, smart homes. All of that will be driven by those kind of mined materials. So one of my kind of issues with kind of the way the responsible investment world is developing is I think it's in danger of sort of setting too high a bar and a sort of pure view of what a responsible investment is, whilst somewhat ignoring the reality of the economy. That Apple depends on coltan and cobalt, and Tesla depends on cobalt. So we need to kind of, I think, reinvigorate that whole debate around what is sort of ethical, responsible mining like. And we frankly need to help the big players. We need to get in behind some of the big mining conglomerates and, as long-term stewards of capital, support them to improve their approach to S issues. Because artisanal mining, as it's called, it's a euphemism for sort of small-scale mining, shows how bad it can be when big corporations step away from sort of key products. So you just have to look at what's happening in Congo right now, where a lot of the big mining companies with better reputations have stepped away from the cobalt mining sector and left the space to other international operators and artisanal mining. And there are enormous social issues in the Congolese cobalt sector. It's one of the most difficult areas of, I would say, of the contemporary value chain for electric vehicles and technology products. So we recently brought a speaker in who's been out in DRC for 10 years with a lot of expertise in artisanal mining to try and educate our investment staff about what we can do about these issues. And there are certainly things that can be done. That there are standards emerging for what you might call fair trade cobalt, and I think we need to get in behind those and make them work, because there's no ready alternative. Congo provides a huge amount of the supply of cobalt just now, and there's no other economy which can scale it up in a way which will help us with the low carbon transition.
Yeah, no, absolutely. Leslie Ann, in your opening comments, you actually referred to this need for standards not just to be set by companies and ratings agencies and investors, but also that there's a need for public and government, public regulators and governments to kind of get involved in. And obviously your example was more around financial inclusion than around mining. But how much do you feel that balance between private innovation and public regulation is important in the S factors?
It's really interesting that you brought up artisanal mining, because actually we had a speaker at our conference about 6 months back from the innovation space around artisanal mining, bringing up exactly the same issues around the provenance and the fair trade, and how do we help people retain their income. It's all very interlinked, but there are people out there who are definitely innovating with interesting products around provenance and the like. It's a complex supply chain. Fundamentally, a lot of this comes down to inclusive identity and inclusive payments rails. As a fundamental way to get more quantitative data, they kind of fundamentally need to be in place and they have to be accessible to all of the population, and that's not a simple thing to achieve. And as a consequence, a lot of the data on the informal economy is very qualitative, and a lot of the evidence is it's not driven by the kind of numbers that we would see in the Western space.
Yeah, no, absolutely. Leslie, one of the other things that Elena referred to was the balance of voluntary and mandatory information available, and that is different for different organizations at the moment. What's your view in terms of the balance of voluntary versus mandatory? Do you think that we're going to see more and more? I mean, EU human rights legislation is certainly heading in that direction, but on the S more broadly, do you think that's a trend we will continue to see of more mandatory?
I think on the social front, we are seeing indeed an increase in terms of regulations. The first that come to my mind, of course, on the human rights fronts, and especially for the modern slavery legislation in several developed countries. We recently published a paper on that, on what it would mean for several companies of our universe. I think also if we look at other social topics that are not always on the top of people's mind, but privacy and data security went through a really important regulatory momentum in the EU more than 2 years ago, and we're really seeing like the snowball effect of this EU regulation across other countries. So the privacy regulations and putting back the individual's right at the center of the privacy legislation is something that we're really seeing spreading across different regions, including in Asia, where we're seeing also corporate disclosing more in terms of their privacy policies and how they provide further rights and further transparency to individuals on what type of data they collect on them, and what are their rights to ask certain data to be withdrawn, and also to have some data being changed or amended. I would say, even if you look at opportunities health and nutrition, we've seen that there has been a huge increase in terms of sugar taxes, and I think COVID is likely to further accelerate that momentum, because we've seen that overweight and obese people had higher likelihood of going through more severe form of COVID. So the whole obesity issues is more and more tackled by a lot of states and countries who are asking for cleaner labels from companies, and also just levying taxes against company, mainly the beverage company. So I would say it's very much growing, but we need to be anticipating those regulations or those mandatory disclosure, because they're still very disparate from one region to another. And it's important that we are already able to collect some of those information across our whole universe for our investors, so they can be able to identify which players are the best or worst positions towards this, more mega trends that we're seeing, where there is more regulation.
Yeah. And at what point is there just too much data to be useful as well? I think that's one of the things that I'm always sort of fascinated by. I mean, Andrew, your team, the analysts in your team, and in fact, Leslie, in your world, you know, it just gets to the point where there is so much disclosure and so much information. How do you decide what's the useful information? And just picking up on a question we've had in from Tendai Stefano, the distinction between transparency and exposure. So some companies actually shying away from even getting into certain areas and trying stuff because they're fearful about exposure, because of all this kind of drive around more and more and more transparency, and they're just a bit, maybe even just a bit immature around something rather than bad. How do you balance that stuff off, Andrew?
Yeah, I mean, there's been an explosion of data, but I think there's a big difference between data and insight, and you know, lots of data doesn't actually help you get a better insight into companies' practices and impacts. And you know, so there's been a sort of huge, you know, increase in the amount of material put up by companies, and that is still often quite unstructured and sort of using sort of company-specific metrics and so on. So it's got hard for investors to compare that. Now the kind of good work being done by SASB and GRI and others on the standardization of standards is all greatly welcome, because that allows us as investors to do more comparable analyses across sort of companies and sectors. But I think, you know, you've heard me say this before, Tom, but when you actually think about data, we're just at the beginning of this. You know, the kind of this whole ESG industry is actually completely nascent, and we know almost nothing actually about companies and supply chains and impacts. It's remarkable how little we know. And why do I say that? Well, it's because the kind of the information just isn't there. Global capitalism didn't evolve in a way where there was clear social and environmental certification of different value chains. So to give a really simple example, you take something like feedstock, you know, Western European feedstock that's fed to sort of chickens and sort of, you know, sheep and cattle. Should be a very basic product, and you think relatively easy to carbon footprint, to sort of work out the environmental impact. Not a bit of it. It's actually made up of, you know, lots and lots of different products. A lot of it is imported soya, which comes from Latin America, and a lot of that Latin American soya is coming from the clearance of sort of virgin rainforest sites. So it's potentially an enormous carbon footprint to the feedstock you give to your free-range chickens. And this is me speaking from experience here. I think we've got an enormous job to do as a community to get over the data and to get better quality of data. And you know, I use the analogy of, you know, the first Enlightenment maps, which had almost nothing filled in. The map makers only filled in the bits they knew for certain, which was about sort of 10% of the globe. That's where we are in ESG data. So yes, it's great that there's a you know, huge industry, you know, burgeoning in terms of providing ESG data, but we need to structure it, we need to improve the quality, and we need to get over how to organize it better. So frankly, analysts can sort of, you know, see the wood for the biomass, so to speak.
Absolutely. Leslie Ann, here we are all talking about these kind of grand issues in a very kind of sort of global and joined up and macro sense, but you've really got a lot of experience of dealing with this stuff on the ground, and certainly when we've spoken before, the examples that you give really bring it to life. One of the things that Leslie brought up just before was around privacy and fraud and data becoming almost another mega trend around S. And I just wondered whether you could describe some of your experiences around working with financial inclusion and financial capability, and how that then runs into some of these other issues.
Sure. Let me see if I can find an example that helps with that. So I would say first and foremost, mobile money providers, banks, telcos, everyone very much has data privacy at the center of their world. Open banking is not a huge conversation yet, and the risks involved in open data are a whole different beast of conversation again. But we created a really innovative product back in 2012 where we linked information from the telco sector to a bank with consent with the customer. So we were able to help a bank understand that this customer has propensity to pay. They are regularly buying airtime. They have had an M-Pesa account for over 6 months. We know their KYC because they did a formal registration process with us. They're a good customer. And as part of that, they were able to open a bank account and save digitally, completely digitally, using the KYC information that we held at M-Pesa, and to as a consequence, be eligible for small loans. Those loans were used for the purpose of access to finance. So you'd find that small traders would take a loan out at 4 a.m. in the morning. They would use it to buy stock for their shop, and they would then go trade all day and repay the loan by 6 p.m. that evening, and do it again the next day and again the next day. That is financial inclusion. It's not having an account, it's giving people the ability to say, do you know what, I am worthy of liquidity, and you should help me and I will repay, and look, here's repeatable. And you bring people out of poverty when you do things like this. However, it's got the ability to be cloned and copycatted, and it's got the ability to be almost taken too far sometimes, and then therefore there's a need for governance and regulation and thoughts. So what's happened after that is an awful lot of copycat products. When you've got smartphones in the mix, you then go to the next level. What is open banking in an emerging markets context when there's no data at the banks because customers are unbanked? Actually, it's their call history. It's what's in their SMS messages. It's what they're using their phone for. It's their battery usage. It's how they're charging their phone. It's a whole ream of data. And what we have seen is quite a lot of fintechs going, how do we actually harness the value of what we do know about these customers? And they're doing it in a way where they want to create an ability to know the customer better. However, what it can do when the industry is not regulated, or there's a central kind of way to understand how over-indebted people are, there's an ability to innovate too far and end up with a customer borrowing from this low-cost service to pay off this low-cost service, and it creates a consumer protection issue and an education issue. So I think there is a need for private sector innovation and regulators to work together and to make sure that consumer protection is at the core of what we're doing, and that we're not making people over-indebted through the use of too many of these services. And even to the extent that I've seen an awful lot of innovation on top of salary schemes, where money is debited before they actually receive their salary. But it's really important that that is not taken too far, and they don't leave with enough money to actually buy their food and buy the basics of life. And that's like one of the examples that we talked about, Tom, when we were catching up at this beforehand. There's a lot of power in data, and there's a power in using it responsibly with consent. But there's also a need for shared services and consumer protection, and doing that efficiently in a way that everyone is not doing their own siloed ecosystem, that actually we're thinking about this together. Back in the world of mobile money, we were seeing the kind of fraud scenarios that we see in the UK today around SIM swap fraud and push payment fraud. We were seeing this with smaller value transactions back in 2007, and we've been solving these problems through various controls over the years. The amount of money is different. We're not seeing people lose 10,000 when their solicitor's account is hacked and the bank account details are changed and a phishing email comes in. What we're seeing is a very similar attack with a different amount of money, but it's still people's livelihood and it's their whole savings, even if it's £200. And so we've been thinking about these consumer protection issues within the financial services inclusion space for a long, long time.
Yeah. As I expected, a very rich example that really brings out a lot of those different issues. And I think one of the things that's really interesting in your example, Lesley-Anne, is all these different operators working in a similar space, but almost with
intentions.
With different intent, with different kind of, and also different feelings about what good enough looks like. So that will do for that organization, but then another organization will say, oh no, that won't do. It needs to be this much better. So, I mean, Elena, coming over to you, I saw you on another panel on Monday with PRI were involved in another S initiative KPMG, and one of the things in there is about so how do you decide what good looks like in the social space? Because for climate, it's now widely agreed that under 1.5 degree raise and net zero is what good looks like. How do you decide for these issues what good looks like?
Great question, and I mean I might not have a definitive answer on that one. I think again, I mean the comparison to climate, I don't think there will be one indicator that would tell us if you do this, then you solve social issues. And I think that's something that we're going to have to live with, and the fact that social issues are more complex, and therefore it would be a combination of indicators that you need to look into. I think, again, going back to respect for human rights should be, I mean, I think the way of thinking about it is maybe on in terms of minimum safeguards. So what is the minimum that is acceptable, and then go from there. So respect for human rights is something that we need to always think about and consider, well, in all of our activities, how much are we impacting people and how much are we infringing on their rights, and then consider that as the minimum baseline for the activities that you do. And the same, I mean, in that panel, we were discussing whether modern slavery could be that one indicator that could take the lead in terms of social issues. And my comment was like, I mean, it is a great first step because it's one of the worst violations of human rights that it exists. However, not being on modern slavery doesn't mean that you are in a decent job. I mean, there are many other conditions that I mean that are not necessarily there, even for people that are not on modern slavery. So we need to think as well about freedom of association, living wages, social protections as well, that are not part of the modern slavery conversation, but are part of the respect human rights. Because if we think about human rights as the Universal Bill of Human Rights, but also the ILO conventions, then that's a good benchmark on understanding what good looks like. But I think that the trying to think about getting one standard, I don't think is the correct way to see it. I mean, I think we were going to need a combination of metrics when we look at social issues. But definitely, I mean, we cannot think about better working conditions when modern slavery is still rampant and is still permissive in every geography in the world, for example. So yeah, there are some minimum safeguards that we need to ensure.
So perhaps the idea of a lead issue rather than a coordinating issue maybe is a simpler way to think about it from a social pillar. It's interesting, we've managed to get, I think, 45 minutes, 50 minutes into a conversation about the S pillar, and none of us have yet mentioned diversity, equity, or inclusion, which is pretty surprising. It's down here as one of the kind of mega trends that have obviously really matured over the last year or so with the Black Lives Matter movement that erupted after the murder of George Floyd. But also in the UK, there's been a second wave of the Me Too global movement around gender equality as well. I wonder if any of the panelists would just like to comment on the relative maturity, perhaps, of diversity and inclusion as a social issue versus some of the newer issues that are just emerging around whether it's measurement or targets or any of that. Any hands, or I'm going to have to pick someone? Leslie Ann.
So I'm going to object and say I absolutely have talked about gender issues and inclusion issues.
You did,
maybe in a different context.
You did in your opening comments. I take it back. I apologise.
But I think they're in a different context in an emerging markets world. So I was talking about women from the perspective of social entrepreneurship and access to finance, and the perceptions of whether women can run a business already and whether they have the right paperwork. And in the Pakistan presentations, that was talked about deeply, actually, as if you want to bring women to the financial inclusion sector, there has to be women in the shops, in the branches, in the ecosystem that they interact with. Fundamentally, it's really important. It has come through strongly in the emerging markets context, but it's kind of got a different flavor to it than possibly the way we think about it in the US and the UK. It's got a different kind of impetus behind it. But yes, inclusion and and gender equality is a huge topic in the financial inclusion kind of development sector space.
Yeah, and how do we avoid just taking a very Western liberal view, not just of gender equality maybe, but human rights and some of these other things? One of the comments that I saw at the panel that Elena was on Monday was, you know, how do you know what's right for the whole world when you're sitting in Edinburgh or Frankfurt or Paris? Andrew, have you got any views on that?
It's a really important issue. It's very issue specific. If you look at something like data privacy, the kind of attitudes are entirely different between the US, Europe, and China, for example. So it really does matter what market you're talking about and what sort of expectations and norms are. I think for the kind of core sort of fundamental human rights, we shouldn't entertain the idea that they're relative. I think that's the entire point of the Universal Declaration. There are some inalienable rights that should be enjoyed by all people in all countries, and I think we need to resist hard the idea that there's a sort of cultural nuance to sort of basic human rights. So I think the Universal Declaration is still as relevant today as when it was published, for that very reason. But I do think beyond that, when you go up the kind of Maslow's hierarchy of needs sort of pyramid to sort of different kinds of issues, yes, it becomes more relative. If there's time, I was going to finish on a few sort of emerging issues, but you might have a few more questions before that.
Before we come to emerging issues, I was just going to ask Leslie a little bit more about the kind of current megatrends rather than the emerging issues, because I think, as I said, COVID and diversity and inclusion have certainly felt like significant megatrends, and with the G7 agreement on tax last week, I think tax is another one. Are there other, for MSCI, are there other megatrends that you feel are particularly hot topics at the moment?
Yeah, I mean, I can not mention, racism and diversity that you discussed earlier. That was obviously a tremendous and still a tremendous topic among our clients this year, and notably among our US clients. And as a result, we are newly collecting corporate racial diversity data for the US market to address this demand. But this is a type of data that is not consistently disclosed, and for certain markets, for example in France, it actually poses a legal issue to disclose about the racial data of your workforce. But it is definitely something that we're looking at, and where we're seeing a huge demand among our institutional investors. I think this issue is also part of a bigger mega trend that we identify in our trends paper at the end of last year, which are social inequalities. And COVID-19 that you were referring to has really put its thumb on the top 1% side of the wealth scale, and really undoing decades of progress towards a greater equality. And what we're seeing at the moment with the proxy season is that investors are closely monitoring how fair the executive remuneration will be for 2020, bearing in mind that employees have had to take a heavy toll during the crisis with furlough, restructuring, and also more health and safety risks when they had to be on the front line. So it's interesting to see how the financial burden of the crisis is redistributed between the different stakeholders of the company.
Yeah.
And I think, within that big social inequality topic, what we've seen is that investors have relied on the SDGs, the Sustainable Development Goal, as a framework for developing their approach to address inequalities, because a lot of the SDGs are referring to inequalities. There is the SDG 10, of course, but also some others, linked to poverty, hunger, or health, or education, gender equality, or decent work. And we're seeing that investors are are using that framework to see the net alignment towards those targets to approach this social inequality issue, which is extremely diverse and complex. So it's a way to rely on a recognized and consensual framework.
Thank you. Right, we've got about 2 minutes left, so I'm going to come to each of the panelists, and I'm going to ask you. Leslie's just very kindly filled in a couple of the gaps of the hot topics that we hadn't talked about. But in terms of the hot topics, when we sit down in next year or the year after, what are the things that are emerging for you that you think are kind of the emerging social issues? Elena, I'll come to you first, please.
Sure. I think, at least from the work that we're doing at the PRI, diversity, equity, and inclusion is a big one. But I think it's thinking of those three terms. I think we think of diversity too much on the number and not so much on inclusion and equity. So it's understanding barriers and advantages that people have depending on what group of society you come from. So that's important. And working on inclusion and not so much on how we see the numbers pan out. And decent work. I mean, as the COVID-19 put a huge spotlight on working conditions, on social safety nets, and the cost for governments for not having those social safety nets in place. So I think, I mean, improving working conditions in different countries and improving working conditions in supply chains is going to be a big trend, especially when we see the low carbon economy transition, the transition to the technological transition as well, and demographics. I mean, when we see an aging population in developed nations, but younger populations in emerging markets as well. So I think those are the issues that we're going to be focusing on.
Great. Lesley-Anne, what's your view?
In my world, there's a mega trend around digital public goods and the need for infrastructure, fundamental infrastructure as the rails for improvement. So I obviously focus on payments. There's a lot of focus around digital public good and inclusive identity as well. And there's that need for public-private collaboration to get the job done is a big part of the conversation.
Definitely, and I think that connects very closely with the work around the just transition. You talked earlier on about agriculture as a significant income, and the just transition is a huge part of that, isn't it? Leslie, how about you? What's your kind of main emerging issue that you would like to talk about when we come back next year?
I think I'm just gonna stay loyal to the social inequality topic, because I think we're just starting to look into that issue, and it's going to take us years before solving it. And I think we can have a broad understanding of social inequalities or social equality issues. You know, it's about decent work, but also about diversity and inclusions, and we have a lot to do.
We do.
I would stay with that topic.
As a whole panel for itself, I think, for next year's conference. Take note, Jeffy. And then Andrew, finally, how about for your company? What are you guys looking at as emerging issues?
Well, listen, we've covered such a spectrum of issues in this panel. It's been fascinating, and you know, this shows why S is ever dynamic and ever changing. I'll add a few more to the mix of things that we're looking at in some of our own internal research groups. So ethical AI is a big theme. So you're starting to get many more companies using AI for, you know, products like risk-based pricing for sort of loans, consumer finance loans, and insurance premiums. And ethical AI could either lead to much better sort of pricing of those products and, you know, more equitable outcomes, or it could lead to the industrialization of bias against a whole number of socioeconomic groups. So we need to kind of really understand that and understand how it's been applied and the governance of you know, ethical AI. So that's one. A second area that we're really fascinated by, we think is really important, is the social impact of gaming. Gaming has become the world's biggest leisure activity, and not just gaming, but watching people playing gaming is one of the most watched channels on YouTube, as anyone who's got sort of 12 to 15-year-old will know.
You're making me feel very old, Andrew.
Well, so, you know, gaming has just the most enormous potential as a sector, but also potentially enormous social impacts. We just don't know yet what the impact is of some of the contemporary generation of games. They're so much more engaging and dynamic and sort of mesmerizing young brains than anything from our generation. You know, it was very hard to get addicted to Pac-Man, frankly. At some point you gave up chasing sort of dots around the screen, but you know, Call of Duty, games like this, Fortnite, entirely different. So the social impact of gaming, we think, is a really big issue. And then the final one I'll mention, and it's been sort of alluded to by Leslie Ann, around, you know, the infrastructure around digital payments. I think the social impact of virtual currencies and, you know, Bitcoin is an enormous theme. So that could be incredibly supportive of, you know, wider SDG goals in terms of reducing the fees for remittance payments, for example, for migrant workers, as Bitcoin becomes legal tender, you know, in countries other than El Salvador, which has been first out of the blocks. Or it could be one of the catastrophes of the future, you know, if not handled the right way. So I think that's an enormous area for further research, and so lots to keep us busy on S.
Absolutely, and lots for, I think we just wrote next year's agenda for the social day of the summit, and I think you guys will all want to come back and participate. Leslie Ann's just messaging Andrew in the background to challenge him on one of his points, but we have run out of time, unfortunately, so I will have to just wrap up. It would be remiss of me, given that Andrew's mentioned gaming, for me not to suggest to all delegates with children that if you are interested in gaming for good, you should download a game called Island Saber, which is entirely free, available on your console, or if you're in the UK on a mobile device, but it's on consoles globally, which my team produced last year. And it's all about recycling and saving the planet, and also teaches kids how to use money effectively. So download Island Saber, give it a go. But that wasn't why I'm here. I'm just taking advantage. ESG, thank you very much. It all started with S, we learned in this last hour. But actually all the issues are completely interconnected, and it's a bit of a fake distinction to suggest that we can deal with E, S, and G separately. There's a big difference between data and insight, so there's lots more that we can do on the qualitative and the quantitative, but ultimately when it comes to social, we are all Jon Snow. We know nothing. And with that, I will hand back to the conference.
Tom and team, thank you very much indeed. That was completely fascinating. I think candidly that a day on S next year at the summit is not enough. I think it's got to be a week. There is so much to cover here, all riveting, and I particularly like the examples and particularly that focus on data. Very interesting indeed. And we must get the Jeffy team to promote the game, which I have actually seen, and we must ask them to do that on their website. Thank you. Really enthused about it, and thank you all for doing it. Definitely a week next year. We must tell Omar and Chris. Now, let me welcome, please, Gail Hurley from Jeffy for our final initiative spotlight of this summit, which is a look at the issues around tobacco-free portfolios. Now, Gail is an international development and sustainable finance professional with 15, 16 years experience in research and, very appropriately for the previous conversation, data analysis and market trends, in advocacy and in direct country support. Her areas of expertise include innovative finance mechanisms, sustainable finance, aid, debt and tax. She's currently a fellow with development initiatives and a senior consultant with Jeffy. Gail will introduce her panel, but I'd just like to add that Dr. Bronwyn King, who's on the panel, was one of the last people to visit our office in London before the pandemic shut us down or kept us at home for a year and a half, and very welcome she was too. It was great to hear about this important project from Bronwyn when she visited, and we very much look forward to welcoming her back soon when travel gets easier. I'm not, of course, blaming Bronwyn for the pandemic. She just happened to visit us. It was just a timing thing. But Gail, thank you, and as it were, if this is appropriate, fire away.
Thank you, George, and good afternoon, and a very warm welcome to our spotlight session this afternoon on tobacco. I'm Gail Hurley. I'm a senior advisor with the Global Ethical Finance Initiative, and I'm your moderator for this session. I'm also supporting the work of Tobacco-Free Portfolios, one of our featured guests today, and I'm delighted that the topic of tobacco is on the agenda of this year's Ethical Finance Summit. It's an important issue in the ethical finance debate, but it's not really been in the spotlight recently in the cacophony of noise around COP26 and the race to net zero. And we've seen on the back of that a flurry of announcements and commitments from financial sector actors on decarbonising their portfolios. All that's wonderful, but we haven't heard too much about tobacco of late. So our aim is to redress that very much today with this spotlight session. And I'm pleased to be joined by two amazing experts in this field. Dr. Bronwyn King, who's founder and CEO of Tobacco-Free Portfolios, who's joining us from Melbourne, Australia today. Good evening to you, Bronwyn. Thank you.
Thanks, Gail.
And Mr. Ruben Zandvliet, who's Environmental, Social and Ethical Risk Advisor with ABN AMRO Bank in the Netherlands. Ruben, a warm welcome to you as well.
Thank you, Gail.
Before we start, and by way of disclosure, I should probably add that this is also a topic that's very dear to my heart, having spent some time in Zambia a couple of years ago working with tobacco farmers and looking at the ways we could use new innovations in finance like social impact bonds to support economic diversification programs there. So I'm really pleased that we're having this conversation today. So Bronwyn, perhaps I can turn to you first, ladies first. You're probably, it's fair to say, the global champion of tobacco-free finance worldwide. You're the founder of Tobacco-Free Portfolios. So perhaps you can tell us a little bit more about why you started the organisation and what you hope to achieve.
Thanks so much, Gail. Yes, when you say, you know, I'm the global champion, I actually like to think that my patients are. And that's really where the story comes from, because I'm a radiation oncologist by background. And in my early years of medicine, I saw the true impact of tobacco. And while I know everybody knows that tobacco is bad, it was really having a front seat at the actual show of tobacco, and it's an absolutely devastating reality where I just watch so many of my patients go through terrible suffering, many of them die, and it was an accidental discovery 10 years later where I found out that in fact through my compulsory pension plan in Australia I was investing in big tobacco. And right away at that exact moment I felt that there was a conversation missing. It was missing between the health sector and the finance sector. And I felt that if people in finance sat down and really learnt a bit more about tobacco, that they would be motivated and would feel compelled, like I was, to do something about it and to go tobacco free. So the work really started here in Australia with our big pension plans here. And as you know, and the audience will know, Australia has a very big pension sector, the fourth biggest pension sector in the world. And after some pretty tough conversations back in 2010, 11, 12, we saw some movement where some of the biggest pension plans did go tobacco free across all of their offerings. And that was pretty instrumental because prior to that, it had only been maybe a few very small boutique organisations or some religious institutions, financial institutions that had exclusions. But suddenly in Australia in 2012, 13, 14, we started to see this growing acceptance that having exclusions made sense. Now, overwhelmingly, the superannuation or pension sector in Australia is tobacco free, and it was a great case study to share with the world. So in 2015, we started working all across the globe. We were very pleased to spend a lot of time in Europe and made a lot of progress there. In Europe, people in finance wanted to talk about this issue and started putting those exclusions in place and really joining together with the global health sector and communities and governments and parents and teachers in wanting to bring an end to what is called in the health world the global tobacco epidemic. And just to give a number there, the World Health Organization predicts that the world is going to see 1 billion tobacco-related deaths this century. So it's a really extraordinary problem and does require global collaboration across sectors, across borders, so that we can comprehensively do something about it. So that's where the work has sort of come from. And I don't know if I have time now to mention, but our flagship initiative is called The Pledge, the Tobacco-Free Finance Pledge, and we were very pleased to launch that at the United Nations in 2018. We had the support of President Macron, we had the support of the Australian Prime Minister Turnbull, we had the support of 3 different UN agencies. The World Health Organization got behind it. Dr. Tedros Ghebreyesus, the Director General, he came along and spoke at the launch. And we're thrilled that this has become an initiative, and we're seeing more and more major financial institutions signing up. There's now almost 170 financial institutions signed up from more than 20 countries, and together they control more than $11.5 trillion US. And I'm very happy to say ABN AMRO is one of our proudest signatories. So we've been very pleased to work with them for some time.
Thank you. That's excellent, Bronwyn. And it sounds like the work is really gaining in momentum over recent years. So congratulations. Well, I mean, I was about to ask that very question to you, Ruben, with ABN AMRO. I mean, you're in charge of environmental, social, and ethical risk. So I wondered, is ABN AMRO tobacco free? And in fact, what does the conversation look like on tobacco exclusions in ABN AMRO?
Yeah, thanks, Gil. Yeah, ABN AMRO is tobacco free, and I think we started that process sometime in 2016 through engagement with the Dutch Heart Foundation and other public health NGOs in the Netherlands. Who roll out their vision for a smoke-free generation. So in 2017, we decided to exclude tobacco from all lending activities. And in 2018, we excluded tobacco from all investment activities. So across the board in all lending and investment activities of the bank, we are tobacco-free. And that's because, and that's also the time, 2018, when we could, of course, join the tobacco-free finance pledge.
And was it a difficult conversation internally to have within the bank, or was the process fairly smooth, both in going tobacco-free as well as signing up to the pledge?
Well, signing up to the pledge was a step we took after we've made the decision to go tobacco-free on our lending and investment activities. So that really wasn't a conversation at all, I would say. There was a bit more conversation around the initial step to exclude tobacco from our lending services, but it logically followed from our engagement with the public health NGOs in the Netherlands, but also our commitment to human rights. So ABN AMRO for a longer time has really committed to respect human rights in line with the United Nations guiding principles on business and human rights adopted in 2011. They provide a framework for companies to understand what they should do to address human rights risks in their own activities or associated with their business relationships. And when you start analyzing these issues through the lens of the United Nations guiding principles on business and human rights, the right to the highest attainable standard of health is embedded in the International Covenant on Economic, Social and Cultural Rights. Right? It is a human right, so companies must respect it. And once you start analyzing that, and you would recognize that through relationships with tobacco companies, you are in fact directly linked to that problem, and there's no way out. There's no way to successfully engage with tobacco companies. There's simply one solution left, and that's to exclude it across the board.
No, thanks, Ruben. I wanted to discuss a couple of areas that could perhaps be described very much as hot topics today in the ethical finance debate. So Bronwyn, if I could turn to you first. I mean, the title of our session today is the S in ESG and why it matters. And certainly we've heard an awful lot recently around environmental concerns and climate change related concerns. So the E part has very much dominated the ethical finance debate, but it's also the case that the COVID-19 pandemic has unfortunately, or maybe fortunately, shining a renewed spotlight on social risk and is leading us to think, more closely about the impact that businesses have on their workforce, on local communities. what impact do you think that renewed interest in the social part might have on how we view tobacco companies and investments in tobacco companies?
Well, look, I think that the whole COVID crisis has created a huge uplift in interest around sustainability, full stop. So I think that is a great thing, and I think that more awareness of environmental and governance risks and how they relate to investments also is a great thing. But it has indeed provided this really interesting point in time where I think that really almost for the first time ever, the finance sector has suddenly got a big jolt and realised that health is intrinsically important when we look at the impact of companies on the world. It's not just the impact on the environment or on, for example, health and safety of employees, or how many women are on boards, or how diverse boards are. There is, in fact, this fundamental principle of health, which I think up until now has pretty much been missed. So even if we look right now, there's more than 600 different ESG and ratings out there. And we have actually found that tobacco companies have really gamed that system very effectively, because while they may score well on a whole range of metrics, the fact that they make products that killed an estimated 8 million people in 2020 doesn't seem to be captured anywhere, which is obviously a glaring gap in those systems. And if we just look at the numbers, you know, the whole world stopped for COVID, and rightly so. COVID tragically took 1.8 million lives in 2020, yet in the very same year, tobacco had the worst impact ever on humanity, taking 8 million lives, so 4 times the number. And of those 8 million people, 1.2 million people don't even smoke. So that just sort of shows, you know, this extra layer of impact, not just on a customer, but on the community in general. So we certainly hope that when people are scrutinising ESG methodologies, they're really, you know, being sceptical, looking very deep down, and making sure that what is said on the label of a product really is a reflection of what they expect.
Yeah, thanks, Bronwyn. I mean, I'm glad you mentioned the issue of ESG methodologies and ESG frameworks, and I'd like to ask Ruben to pick up on that point, actually, because, you know, we've seen a real uptick in investor interest, in consumer interest in products that are marketed as sustainable or SDG friendly or Paris aligned in some way, you know, and now a dizzying array of financial products out there that are marketed in this way. It's a little bit of a Wild West out there, perhaps. So, I mean, how, in your view, Ruben, should ESG frameworks tackle tobacco, and can a tobacco company be sustainable, in your view?
Yeah, this is a very important issue, if not a key issue in the whole debate around finance and tobacco. Because tobacco companies cannot be sustainable, and ESG rating agencies really fail to capture that. And as you said, we cannot overestimate the role that ESG rating agencies, ESG data providers, as we call them, play. But they really fail to capture that. And demand for their services is booming, right? As sustainability gets higher on the agenda of the financial sector, due to increased consumer demand, but also due to increased regulation, the sustainable finance regulations that are rolled out in the European Union. And there are some real fundamental problems. So that's why recently the European Securities and Markets Authority has sent a letter to the European Commission warning for the unregulated and unsupervised nature of the market for ESG ratings and ESG assessment tools. And similar calls have been made by the Dutch and the French financial markets regulators. So there are a few problems. We see very low correlation between ratings. So for one rating agency, a company may be a leader on their confidential methodology, but for another data provider, the same company may be called a laggard based on their own proprietary confidential methodology. And there's no transparency, there's no scrutiny from organizations, including public health organizations that should be able to see and review and comment on those methodologies. But we should also understand that many of these ESG risk scores really look at risk to investors. So how does poor management of ESG issues by the company translate into financial risk for investors? And that is an important question. It is a question that investors should answer. But it is not the only question that companies are supposed to answer under the UN Guiding Principles, which has a lens on impact to people. So some ESG rating agencies also try to capture that and make an assessment on what the impact of certain business activities is on people. But very remarkably, also in those outcomes, we see that it fails to adequately capture the health impacts of tobacco.
Bronwyn, did you want to come in on this point? What's Tobacco-Free Portfolios doing in this area on ESG methodologies? I mean, what deficiencies do you see?
Yeah, well, look, I think it's just, I mean, there's so many, and I think our job is really to make people aware of these gaps and the fact that you know these gaps exist and that an intense level of scrutiny is required, because unfortunately many products labelled ESG do have tobacco in them. We're seeing many major organisations, as you mentioned, commit to all of these really great initiatives like net zero, yet they still have tobacco in their portfolios, and I suspect they're just unaware of how that's sort of slipping through a methodology that would otherwise be, I think, reasonably assumed to exclude tobacco. But Ruben mentioned several times, he's mentioned the UN Guiding Principles for Business and Human Rights. And I think when we look at that, it's such a great tool, and it relies on these three principles of protect, respect and remedy. And when it comes to the remedy, you know, I'll never forget being at a conference in Geneva for the UN Guiding Principles on Business and Human Rights and asking about, you know, what's happening with remedy and the tobacco industry. So, for example, if we look at the impact on humanity in 2020, what's happened to those 8 million people who died? What's happened to their families? Where's the remedy going on? And of course, there was just silence at this conference because there's nothing happening there. There is no remedy. There's nothing. There's no compensation. There is, and even worse, there's no further prevention that this isn't just going to continue going on and on and on. In 2017, the Danish Institute of Human Rights used the UN Guiding Principles to assess the human rights impact of one of the world's biggest tobacco companies. And they came out and said, according to those UN Guiding Principles for Business and Human Rights, that this company, it was just irreconcilable. The production and marketing of tobacco was irreconcilable with the human right to life and the human right to health. And they recommended they immediately cease production and marketing of tobacco. Now, of course, that company didn't do that. They're continuing their business today. And I think that this just shows that it's almost like overarching ESG. We need some basic principles. And if your company is not adhering to basic human rights, if your company is making products that contribute directly to the death of consumers and others in the community, then I think we have a problem and we need to rethink these frameworks.
And Bronwyn, tell us, we're seeing many tobacco companies now diversify their product range and move into e-cigarettes or other supposedly less harmful products. What is your view about those? Are they better? And I suppose to Ruben as well, you know, should the financial sector be investing in those instead? Are these positive developments?
I think that overwhelmingly the health sector is extremely concerned about e-cigarettes and heated tobacco products. We know for sure that they're addicting a new generation to nicotine. We know for sure that there is a gateway effect where children and teenagers who were otherwise not destined to smoke are now addicted to those products and more likely to start smoking old-fashioned cigarettes. We're also concerned about re-glamorizing of the act of smoking, something that has sort of become the buzzword in tobacco control is denormalised. We've done very well to denormalise the act of smoking in many, many places, many countries and many settings throughout the world. So overall, we're very concerned about not just the short-term, but the long-term impacts of these products. We're concerned about the way that there has been a massive uptake in children and teenagers. And I know many parents of teenagers who are desperately concerned about how kids, it seems all over the world, have increasingly become hooked to these products when there's no long-term data showing that they're safe at all, and there's very significant health concerns.
Yeah, we fully agree. I think sort of marketing on these products is also primarily geared towards Western societies where smoking has really been denormalized. Like, it is not the approach across the board in many developing countries. And for all the reasons that Bronwyn stated, I think financial institutions should not buy this. ABN AMRO will certainly not change its policies or its non-enforcement strategy. We know that this trend or this approach of the tobacco industry is not just a tool towards consumers, right? It's also a tool towards investors. They try to use this to create like benchmarks to distinguish responsible tobacco companies from slightly less responsible tobacco companies. But it is all marketing and PR based on a number of very, very flawed assumptions. So investors and banks should really not buy these types of benchmarks and stick to exclusion policies.
No, thanks to both. And I know that similar with traditional tobacco products, e-cigarettes and other new products are also associated with significant environmental waste as well. And I wanted to perhaps turn the discussion now onto the environment. Climate change is the topic of this year's Global Ethical Finance Summit. Of course, it's a big issue with COP26 happening just down the road from us in Glasgow in November 2021. And of course, we've seen over the last year, as I mentioned, many finance sector actors make commitments around decarbonising their investment portfolios over the next 2 decades. All of that is wonderful. Tobacco is not really part of that conversation, but should it be, in your view?
Well, certainly in mine, absolutely. I think that, many people are genuinely shocked when they find out that the #1 ocean plastic is cigarette filters. Filters turn into microplastics, so they're not visible. So we're not nearly as aware of that form of plastic compared to plastic bottles or bags or straws. But microplastics enter the food chain and end up, again, having a terrible impact on the environment and on human health. Even if you look at other metrics like deforestation, 5% is the estimated impact. 5% of global deforestation is caused by big tobacco, and that's really just a handful of companies, which is an extraordinary impact for really such a sector that really contributes no good to the world, certainly not in my view. And if you're looking at carbon emissions, so there were some interesting estimates recently that compared the carbon emissions that big tobacco contributes to the world, and they suggest that they're about the same as entire countries. So, for example, about the same as Israel or about the same as Peru. So if we just look at those as just some very basic metrics, going tobacco-free is entirely consistent with any other environmental initiative out there. And we certainly hope that while investors are considering big, game-changing environmental commitments, that tobacco-free is on the table at the same time.
Yeah, and it can be the first thing that is on the table, right? So for some sectors, for the energy sector, which of course has a major responsibility to decarbonize and contribute to a net zero economy, I understand that there is a transition path, and we can debate sort of the speed of that transition and the contributions they would have to make. But they can play a role in that transition. For tobacco companies, like it's the low-hanging fruit for financial institutions. They can implement exclusion policies tomorrow, through that contribute to that net zero ambition, contribute to realization of the SDGs, fulfill their responsibility under the UN guiding principles, and there's no transition discussion in this sector whatsoever, at least not from my perspective.
No, thanks to both, and certainly, you know, that reinforces what I saw from my own work in Zambia a couple of years ago. So I saw how tobacco farmers have a lot of additional labour and environmental costs associated with what they do that they're not compensated for. So, for example, they have to build their own tobacco curing sheds, so they then have to go out to the forest and cut down the trees in order to build the fires that they need to cure those tobacco leaves. So you have scarce agricultural land being used for a crop where there's no nutritional value in a food insecure country, and you also have to destroy additional land in order to produce that crop as well. So, you know, I think a lot of these challenges are not widely understood, I think, by the financial sector. I wanted to, did one of you want to come in there? I wanted to, I read an article recently in the press about how there's an ongoing court case at the High Court in London relating to the alleged exploitation of tobacco farmers in Malawi. And Malawi, of course, is one of Scotland's international development partner countries. So given all of these concerns around tobacco farming, and given all of these concerns around public health, given all these concerns around sort of the regulatory pressures, the tightening pressures around regulation that we're seeing governments implement worldwide, I'm just wondering, Ruben, from your point of view, what do you think might be the continued appeal of investing in tobacco? Do they make financial sense purely from a financial point of view?
I don't know. I'm sure there are studies that suggest it would have a financial impact. I also think there are studies that show that divestment from tobacco does not have a significant financial impact on investment portfolios. But is it the first question you want to answer as a financial institution, right? Because it is one perspective to look at the issue, but the other perspective, the perspective of the UN guiding principles, the impact on people's health, on their life, basically, to me, that's a much more fundamental question. And whatever the outcome of the financial analysis would be, I think the second question is what financial institutions should really answer. And after we've signed the tobacco-free finance pledge, we have organized a roundtable, for example, at ABN AMRO with financial institutions that had not taken the step to become tobacco-free. And surely, you know, these issues are discussed, the financial impact on portfolios. But in the end, many recognize sort of the ethical question, or the responsibility question that is sort of the main thing that financial institutions would have to focus on. And luckily, these roundtables work, right? So after our session, a number of the participants of their institutions became tobacco-free. And that would also be my main advice to financial institutions that consider becoming tobacco-free, right? Reach out to civil society, to public health NGOs, to tobacco-free portfolios, but also to peer financial institutions that have taken that step already.
And I think, can I jump in there and say there is some good news though on the finance front that I think is important for people to be aware of, which is that all of those financial risks that we've mentioned today, they have all converged, and in 2017, that's really when we saw the peak of tobacco share prices, and since then there's been a very dramatic decline that has really departed from the rest of the index. If you have a look, you know, for example, compared to the S&P 500, the S&P Tobacco Index has had a dramatic decline, such that today many tobacco companies are trading at just about 50% of the share price compared to 4 years ago. And the reasons behind that are all still present, the risks are still present and in fact intensifying. So it's not as if we expect some kind of change in the future. The regulations are getting tighter, the litigation risks are pressing, supply chains are being scrutinised, environmental risks are becoming more known, and there's a reputation risk that it just can never be changed. So it's also great to hear some recent reports. So, for example, CalPERS reported in 2020 that, in fact, their tobacco exclusion had led them to be $856 million better off just in the past 4 years. Australian super is 100 million Australian dollars better off. ABP is 700 million euro better off. So we've seen consistent and constant updates on how, in fact, financial institutions have been doing better. So I think that absolutely you can take a very strong ethical position, but also if you really carefully analyse the financial risks, I think that many financial institutions will feel quite comfortable that it is also a very prudent financial decision to go tobacco-free.
No, thanks to both, and there are certainly some very powerful arguments there in favour of implementing tobacco exclusions, and I think we're only likely to see continued momentum around and interest around investing more sustainably and ethically in the future. Certainly, it's a market which is moving incredibly fast and is becoming increasingly mainstream. So there's an offer there from Ruben and Bronwyn here. If you're interested in what it looks like and what it involves in terms of going tobacco free, and you want your questions answered, then I'm sure they will be happy to answer any questions you may have. I think we're out of time today, but I'd like to thank you both for your time and for your insights at this spotlight session on tobacco today. We did discuss the environmental and climate change side. We didn't totally avoid COP26. That's certainly difficult to do this year in Scotland. But as we said, tobacco cuts across all of these issues, doesn't it? But it's great that we were able to discuss such an important topic. So let me thank you both. Thank you to all of you for joining us today. And thank you to the wonderful team at the Global Ethical Finance Initiative for another phenomenal ethical finance summit this year. And we very much look forward to continuing the conversation with you all. Thank you from me. Bye-bye.
Thank you.
Thank you.
Thanks so much, Gail and team. What an intriguing and important mission you have. And we'd all, I know, love to hear more as the project develops. Certainly next year, Ethical Finance 2022, we hope in person, but also this year as the year progresses. But thank you again, all three of you. Now, the demand for the broad range of responsible investment, environmental, ethical, faith-based, green, impact, social, sustainable, and their many cousins, has soared among both private investors, particularly at the top end of the market, and institutions such as pension funds in many countries, driven in part in that case by sterner disclosure standards. Wealth managers, our members, and many others, both frontline and back office, and securities issuers, face a much better informed and more wily client base than even a year ago. Regulations in this field are doubling every few years. As we've heard today, the finance sector has much to offer, exploiting its power and leverage, and there's great profit to be made by agile players, as well as social good in a spirit of enlightened self-interest, one of the themes of the whole Jeffy initiative. But actions are overdue. Finance needs to bridge the understanding gap to avoid preaching to the converted, to stop boxing responsible finance in all its forms as an alternative rather than mainstream. We do need to get back to basics to develop and articulate clear responses to market and regulatory demands rather than fluff up the green marketing. And data, which is now the lifeblood of much financial activity, does need to be coordinated to provide relevant, orderly information to investors, particularly institutions and ultra high net worth private capital owners, the people with lots of money to spend on serious impact investing. There is too much fragmentation, and as we've just heard from Andrew Cave in the session before last, Andrew Cave of Baillie Gifford, he was pretty scathing about the quantity and quality of data on ESG out there right now. It is getting better, but maybe a bit too slowly. These are just my reflections. If there's something you'd like to share or reflect on after hearing our speakers and panelists, remember please to join in the conversation via Twitter. Follow at Finance for Change, Finance numeral 4 Change, using the hashtag Ethical Finance 2021. We'll now have a very short break, as is common in Ethical Finance 2021, before reconvening at 14:25 BST, that's in 5 minutes, for our final session today on the qualities needed from leaders in this pivotal field. Don't miss it. We'll be joined amongst others by Sir Howard Davis, and the Lord Mayor of London. See you soon. Thank you. Hello, I'm George Littlejohn, your host for what is, alas, the final session of Ethical Finance 2021. With more than 90 speakers and panelists and 3,800 delegates from 90 countries, Ethical Finance 21 is a truly global event, a great tribute to the team at Jeffy. Wherever in the world you're joining us from, and whether you're joining us for the first time just now or attended one of our earlier sessions, you are very welcome. Goodness, we've learned a lot today. Almost all wealth managers globally put wealth transfer among their main concerns. A recent big survey of the sector by Refinitiv, the data provider now part of London Stock Exchange Group, revealed that 100% of respondents are putting that in their top 3 worries. As a consequence, the best asset managers, like those we've heard of during Ethical Finance 2021, the best are focusing much effort on the next generation, which takes the climate threat very seriously. It also takes the Sustainable Development Goals very seriously too. At the same time, many grandparents, I speak myself as one, keen to be good ancestors to their grandchildren and that most trusting of relationships, are no slouches when it comes to querying responsible credentials before the great handover. Our speakers this past 3 days from that industry, from banking and asset management, haven't been slouches, but alas, some out there are. Now, most big firms in the field have revised their client segmentation models to take those shifts into account, to make them more customized, rather than retain a straight focus on assets under management. And separately, there's no doubt that the psychological and social shock of the current crisis, the pandemic, seems to be leading to an acceleration in the way people quantify the externalities threat. Economists speak there for the problems being countered by the Sustainable Development Goals. This pandemic is in effect the first systemic ecological crisis in modern times, with immediately visible and profound economic cost. The virus is a classic black swan event in finance speak, an unknown unknown, the greatest of our lifetime. But runaway climate warming is not, and runaway problems with Sustainable Development Goals, the lack of attainment of them, certainly is not. It's a known known. You know, at the end of the First World War, that's the European First World War, and Mark Carney, former governor of the Bank of England, is very keen on this concept. In Britain, we were the victors. In Britain, we planned a country fit for our heroes to live in. So new housing was planned for those heroes coming back from the horrors of the battlefields. But a century later, after this invisible enemy, the pandemic, has been seen off, we want to build a planet fit for our grandchildren to live on. So in this, the third of our 3 sessions today on Beyond Climate, we feature a rather star-studded cast on themes around strategic business and sustainability leadership. If you missed any of our earlier sessions, which are all excellent, then don't worry, as you'll be able to watch them all soon on our EFX platform, which is why I'm delighted we'll examine this whole theme now of leadership in our third and final session of Ethical Finance 2021. The session will last for around 2 hours, beginning with a fascinating talk by a man who ran a successful bank through a bloody war in the Middle East and Syria. Then my dear friend Fahmida B, a lawyer, chair of Norton Rose Fulbright in this time zone, one of the world's biggest firms, and much else besides, will be speaking with Sahar Davis, chairman of NatWest Group and one of the best and one of the wittiest brains in the world of finance. Then we move into the practical realities for steering a course to net zero, before a session with head of Britain's Green Finance Institute and the City of London's Lord Mayor. And then we close on a high note with an interview with Hiromichi Mitsuno from Japan. And wherever you are, remember you can join in our conversation via Twitter by following @Finance4Change, Finance #4Change, and using the hashtag Ethical Finance 2021. Now, let's turn to the first item on our agenda in this leadership session. Only once that I can recall in recent years have I read a book through in one sitting, apart, of course, from his grandchildren. Louis's book, our next speaker, Louis, wrote this great book, Lessons from a War Zone. Now, Louis, it's not the kind of book you'd want to read to small children, but it's gripping and truly excellent. It's his account of running the finance and planning side of the largest bank in Syria, a dreadfully war-torn country, as we all know, when the war broke out 20 long years ago in 2011. Or 10 years ago. On one level, it's his personal story of dealing with the challenges of leading an organization in dangerous and hostile conditions. But it's also a compelling guide for leaders grappling with, amongst other threats, the climate crisis, the challenges to biodiversity, the challenges to other sustainable development goals, the pandemic, and all the rest. The book is packed with universal lessons in resilient leadership in turbulent times, and it shows that any crisis, war, financial health, whatever, shares a similar set of challenges to plan for and overcome, managing risk, building strategy, cutting costs without cutting morale. Louis' resilient leadership proves that whatever disaster we face, the lessons we learn at that time become our most critical and the ones that are going to hold us in good stead for the future. Louis, a great warm welcome to Ethical Finance 2021.
Thanks a lot, George. Pleasure to be here today. So when people hear the word Syria, these are the kind of images that usually come to mind. Sadly, it's been a country defined by the ugly war that has happened. Not to me, though. I know this particular place, and I had seen it in its more glorious past. This is Suq al-Medina in Aleppo. Syria is a country known for its beautiful ancient cities. This is my city, Damascus, which most people agree is the oldest continuously inhabited city in the world, famed across the world for its beautiful crusader castles. And the vibe before the war had started was actually quite positive in many aspects. There was this form of a cultural renaissance across the country. And when the sky did light up at night, it was mostly due to fireworks from all the different cultural festivals that were happening. Economically, things were doing so much better than before. You can see here GDP growing up until 2010, right before the war started. I was a part of the senior management team of the largest privately owned bank in the country, BDSF. And just a couple of months before the unrest began, we had to build a new building and a new financial hub that was being built outside the suburbs of Damascus. And there's a photo of me here with some of the board of director members. Really happy about this new purchase. We had lots of big plans for the bank, and I was really looking forward to my new office in the next coming few months. But that was not to happen. I would stay in my central Damascus office, and this would be my view in the earlier months. And things started becoming worse and worse with more uncertainty, and with that came less visibility, even in the literal sense. So we had political slogans wrapping our entire buildings, which blocked our view and really blocked the view of how we were about to continue with our business. And what would the early sign of a major crisis be? We've seen it in London, but we've seen it everywhere else. Queues. So whereas last year in London, we saw a lot of queues outside of supermarkets. In Syria, we saw them outside of banks. Syria was a cash-based society. People were scared for their money, and people queued outside the banks to withdraw what savings. Usually a queue is a good thing for a business, but a nightmare for banks. Then things started becoming worse and worse. One day we're taking photos outside a branch when it snowed. Other days we took pictures, but for different reasons. And this is our flagship branch in Damascus. And that's when you probably started to see maps of Syria, and then updates from the BBC showing how the fighting was evolving on the ground. To us, though, the map of Syria wasn't just something on the newsreel. It was really the blueprint of our operations. So all of these little blue boxes refer to branches that we had across the country. So increasing colossal challenges on the ground meant increasing difficulties for us to manage our operations and protecting the deposits of our customers. So what do? As we sat there in the board meeting room, me and my colleagues with a giant map of Syria looming behind us, we had lots of questions to answer. How do we face this crisis? Honestly, initially I had no idea. This was something completely new to us. This came almost out of nowhere, and we were just not prepared for it. So initially we were just all over the place, scrambling, unsure how best to handle this. But with a lot of mistakes on the way and a really steep learning curve and lots of trial and error, we found that there were certain principles that that when applied, improve the chances of one thriving and doing good in a crisis, no matter what. So after 4 years of operating and being part of the management team of the largest bank in Syria, what many people think was probably the hardest place in the world to do business in, I decided to write a book and to highlight the principles that I learned working in this crisis. And in this talk, I wanted to share a few of the lessons that I had learned. So people have different kinds of business heroes. My business hero is this Syrian food seller. Just notice all of the different details. Notice how neatly lined up all the oranges are compared to the rubble behind them. Look at the details of the bananas. These are not normal bananas. They're labeled as premium bananas because why would anyone settle for anything else, even in such a war zone? Look how dignified he is, standing there, as if there isn't war in the world, and so casually going on with his life. So for this guy was so bold and able to pursue opportunities no matter what, we probably had no excuse not to. And again, to remind everyone, this was a context that was becoming more and more difficult by the day. So this would be the view of my daily commute every day to my office, random bombs all over the city, and actual damage happening to a lot of our branches. So this would be an image of one of our branches in Damascus. And outside of the capital city, we had the cases where entire branches were being completely rampaged. And again, this very sad, horrendous loss of life and the terrible consequences of the war is just something so sad and so big. And for us as a business, it was so easy to have this feeling of general disbelief wash us away, and to have this narrative dominate the landscape. And no matter how grim it was and how tempting it was to just lose faith and hope, we tried our best to pursue opportunities no matter what, and to find opportunities in places that were probably doing better than other places. So the UK media ran a report during the early years of the war. They were sort of surprised that there were, and they saw people in the souk buying candies and people clinging to normalcy. And what I think people learn now during the pandemic is that during a crisis, people probably cling to normalcy and crave it more. So yes, I mean, life needed to move on. And yes, there was a lot of bad things happening, but that doesn't mean that this would dominate the entire landscape. So when electric power stations were demolished in the country, and many bankers literally saw the dark side of things, we saw maybe an opportunity to finance solar energy. When many withdrawers withdrew their money from banks and turned them into gold, we found an opportunity to maybe bring back part of that wealth in a different form and store them in the bank in the form of a safety deposit boxes. So the overriding idea was not to let the feeling of a pending doom brain in, and to be bold in pursuing opportunities no matter what. Second thing is to build genuine trust with really all of your stakeholders, staff, customers, everyone. So earlier I had showed an image of people queuing outside of banks, but I can assure you that it's a lot scarier when you're viewing it from inside the bank 10 minutes before opening time, when you're in charge of operations. What would we do? Most the other banks decided to impose daily limits, to delay withdrawals, to maybe tell people not to panic. And if someone wanted to withdraw £1,000, they would tell them to withdraw 100 today, 100 next week, and so on. Would we do that? Would we tell the people that not to panic and that everything is going to be all right? Would we really take measures that would probably make our operations a lot easier, but would probably erode confidence in the long run? So we decided to do something completely different. People will panic, and who are we to know something about the crisis that they didn't know? We would not give them a false sense of assurance that the crisis was going away. What we did is that we were accommodating. We may have exaggeratedly maybe stacked our banknotes. We had plenty of money, and we had nothing to hide. We wanted everyone to see that. And I think the fact that we did that and that we simply gave people what they had wanted during a time of a panic, that helped build genuine trust. And what happened is that a few months down the line, banks that had delayed withdrawals, their depositors ended up bringing their cash back to us, which I think is due to the fact that we took measures that instill a genuine trust. And we learned a very key principle. Maybe in normal times, if you try to outsmart people, they might politely decline and say no. But in a crisis, they'll come to hate you. And when it came to something as valuable and as sacred to someone as their lifelong savings, we were not gonna outsmart them. And I think these are the kind of things that build trust in the long run. Same thing with our staff. What's the easiest thing to do in a crisis? Cut costs. It is the easiest thing to do. It is the most tempting route to fulfill targets. It's a lot easier than increasing revenue, than thinking of ways to optimize operations. But we resisted that. It was so easy to get sucked up in that cycle where we're trying to really fulfill year-end targets, year-end metrics that will maybe cause short-term causes for celebration, but what would end up eroding capabilities along the way. Yes, they would maybe save a buck here and there, but these would end up demotivating staff along the way. And we would not divert our energy on saving costs rather than optimizing revenue. People know whether you chose to take the convenient route of just across the board abrupt cost cutting, or more difficult but strategically rewarding routes. We tried our best not to get tempted by that very appealing, the very convenient route, and I think that this is really what builds trust genuinely. So just a couple of examples. sorry. So again, and again, I'm just bringing that slide one more time. If you try to outsmart people, even your staff, all stakeholders involved, normal times they might politely resist. In a crisis, they'll come to hate you. Third thing that I want to talk about: get things done. I mean, just as you can imagine, this was a crisis. We had to do a lot of press releases, a lot of general assemblies, lots of key messaging taking place there. But we knew at the end of the day that it was action that speaks louder than words. So I mean, so just a little history of the bank. It's called Bank Paymo Saudi Faransi, which was formed by Saudi bank and a Lebanese bank. And as you can see here, not a lot of effort was maybe put into the branding. We simply took the name of the Saudi bank, merged it with the logo of the Lebanese Bank Paymo, and we ended up with our logo, Bank Paymo Saudi Faransi. Now imagine, amidst the crisis and all of the challenges happening, our founder, the Saudi Arabian bank, decided out of nowhere, without us knowing, and by the way, my mother found out before I did on the news that they suddenly decided to abandon us. Now, just, I mean, imagine, like, over and above all the colossal challenges that we were facing, the last thing we needed now was an identity dilemma. I mean, three of our four boards almost correspond to that founder's name, and we really worried that this would cause branding and lots of challenges in our identity. But then we realized that, you know what, even something as central as our name didn't matter so much. In a crisis, they say that talk is cheap. And what we learned is that as action becomes harder, talk becomes even cheaper. Your actions and what you do in the crisis define you more than anything else, even your own name. The fact that we were doing what we're meant to do, that we were giving the people what they want, that we were safeguarding their deposits, was 100 times better than having a better name. So it was really better to have an irrelevant name, but have cash for our clients and doing what we're meant to do, than be called the most liquid Syrian bank, but not have any cash. And by the way, I mean, 6 years later, the bank has still kept its name unchanged, even as that main founder did not return back to the bank. And same thing with the staff. I mean, there was lots of fuel shortages in the country. People were finding it really hard to come to work. Less preaching and more actual problem solving mattered to us. So rather than a lot of messaging going out, we actually tried to solve the problem at the root. We brought along lots of buses, and we did take care of transporting staff of everyone every day. And we took a step further. When we had space on the buses, we actually transported staff of other banks as well with us. We had besieged cities. How do you engage and motivate with staff in besieged cities? We launched an online banking simulation game. Nothing would stop us from engaging with staff, not even besiegement of a city. And I do remember talking to the CEO of this Finnish simulation company, telling her that we were in Syria, and we were trying to do this. Initially, he thought someone was maybe pranking him, and that it was a faceless joke, but it wasn't. And I think these things help instill genuine trust. Fourth thing is to be strategic yet very close to the ground. So even if you don't know anything about banking or the geography of Damascus, just by looking at this map, the boxes are branches, and you can see the political context around us. Not easy at all to plan in such situations. So we had an actual challenge initially. Where do we place our backup server? So initially, in the first year, Aleppo was the safest city in Syria, and it made sense to us to place the main server there. But then Aleppo, and this was Aleppo in the planning phase. But then later on, out of nowhere, Aleppo sadly became synonymous with a city known for its very sad destruction, and it turned into the epicenter of the war. So, and we realized that no matter how much we planned, unforeseen things will happen. So how on earth do you run operations in such a context? And with the time, we learned that the main principle was to be very unswerving on the vision, yet very flexible in the tactics. So yes, we were not able to know which branch would be at greatest risk. This was beyond our control. But what we could do, and what was within our control, is to embed very robust continuity plans and operate our branches in such a way where within a very short period of time, we could protect and safeguard our staff, our customers, and our assets. So the key principle was to create a lot of buffers and a lot of alternative channels. The last thing that I wanted to talk about is to be driven by the long term. Now, this might seem like a very cliche thing to say, but it's really key and then really vital, and to focus on your critical success factors. Initially in the war, we had a flawed approach. We were asking, things and questions that we didn't really have control on. When would the war end? Will the US interfere? How will this unfold? And by the way, this was 10 years ago, almost now to the day. And the questions that we had 10 years ago, even today, many of them are still unanswered. But with time, we learned that it was better to actually instead focus on the things that we could control. So rather than asking questions about the war's timeline, we asked what are our critical success factors, i.e., what are the things that we needed to excel at in order to remain competitive, and how are these relevant today, tomorrow, regardless of how long the war takes or how things would evolve. And we realized that yes, war is destructive, and it can and did destroy up to a quarter of our branches. But even the worst war in modern times did not destroy the dynamics of our industry. There were really three basic things that we needed to excel at: trust, liquidity, ability to lend in a competitive way. No matter what happens, no matter the timeline of the war, people trusting in a bank would always be a critical success factor, and maybe more so during a war. So we made sure that we were laser focused in building capacity in these areas over almost everything else, even profitability. Get these right, everything else eventually falls into place. If you don't, almost anything else you do won't matter. And our usual metrics maybe fell behind in the first year or so, but we never allowed year-end targets to hinder us from building capabilities. A few years later, we became the undisputed leader across almost all metrics. And just to wrap up here, if I were to leave one small note, is that the mindset is essential. And no matter how tough it becomes, never allow the feeling of impending doom to reign in. Thanks a lot.
Thank you, Louis. That was indeed a powerful story of how people can survive and indeed thrive in the face of enormous threat and massive upheaval. Here's the book. I would highly recommend it. Lessons from a War Zone, Louis Al-Roumani, available in a good bookstore near you or on your machine from that big store in the sky. Now we turn, thanks Louis, really great, super. Now we turn to rather calmer waters, I hope, with two of the very best brains on the British and indeed the global financial scenes. Sir Howard Davis barely needs introduction. He's now chairman of NatWest Group, and from his early days at the Treasury, the British Finance Ministry, Howard's gone on to serve at the heights of major institutions such as our financial regulator, the then Financial Services Authority, as head of the London School of Economics, at which I know many of you watching this will have studied, and indeed a number of speakers did so, and now at one of Britain's biggest banks, and a great wit to boot. Fahmida B, meanwhile, is a star among stars. Chair of Norton Rose Fulbright, huge law firm, one of the world's leading banking and Islamic finance lawyers. She helped us, the CISI, launch our Islamic finance qualification at London's Mansion House 15 years ago. And since then, Fahmida has been one of our institutes, and indeed many other organizations' biggest supporters, and a great friend. Fahmida, welcome to Ethical Finance 2021.
Thank you, George, for that introduction, and hello, everyone. I'm going to be speaking to Sir Howard Davis today about what leaders can do to drive sustainable business. Sir Howard Davis is the chairman of NatWest Group, formerly RBS, and has led many businesses over his illustrious career, including having been the first chairman of the UK Financial Services Authority, as well as a deputy governor of the Bank of England and a director general of CBI. So he has a great outlook on what it's possible for leaders to do to drive what's important to an organisation as well as corporate culture. Now, Sir Howard, NatWest last year announced that it was going to become a purpose-led bank, and I'm just very interested in understanding how that came about and what it's meant in terms of how it's now doing business differently.
Well, it's quite a story, actually, and we began to think about our future orientation, if you like. I distinguish it from strategy, about almost 2 years ago, and a number of people on the board and in the executive at the time our chief executive was Ross McEwan, began to be interested in the idea of a purpose-led company. And we had a couple of consultants and NGOs come to talk to us about what a consultant-led business would look like. And we have on the board something called our Sustainable Banking Committee, which actually we've had for a few years, but that was the natural place in which to think about this. And we had some people from outside who made some suggestions about sustainable banking, and they were all rather well-intentioned, but the honest truth is that they didn't really inspire the board exactly. And our first couple of attempts to devise a purpose were the classic camels, if you like, the old phrase that camel is a horse designed by a committee, and they were like that. They were deeply unmemorable and probably not actionable in any way at all. And so that was the position we were in. And in fact, also, if we look back, we were doing it in the last year of Ross McEwan's chief executiveship. I mean, we knew that he was planning to leave at the end of 2019. It was all a very well-planned transition. And really, when Alison Rose came in, there'd been a lot of ground clearance done about what a purpose-led strategy might look like. But frankly, we hadn't reached a conclusion. And Alison picked it up and ran with it, and fairly quickly managed to produce a formulation, which is that we champion people helping people, families and businesses to thrive. And we picked that up and then began to turn that into some actionable elements of our future strategy. And the board, by that time, was very comfortable with it because we'd spent a lot of time. So I think the time, as it were, not producing a purpose statement was not wasted, because by the time we had one, we had got our minds around what it meant. And we'd also, I think, particularly realized that it wouldn't make any sense unless you could find a way of sort of actioning it within the business and finding concrete examples of how the purpose strategy would make things different. And so that's been the key focus that Alison has spent her time on, turning a sort of high-flown purpose statement into a set of actual changes in the business that people can understand and get behind.
So has that meant a fundamental difference to how NatWest conducts its business now? Has there been a decision made to focus on certain kinds of customers, not on others, going into certain areas of business, abandoning others, that kind of fundamental transformation, or is it really about messaging?
I think, to be frank, it's probably somewhere between the two. I mean, bluntly, if you are a big clearing bank with 19 million customers, the idea that you can wake up one morning and say, do you know what, we're not going to do any of that, we're going to do something completely different, is, well, that's not realistic. You happen to be a NatWest customer, or whichever clearing bank you are a customer of, and I'm sure you're a customer of one of them in the UK. If you then discovered that they just dropped you a line saying, by the way, we're not providing current accounts anymore, we're not actually doing money transmission, we're not going to operate a payment system, and your credit card won't be functioning, you'd be a little bit disappointed probably. So realistically, the core of the business has to remain responsive to our clients. But it's not just messaging, because in a number of areas we have decided to make quite material changes to our business. One of them is obviously climate, and maybe we'll come on to talk a bit more about that in a bit more detail later. But we've made some very significant climate commitments which are consistent with our purpose. But also we have begun work, well, more than begun work, we've got quite a long way in looking at our customers in quite a different way and looking at their life cycles, if you like, and saying, how do we orient ourselves to address the financial needs of our customers through their lifetimes? And so be much more relationship focused rather than transactional focused. And that has meant doing things like pushing financial health checks out through our networks, where if you go into a NatWest branch, you'll be asked, rather than trying to sell you just a credit card or an extension to your mortgage, you'll be invited to go through with one of our people a structured approach to thinking about what your financial needs really are. And you might leave the branch discovering that your financial needs are not the ones you thought they were when you walked in. So there's quite a lot of examples of how we are reorienting the way in which we deal with our customers in a manner that is consistent with our purpose. Now, I don't diminish the fact that there is some messaging in there as well, but it's not just messaging. It actually is about the way we interact with our customers and the types of products and transactions that we are going to do with them.
You said that the 2 years that the board spent thinking about this before coming up with a final strategy were helpful in terms of deciding what was needed. Having been involved in a number of other boards as well, do you conclude that a change like this can be brought about by a leadership? Or do you think an institution has to go through sort of a fundamental change, like the global financial crisis, like the pandemic at the moment, in order to sit back and think we need to do things differently going forward?
I think it can be brought about by leadership, and I think the example of NatWest does demonstrate the truth of that. If you like, the RBS, as we were until a year or so ago, went through well, I wouldn't even say it was a near-death experience. It was sort of a death experience, actually, not in the sense that in 2008, had the bank not been bailed out by the government, it would have folded up. It was unable to fund itself in September 2008. Now, in those circumstances, you might say, well, that's a good example of how you reorganize a purpose, and that would have been a catalyst for a completely new purpose. But actually, the task for the first few years after the crisis was a really much more basic one, which was to get the business back into a position where it could survive on its own 2 feet. And that involved getting rid of a lot of businesses all around the world, which were simply not viable. It involved getting out of a lot of very complicated structured transactions, which had embedded in them huge financial losses. And so for quite some time, although the bank, did talk about its strategic approach was to get back to a position in which it might be viable, because at the time it was not. And as you may recall, it recorded the largest ever corporate loss in the UK and all of that. So really, in our case, I think it wasn't until we had got the business back into a viable state and had begun to pay dividends again, so that we were standing on our own 2 feet, we were actually remunerating our shareholders. It was really only then that I think we had the freedom, if you like, to determine a new strategy for ourselves. I fear that had the bank come out with a purpose statement in 2009-10, the response in the public would have been, well, that's all very well, but one purpose you might have is to get yourself to be at least viable and profitable and give us a little bit of money for our investment. I think that there would have been a deep degree of cynicism had we tried to come out with that kind of statement 10 years ago. I just think it would not have been believed and would probably have set us back quite a long way. So in a way, the decision to go for the purpose was a sign that we felt we were now a normal bank, and people that wouldn't be allowed raspberry across the country if we came out with a purpose statement of this sort. And there wasn't. So we judged it correctly, I think, at that point. But so in our case, it was leadership driven, and it was not as a result of some major discontinuity, because we'd had that a decade before, and that was so bad that it couldn't really plausibly have led to a new purpose statement at that point.
And yet, so many organizations right now are going through a fundamental reconsideration, I think, of what their purpose is, what their obligations are to the communities, to their employees as a result of the pandemic that we're living through. And so this is, in a way, the time for those organizations to have a look at what they can do as responsible businesses. I was very struck about what must have been in the water in 2019, because not only was an organization like RBS thinking about purpose, but the US Business Roundtable, as I'm sure you'll recall, issued a statement about the purpose of a corporation being not just responsibility to shareholders, but also to customers, to employees, and to the community more generally. So, I mean, that was a pre-pandemic statement, and yet that kind of sentiment is very much in the air at the moment. Do you see NatWest sort of having created a trend now that is likely to be followed certainly by other financial institutions or UK businesses?
Well, I wouldn't want to give us the credit for creating a trend, though I think we're a fairly early mover. We're not the first mover in this area. And as you say, in the States, there's been quite a lot of movement in this area. I mean, Larry Fink has been very prominent. And in the UK, of course, there are companies like Unilever who talked this kind of language for the last 3 or 4 years, probably, maybe even longer. And so I would claim that we are an early mover or a fast follower, if you like, rather than people who are inventing something completely radically different. But I think in the banking sector, we are reasonably well positioned. All banks are struggling with the same sorts of issues in relation to their communities, whether it's financing climate change and getting out of financing bad things on the one hand, or whether it's coping with the problems of the shifting ways in which people do banking, and therefore the decline of the branch network. But that becomes a very emotive subject in particular communities if when you close a branch. So we're all coping with the same kinds of pressures, but I think we're doing them in somewhat different ways, as is appropriate in a competitive marketplace. So, we would hope as well that this would be over time a competitive advantage for us, but it's probably too early to claim that yet.
And yet, if you go into the market and you make a statement about purpose, people in the market are then very quick to point to where there be potential conflict. So, for example, branch closures or having we've been touching on climate change without really addressing it, but having clients who, for example, are contributing to carbon emissions. When it comes to potential accusations of rhetoric versus reality, how do you as an institution balance that? Do you sort of decide that there has to be an element of pragmatism, or does it mean taking a very firm position on some of those issues? Do you give up certain clients, for example? Do you keep unprofitable branches open?
The answer to both of those, I think, is in some cases, yes. I mean, I think that the different thing about being a bank as opposed to being a manufacturer or whatever is that almost all of what you do, and this is true in climate change, is really through somebody else. Making a bank climate neutral is bluntly not that difficult a thing, because we just employ a bunch of people with a set of bits of IT and a few buildings, and that is quite a straightforward thing to make carbon neutral. The key thing is, of course, how our financing affects the climate through the people we lend money to. So we're operating at one remove, if you like. And similarly, actually, frankly, the way branches work, I mean, we are responding to changing customer patterns. And so quite a lot of the branch closures of us and ours and other branches are because, the footfall has gone away. In a lot of cases, it's that a big out-of-town shopping centre has been built and the high street has kind of deteriorated to the point where people are not going there to do any significant transactions. There's a tattoo parlour and a couple of charity shops and possibly one branch of one bank clinging on, but where the footfall is elsewhere. So often the branch is not that we are closing branches in order to stimulate change in that community. We're responding. So we're usually behind the curve, frankly, because we are responding to customer needs. So the difficult thing for us is to ensure that we are providing what our customers want when they want it, and explaining how we are responding to changing patterns. So I think that's really how we think about the branch issue. The huge majority of our transactions now are carried out in a digital form. Very, very few require physical presence in branches, although the branches do have some utility in providing advice services and that kind of thing, financial health checks, as I mentioned. In the case of climate change, I think there is a balance to be struck there. And I think that banks are going to be taking a more active role in the future than they have in the past. And that's partly because it's what we think is the right thing to do, but it's also partly because the Bank of England and the regulators, and this is true in other countries as well, are saying, look, this is not just this is not just a welfare question, it's also a financial stability question. And that if you are lending to a lot of companies who are assuming that they can use assets in the ground, I mean, to make it simplest, you know, you're lending to an oil company and it's secured on reserves of oil in the ground. And if it's not possible for them to extract that oil and use it because that's incompatible with legislated commitments on net zero, then what's the value of your collateral exactly? Therefore, you know, you're going to find yourself losing a lot of money, and the financial markets are going to be significantly disrupted. So we've got the central bank coming at us from that angle and saying, just a minute, you know, you need to look at the riskiness of your portfolio because some of what you think is collateral is not going to be helpful to you when you come to get that loan repaid. And then also, of course, we have our customers who are increasingly concerned about climate change and wants to see businesses acting in a forward-looking way. Now, the way we've rationalized all of that is to say, essentially, well, we've got some specific commitments on coal and oil and things like that, but that we have said that we will, in future, want only to do business with people who are either climate neutral themselves or who have a plausible transition plan which is compatible with the targets that the government and the various COPs have set out. So we want to see for oil companies that they have a transition plan that is compatible with the Paris commitments. Now, that will probably change as well as commitments change, as COP26 probably will develop further commitments. So we will have to adjust and adapt those. But we have been quite active, I think, in going to clients and saying, you know, you need a transition plan or we're not going to be able to do business with you as we have done in the past. And that's partly our decision, but also with, frankly, some pressure from the regulators too.
Well, can I ask how customers broadly, I guess, not just those affected customers, how customers and shareholders have responded to the change in purpose or the focus on a purpose-driven business?
Yes. Well, take shareholders. Of course, most of our shareholders are institutional shareholders, or in our case, unusually, the government. But the government have, take a rather hands-off approach. You know, they have made it clear that they are, want to sell their stock, and so they don't actively drive our strategy. And most of the institutional shareholders have got strong ESG focuses now, and they are quite keen to know what our approach is. And I think that's partly because some of them feel that they need to respond to the pensioners and the individuals on whose money they are managing, but also I think because they have themselves recognised this financial stability point, and that they don't particularly want to own shares in companies whose business model is going to be fundamentally invalidated by climate change commitments, whether by regulatory commitments or indeed by just the physical impact of climate change on them. So we get quite a lot of pressure from shareholders but of course the shareholders, they're not terribly specific about what they want. They come and say, what are your climate change commitments? What are your climate change plans, etc.? And they want to see that you have thought about it and adapted the principles to your business. So yes, there's pressure from shareholders, but it's not do this, do that type of pressure. It's questioning as to what our strategy is. Now, individual customers, of course, it's more difficult to get an idea of what they actually think. I mean, you can look at overall opinion polls, because if you've got 19 million customers, you know, you're pretty broadly spread across the country, and I'm sure you can find people among that 19 million with every possible view on climate change, you know, from some deniers at one end of the spectrum to some Extinction Rebellion people at the other end of the spectrum. So I think it's probably difficult to say what our retail customers think. The only indications we might have there are whether they are interested in things like green mortgages, and increasingly that is the case, although it's still relatively small at the moment. But you know, so you can get some indication, but overall, I think it would be tough to say what our retail, you know, customers really think about climate change beyond, as I say, the national opinion polls, which suggest that there's been quite a significant move of public opinion towards believing that climate change is A, at least very significantly man-made, and B, that it is a very significant threat to our way of life. So I think, you know, you've got a receptive audience in the population as a whole, albeit, you know, there's still a range of views, I'm quite sure. As for business customers, well, business customers are pretty interested. I mean, I don't think that we've had any really firm pushback. I mean, I have not had a single letter from a corporate customer saying, what the hell are you doing asking us for a transition plan? You know, I mean, you just don't get that kind of resistance, because most businesses can see that this is coming down the track. And if they think they're not going to be able to buy a diesel van from 2030 onwards, you know, they're starting to think about the electrification of their fleet. And if, you know, so it's not something where we're getting a resistance. Now, I'm sure in detail, when we get to the point of saying, well, is this a credible transition plan? I'm sure we will find some disagreements. It'd be odd if we didn't. But I think most of our corporate clients are moving in pretty much the same direction at the moment.
You talked about ESG being particularly important to institutional investors at the moment, and indeed it's becoming important to financial institutions very generally. NatWest produced its ESG supplement this year to set out in a transparent way the approach that it's taking. Was that something that needed a lot of thinking? Is that going to be a normal part of how you progress going forward? And you know, have customers, clients liked seeing that kind of information?
Customers and clients, well, I wonder how many, you know, this seems an odd thing to say, but I mean, I just wonder how many customers really digest that terribly well. And your first part of the question was, did we spend a lot of time on it? Yes, we did. And the audit committee you know, went through it in great detail. Do we think it's ideally constructed for informing customers and shareholders? Well, the ESG parts of our big shareholders, I'm sure, understand it, but it is quite complicated. And that's because at the moment, there is not a global agreement on what kind of disclosures in this area make sense. You know, you've got a whole range of different things. The World Economic Forum has produced stuff. There's something called GRI, which has produced stuff. There's the Sustainability Accounting Standards Board. Now the International Accounting Standards Board have issued a consultation paper, which I was involved actually, on how they might integrate sustainability reporting into international accounting standards. There's the Task Force on Carbon Disclosures, which has been promoted by the Financial Stability Board. And there are a whole range of different disclosure templates, if you like. And we've attempted to meet as many of them as we can, because at the moment, it's a little bit difficult to know which horse will win this race, and become the global standard, if you like. But, do I think that we've got something which is really snappy and comprehensible and allows people to compare and contrast banks effectively? My honest answer to that would be not yet, because, but I think that's more or less inevitable. It's difficult for one bank to say, well, we're just going to ignore this SASB stuff, or we're just going to ignore the TCFD, because there are different stakeholders who want you to report in these different ways. So I'm hoping that over the next 3 or 4 years, probably, we will get to a more standardized and more meaningful set of disclosures, so, as we have done in the financial accounting area. And I think it's on the way. I think IASB will be the driver of it, and we would certainly welcome that.
We started our discussion talking about whether leadership can drive sort of sustainable change like this, and you talked about the role that Alison Rose had in creating the purpose-led mission of the bank. Has that sort of focus on purpose now changed the board's approach to what you need from top management? Are you looking for different skills, a different approach to how to run the business in terms of the senior executives in the business as a whole?
Well, one thing we have done, which has changed the way they relate to the board, is that we've altered our board papers structure. I mean, it's a banal point, but a significant one, I think, so that when executives bring papers to us, they have to say how this is compatible with our purpose, and how they have thought about the decision in a purpose-led way. So they are required to do that, and we do ask questions about that, and that has changed the decision making. Now, it follows from that people who come into the bank would need to be prepared to operate in that kind of framework, and that will therefore drive the sort of people whom we appoint. And I think we have a couple of examples already of people who have been attracted to come to the bank because of the purpose statement and Alison Rose's enthusiasm about it. So I think over time you do get the people who want to work in the way you want to work. And anyone who's joining the bank now understands that they're going to have to work within this purpose framework and understand that their business will be oriented in that way. So I think it happens. Now, whether we've, you ask a good question, have we kind of changed our person specifications, if you like? I'm not sure we quite have done that, but I think what we have done is to set out very clearly how the bank will operate in the future, and therefore that drives the kind of people who are interested, frankly. So I think it's been that way round, rather than our saying we want purpose-led bankers. They haven't quite done that.
And as a last question, can I ask you, are you surprised at the speed of change on this issue? It feels like in the last 3 years or so, this is looking broadly at responsible business and across the ESG spectrum. This has become increasingly and quite quickly important to business, when for many years before that it was a nice to have that sort of sat in the background.
Yeah, in a way, I am a little bit surprised, and I think it's probably appropriate to admit that, particularly how even the COVID crisis and the increase in unemployment and the economic financial pressures that's put a lot of people under, I don't think that has made any difference to the attitude to climate change, for example, or indeed to purpose-led business in a broader sense. And I think one might have wondered whether it would, whether people would by now be saying, well, it's all very well, all this purpose-led stuff, but I want a job, and I'm short of cash, and that but I don't think that's how. It's not that people are not concerned by unemployment. Of course they are, but I don't think it's dominated the other agenda in the way that it might have done. And there have been times in the past, I think, when, you know, once unemployment rises above a certain level, it's all people want to talk about. And that's not been the case, actually. I think people have recognized that the long-term challenges of business and society linked to the long-term challenges of climate change mean that this is not an optional agenda, you know, which you can kind of pick up for a while when things are good and drop when things are bad. I think that's gone. I think this is now mainstream and is going to stay so.
Well, on that sort of uplifting message, Sahad, let me say thank you to you for this really interesting discussion. And I'm sure we've all taken a huge amount away from it. Thank you.
Thank you.
Fahmida and Sahad, thank you. And what a rare set of insights into top-level strategic thinking in a major institution. It's very rare that one gets this kind of look inside the brain, frankly, of a major leader. Fascinating, and we are indeed privileged. Thank you both for giving up your time for us. And it's always said that you can trust a man or a woman who's got a line of wisdoms behind him or her in his bookshelf. Wisdoms for the benefit of people who don't visit Britain too often, as the annual Cricket Almanac, a yellow-covered book, which is evidence of right thinking in many people's minds. So thank you both, tremendous. Now, Alan, welcome. I rather suspect Alan Watt, Senior Advisor to Jeffy, is a man who also has Cricket Almanacs or similar. Alan has wide experience in the public, private and voluntary sectors in the UK and overseas. He's been UK Chief Executive and also Scotland Director for the Prince's Trust. This is the trust, very large trust set up by the Prince of Wales many years ago, which helps young people into work or education and provides microfinance and startup mentoring. Alan also spent 13 years at RBS, which is now, of course, Sahad's NatWest. There he had responsibility for communications, sponsorship, marketing, CSR activities in Edinburgh-based roles, global roles, and for 3 years in Hong Kong as a member of the RBS Asia Pacific Executive Management Team. This included work on affordable finance, lending in disadvantaged areas, and impact investing. It's been a great pleasure to work with Alan since he joined Jeffy as a senior advisor. So Alan, over to you.
So thank you, George. Now we have an opportunity to look at leadership in a very different sector, which is right at the heart of the green transition. I'm delighted we've been able to bring together two major leaders from the energy sector. Vivian Yeda-Apopo has been the Director General of the East African Development Bank since January 2009 and was appointed as the new Chairman of the Board at Kenya Power in 2020. She's an experienced banker and lawyer with over 20 years practical and comprehensive experience in banking and financial solutions in Africa. She has a long track record in devising projects in public and private sector, and she's negotiated and structured facilities for sovereign borrowers and many projects in the private sector. She was recognised in 2014 as African Banker of the Year. Kenya Power is an essential driver of development in Kenya, with a push to bring electricity to 100% of the population, and is already well down the track on renewable energy, with over 90% supplied from non-thermal sources. Keith Anderson is Chief Executive of Scottish Power, and he also sits on the Scottish Power Board, where he was appointed in February 2012. Scottish Power is already providing 100% green energy, and Keith has full responsibility for the company's activities in the UK, including the recent commitment to invest £10 billion in the UK to help unlock net zero by 2025. Scottish Power is also a business sponsor of COP26, which will be hosted in the home city of Scottish Power's home city of Glasgow in November later this year. Keith is a member of the UK's Government Investment Trade Advisory Group, and he's a COP26 business leader. And in January 21, he became chair of CBI Scotland. Like Vivian, Keith started his career in financial institutions, and prior to joining Scottish Power, he worked with RBS, Standard Life and Ernst & Young. So, as an opening question on leadership, the pandemic has challenged everyone. And Keith, you've been leading Scottish Power right through the pandemic. What's been the most difficult leadership challenge you've faced since the start of 2020?
Yeah, gee whiz, what a question. I don't, you know, a lot of stuff just happened and clicked into place really, really quickly, which I suppose as a, as a leader of any company, it doesn't matter whether you're big or small, is really pleasing to see. So, I mean, I think most people probably, if you'd said to them 2 years ago, by the way, something's going to come along and all of a sudden you're sending half your staff home, you would just assume it would be complete bedlam and chaos. And actually, I think because we're a real clear purpose as a company, a very clear purpose as an organization, we've got a very clear purpose in terms of, what we're here to do as a company, i.e. we keep the lights on, we keep the power flowing. That actually really helps to galvanize people, and so everybody kind of just got into the mode of, right, we need to keep the lights on, and it doesn't matter where you are, how you're working, what you're doing, we're just going to keep the lights on. And I think that helped get through the sort of drama of sending people home and the drama of getting everybody a laptop, etc. So that was great. I think actually probably the biggest challenge comes way after that, which is how do you keep operating in business continuity mode? Because for most people, your business continuity plan and your emergency plans they're designed for being a short period of time. And in essence, we've been working in business continuity mode for 18 months. And the challenge is really now about how do you keep people motivated? How do you keep people focused? How do you keep people learning? How do you keep collaboration going? How do you keep innovation going? How do you keep communication going? I mean, you think about it, I can't help but constantly feel sorry for the people who've joined our company in the last 6 months and they've not met anyone face to face. And that's just, it's bonkers. Those are the difficult things, and those are where the real challenges are in keeping people going. And the hope now is that in the next month to 2 months, we can start bringing much more people back into a building. We can get people working together, and that's really what's giving people hope, hope and focus now. But it's those challenges, it's those people challenges about the way you work, because we're designed to be a community, not to be remote. And our work's designed to be done by a community, not by remote people. So that's the biggest bit about the biggest problem.
So Vivian, you, I believe, took over as chair just as the pandemic was really starting to get a grip in July last year. So what was your experience of coming into an organization as a new leader?
Yeah, thank you. I think that was variously interesting and challenging and hair-raising at the same time. Because coming into a utility the size of Kenya Power, with 12,000 staff in the middle of a pandemic, and with various operational challenges, but also social and personal challenges for the individual staff. So it was quite an interesting period where we had to keep operationally efficient and keep the lights on and do what we're supposed to do. But at the same time, continue planning for the next day and the next week. And given the challenges we had in our region where we had several periods of complete lockdowns, there were also logistical challenges that we had to address. And then we had major situations with some of our clients who obviously during the lockdown period, not able to pay their bills because the businesses are closed and generally operating in a very difficult business climate. So we've had to juggle a number of balls in the air at the same time, to keep the operations running, keep the businesses going, keep our supply chains open, which again is a big challenge with the global situation, getting equipment in, materials and supplies in on time. In the situation of a lockdown, that again became a serious problem. But I'd like to say that in the 6 months since then, I think we've learned to plan well, plan better, plan ahead, be resilient. The staff at an individual level have been very, very innovative and making the best that they can in whatever situation they are. And we've kept the lights on. and that has been very important.
Yeah, and Vivian, when we spoke earlier, I know that in your role at the East African Development Bank, you were very committed to the idea of planet, people and profit in the work that you did in the Development Bank. What's been your experience of bringing that approach into Kenya Power and applying some of that as we emerge from the pandemic and look at the challenges ahead?
I think the pandemic actually brought into sharp focus the need to actually develop a people, planet and profit approach. Simply because, for the first time, the global economy had to go into a reset. And I think for the first 6 months, we had to analyze our business operations and focus on what was actually important and what was not, and what we could do away with and what we had to improve. So coming to Kenya Power, it became very obvious from the outset that irrespective of the economic, social situation that we found ourselves in, we had to keep the energy supply available. The lights had to keep on because hospitals have to run, schools, when they were open, have to function, water companies that need energy to supply water had to run, so the lights had to remain on, and in as much as we had the difficult challenges. And at the end, our supply chain obviously are people. We're serving people, we're serving customers who need the energy, they need the energy to cook, they need to heat their homes, to heat their water supplies, and generally to live. And because of that, we reoriented our operations to ensure that the very critical sectors of the economy, health in particular, security, transport and logistics was served irrespective of the lockdown situation, so that the society and the community could continue to function. Those who could manage their small businesses from home, or those that were in sectors that had to continue running their businesses, like the supermarkets and the markets and the like, had to continue operating. So we really put a lot of initiative and effort in those areas where we needed to provide the support so that the economy could run and communities could continue to function. So that's really been a very heavy focus on people, and also making sure that even those, in some of those sectors, the bills could not be paid because people were not working and they were not. We had to find a formula and a package which could allow them to pay in installments over time, so that we still continue to supply them with the energy, but they would go into a payment plan.
Yeah, and so just very clear sort of thread through both of your both discussions there in terms of purpose and just this absolute central role of keeping the lights on, which must be a great galvanizer across the organisation. Obviously, the pandemic was forced on us and we had no choice about making a shift and changing the way we operate. But Keith, you made the journey from Scottish Power Renewables to running the whole group. And in some ways there might be parallels with, I think, what a lot of financial institutions are now seeing, which is sustainable finance used to be part of an organisation. It's now become the mainstream. And I think, a lot of organisations might learn from that. What did you learn in making that shift, and how did you set a culture and a tone in the whole organisation, to commit to 100% green energy and make those difficult decisions?
I think it is about so you use that word sustainability, and I think people's definition and use of the word sustainability has changed and is continuing to change. I think when people used to talk about sustainability, they just talked about it being green. Slap a green sticker on it and you'll be sustainable, don't you worry about it. And to some extent, life was made a little bit easier for us than some other companies, and that there was a move and an incentive to start looking at building wind farms. There you go, tick in the box. We're sustainable. We build wind farms. What more do you want me to do? But our view, and I think, as I say, the world's view is moving on. That's not being sustainable. That's doing some good things and some sensible things. You need to have a sustainable business model. So you need to build a business model that says your company is still going to be here in 30 years' time, in 50 years' time, in 100 years' time. Is it truly sustainable? Can you truly carry on doing what you do? And that was really what set the tone for us as a company when we did that quite a number of years ago. And our view very clearly, very quickly became, actually burning coal and burning gas is not sustainable. The world cannot sustain that, so this has to change. And it's then about getting your mindset into, so how do you go about making the change, and how do you create an opportunity out of it, as opposed to looking at it as a challenge and a downside. And that's been the biggest trick and the biggest challenge for us, is going into it with that mindset and that approach. And I can quite clearly now, and we do this with our investors and with governments, we can quite clearly sit and look at Scottish Power, look at the Iberdrola group as well, and you can track the value and the success of our company with making that change, and making that change in mindset about going after this as an opportunity. And I still believe today, if working with governments and regulators, you get the right regulatory framework, the right competitive framework, the right incentive mechanisms put in place, then investors win, manufacturers win, the citizens of the country win because you create jobs and you create training opportunities, and customers win because you end up delivering cheaper energy for the future of the country, and the country wins and the planet wins because you end up getting rid of pollution, you end up decarbonising, and you end up tackling climate change. And if you look at all of those things, you end up with this brilliant win-win-win. And it's about that conversation. How do you create that structure? How do you create those incentives? And I think, being in the UK's done it well. We've created some of those incentive mechanisms in the early stage. We've created a good balance between regulation and competition. We've encouraged innovation. We've encouraged the investment. We've driven down the cost. We're creating the jobs. And so people are starting to see the win-win-win. And I think one of the greatest accolades you could give the renewable sector or the offshore sector in the UK right now is you've now got BP, Shell, Equinor queuing up to invest in the future of renewables, because they believe in it now as well. What bigger stamp of approval could you have that actually people now understand this is the success and it's the future, and people are changing their business model. A great accolade now, I think, you go back 10 years, no investor would have come in to an offshore wind farm project pre-construction.
Yeah.
You look at it now, you've got investment companies queuing up to bid for seabed licenses, let alone a development project, let alone a constructed project. You look now at things like round 4 in the UK, you've got investors queuing up to bid and outbid each other for site licenses. It shows you the investment community, the finance community, the development community, as well as the energy community, have all bought into this future. We all understand it. We all know it works. We all know it's great. And that's now the opportunity for the UK. When you look at things like transport, heat and hydrogen, how do you create that same market and that incentive where you get the investment flooding in, you get the innovation flooding in, you drive down the cost, you get the competition, and you get the benefit for all, and you just keep repeating that cycle. And that's the message we take to all of the other countries we work in. Get that right, get that framework right, and you'll see the investment flood through. I mean, it sounds easy, it's not easy, it's a difficult thing to do, but you do that. And part of it is about the government setting the ambition. And I know people often say to politicians or to governments, setting the target's easy. The difficult bit, delivering it. Well, setting the targets isn't actually that easy. And you need a government to show the ambition and show the target and show the size of the prize, because that's what allows the investment to come through. That's what builds the confidence. So it's a mixture of a whole load of things, but it's worked, it's working. And I can hand on heart say absolutely 100%. We did the right thing 25 years ago when we started building wind farms, and I'll stand here today and I'll tell you we'll still be building them 25 years from now, and we'll still be operating them 25 years from now. It's been a fantastic transition and the right thing to do.
So, I mean, obviously it's nice to sort of you're at chapter 3 or 4 already. But, you know, sitting down with a blank page, it is really hard. And maybe Vivian, it must be really tough, I suppose, where you're still looking at getting electricity to 100% of the population and balancing, you know, that against renewables and taking some of those difficult decisions. What's the, you know, in terms of the finance community and looking at the lenders into the sector for you, what are they pushing you to do? Are they looking for a renewable company, or are they just looking, you know, to see a profitable company? What's the appetite of the finance sector?
So I think the appetite for the finance sector is to see both. Obviously, a profitable company is a good partner to them, so that's important. And obviously, they also want to tick the right boxes. So a company that's focused on renewable investments is also something they want to see. So I think we tick both boxes so far, and that's well. I think the challenge we have in terms of getting to 100% of electricity to all in the country and in the region is that we have the energy and we have the investments and we do have the supply. The challenge is putting in the grid network that would enable us to reach the most remote or those who are not already on the grid. So there's sort of massive investment that has into the grid network and ensuring that it's efficient and it works and it doesn't develop a buildup of costs. The other very, very significant challenge for us that goes hand in hand in that is obviously the cost of the energy, because a lot of the renewables are developed by independent power producers, and they have made investments into the sector, and the cost of that investment plus a margin is passed through in a tariff, which obviously has to be paid for. So the cost issue is very, very challenging, I think, more than anything else. We have the energy, we have the means, so we can try and have the means to have a very reliable grid infrastructure, but the cost of that energy is a big challenge that we're facing now.
That's quite an interesting thing to bring up, because I mean, I know in the UK there's just been, I think is it called the Rio settlement, Keith, and in terms of you know, that burden of sharing the burden of investment between shareholders and customers, and you know, Vivian, you know, how does that work in Kenya? You know, sharing that burden of that huge investment that's needed between the customers and the shareholders in the company.
I think that the way the tariff structure has been put together, it would appear that yes, there is that burden sharing, but the bulk of it is borne by the customer through the tariff.
Yeah.
And apart from the normal cost plus margin, which gets passed on, but there are other costs like the fuel costs and costs of funding, where the finance costs come in. And then there are obviously exchange loss risks, which also get passed on to the tariff to the client. So that whole build-up of costs which are passed through do have an effect on the cost of energy to the ultimate consumer.
Yeah.
I think, sorry, Alan. I think Vivian said a couple of really important things, and this is there's no magic answer to any of this, but it is the balance between what you do through a regulatory mechanism and what you do through a competitive tariff mechanism is absolutely critical and crucial. And how do you shift and move from one to another? To encourage the investment, to control the cost, to control the impact on consumer, but to still get the level of investment and the level of innovation down. And that balance and that mixture is incredibly difficult to get it right. You know, and in the UK in the past, it's been skewed one way or the other. And, you know, and you've seen accusations of people making too much money and too high a rate of return, and the cost burden on the consumer being too high. And it is a difficult thing to get right. And it has to transition as the system transitions as well. So you need to keep changing the mechanism, despite investors telling you, no, you can't change it. We need certainty. How dare you change the mechanism? But it needs to adapt and evolve as you go through the process. And I think the other critical thing Vivian touched on as well is grid. And this doesn't matter whether you're in a country that has a developed grid system or whether you're in a country where the grid system doesn't reach everybody yet. You're going to turn it inside out and upside down because the grid system you've got wasn't designed to do what we're going to do to it. And it's critical to everything. It's critical to be able to get the power to the people. It's critical to be able to get the power from the energy source. And it's critical that it can cope with all the changes and the fluctuations as you continue to decarbonise. And that's the bit 99 times out of 100, the politicians forget all about it because it's kind of hidden and it's a little bit boring and people don't really want to talk about it, but it's crucial. That grid system has to be fit for purpose.
I want to come back to that because I think that's a really important point. But just to finish up, though, clearly things like tariffs, regulatory regimes, incredibly complicated. How well do you think we're doing in taking the public with us and understanding, the scale of that investment, the scale of change on a drive to net zero? I mean, Keith, what's your experience in the UK?
Yeah, no, we don't do a particularly good job at it, it has to be said, in all honesty, because energy becomes such a kind of media political topic around the cost of energy and the bills, and the mechanisms in the industry are incredibly complicated and difficult to explain and break down and explain to people. I think the hope is that that over time people will see that the unit cost of energy ends up becoming cheaper, and that we end up moving to a better, cheaper, more sustainable world. But it is, it's difficult because people talk about, the Committee on Climate Change report talks about the billions of pounds that need to be invested, and so the general public kind of get lost in this, thinking this is horrifically expensive. Yet, we invest billions of pounds in this system already, but you invest a lot of it through a regulatory mechanism that spreads it over the next 40 years. So people don't really see the impact of it. But there are other bits that they do see the impact of that come through. They get their monthly electricity and gas bill, and they see that and they feel it. And how does that relate to what you're telling me, that the cost impact's minimised? It's a complicated world, and we need to keep navigating our way through it. But you need to do it with confidence. You need to do it knowing and being confident that the end result is the one you need, and it's right, and it's the right place to go. And we need to get to a point, again, it doesn't matter what country or how well developed the system is or how far you are down this trajectory or down the journey, you need to get everybody talking in the same language about the future and about how it's going to be a better place. And you need to show them the milestones along the way, and that's where it becomes critical to create the jobs, to create the training opportunities, to create the manufacturing and supply chain opportunities, so that people have belief and they keep getting those belief points all the way through because there will be bumps in the road and there will be problems along the way in doing it. But you need to have those good news stories delivered at the same time, and you need to convert it. The media, in this country, they'll love talking about the cost, and look at what you've done to the cost of electricity, and you put people's bills up. Okay. It's fine, it's true, we need to deal with those things. What's the cost of pollution? What's the benefit? How do you measure the benefit of clean air? How do you measure the benefit of children in Glasgow not having pollution that causes asthma? What number do you want to put against that? And you need to, we need to pull the whole thing together and sell the whole story and bring forward the whole benefit of what we're trying to do.
Yeah, no, it was a very powerful intervention from Sir Partha Dasgupta earlier in the summit, and making exactly that point about paying for the nature that we used. And in terms of in Kenya, Vivian, how taking the public with you on the transformation journey, how successful do you think you've been at explaining what needs to be done to them?
Yes, I think by and large the public is very, very supportive and very, very aware. Mm-hmm. Because obviously we've begun to see, though we may not be the biggest polluters globally, or even Africa being a big polluter, but we began to suffer the effects of climate change by seeing some very drastic changes in weather patterns and flooding, and the seasons really changing. So the climate conversation is very topical, and I think the public understands what needs to be done. The challenge that we've had, obviously, is how do we finance this change? And what does that mean at an individual level? So if you're going to ask me to use electricity to prepare a meal and I cannot afford the cost of that electricity, but I can afford to buy a bag of charcoal, which means a tree gets cut, that becomes a very different discussion. Yeah. So we have the buy-in, but what we need to do is to be able to bring this energy at a price that is actually affordable to the vast majority of the people, and then we'll have crossed that hurdle. So it's a question of the practical reality of what needs to be done at a very individual level to be able to make that change.
And I know that, I mean, obviously financing climate-friendly investments in developing countries is a really important issue, and many developing countries don't have the, the fiscal capability to make these contributions. In terms of global finance, what would you like to see happen, or do you think there are long-term opportunities for the global finance sector in developing countries to make this transition?
Yes. I think that this is an important time. These are times when the whole global community is confronted by certain challenges, and then everybody has to sit down and think about how we resolve them as a global community. So we've just gone through, or we're still going through the COVID pandemic, but we've been able to reason together as an international community and have come up with some protocols that we're all observing. I think for climate change, we've had that conversation, but it has not addressed a very important issue, which is the financing of the initiatives that would bring about that climate change in a reasonably short period of time. Because we all agree and understand that we don't have the luxury of doing this kind of transition over the next 30, 40, 50 years. We all agree we need to do it as soon as possible here and now. And therefore, there are quite a number of initiatives that will have to take place at the same time. And for developing countries, that may not be practical from a financial standpoint. There are decisions that have to be made, particularly for those countries that produce fuel, petroleum. And the conversation would be around what do you do with assets that you are already, you've already invested in and you had hoped to exploit for the next 40, 50 years. So if we're going to abandon that sort of resource and move to another resource, then how does that transition get financed? There would be debt that may have been taken to develop those assets, and that debt needs to be paid. So those are conversations that we must have. We need to find a solution that actually makes it practical for all countries to be able to take at least the minimum that is required to be able to bring about that change. If the cost of funding is another, yes, there is funding, but the question is the cost of it. So if you look at developing countries, the rate at which they borrow, particularly if they're borrowing foreign currency, is extremely high. And if you're going to borrow vast amounts of money to be able to put in place the necessary infrastructure, that will not be practical and that will not be feasible. So we need probably to set up a sort of a fund or a funding mechanism that makes resources available from different organizations or institutions that make it affordable and practical for developing to be able to implement the changes that are necessary.
And, obviously, we've talked about emergency, we've talked about climate change, we've talked about challenge, but there's also opportunities. I mean, if we take the long view, Keith, I think you mentioned, you've set the company up for, a 50, 100-year lifespan, and that's the sort of thing that pension funds want to hear about, is matching long-dated assets and liabilities. And what do you think some of the really big investable opportunities are going to be on the road to net zero? Because it's not all about a cost burden, it's also about creating new opportunities. What do you think the most exciting ones will be?
Yeah, I think we've seen a massive change, and you're seeing a massive change across the investment community now, and you're seeing companies, like our parent group Iberdrola doing green bond issuances, etc. And it's the whole system's starting to move in that direction. I mean, I think there's a massive right now, a colossal wave of interest in investing in onshore wind, offshore wind, and solar technology, because they are now virtually deemed to be bog standard infrastructure assets. So people are very, very, very comfortable about putting money into them, particularly in countries where they think there's a reasonably stable regulatory and political framework. And you see now investors running around chasing, outbidding each other. The trick right now for those kind of assets and in those areas, the trick right now is creating big enough opportunities and big enough pipelines. So a good example in the UK, we held a couple of months back the round 4 site licensing process for offshore wind. And I think there were 6 successful bidders. There were 25 other companies or consortia who were bidding in billions of pounds to build an offshore wind farm in the UK, and there weren't enough projects for them. So where's the money gone?
Yeah,
because the money will just fly off somewhere else or go somewhere else. So so where's round 5 and round 6 and round 7? Otherwise, all of that money will go to projects and across the rest of Europe. It'll go to projects in the Far East. It'll go to projects in America. There's a kind of global race going on to make sure you have a big enough pipeline to create the big enough opportunities to get the investment. The future ones, there's a massive challenge coming up around heat oblique cooling. So from a UK. Sadly enough, and sitting here in Glasgow, we don't really worry too much about the heat. Well, about the cooling system, we worry about heating. But there's a colossal technology challenge there around how do we stop burning gas to heat people's homes? And it's about how you create that market. But that's going to be a massive investment market, both from a technology point of view as well as an asset ownership point of view, trying to do ground source heat pumps, air source heat pumps. There's a massive, and that then becomes a global issue around heating and cooling. There's then a massive potential around hydrogen, and the creation of hydrogen economies that I think investors are incredibly interested in. The issue now is still more around what is it we want to use hydrogen for, and what is the market and how do you create the market, and is it a market around using hydrogen to decarbonize industrial process, or is it a market around using hydrogen to decarbonize difficult transport solutions, like heavy goods vehicles, or is part of the market around actually using it as an alternative to burning gas? But that market has to be formed. But then you can see a colossal wave of interest in technology investment, innovation investment, and then again in assets and investing in assets in the future of that market. They look really, really exciting and promising. The whole area of transport is just colossal. The decarbonisation of transport, be it domestic vehicles all the way through to airplanes, to shipping, etc. And again, how you decarbonise all of that, be it a biofuel, a battery, be it a hydrogen solution. I do always kind of chuckle to myself when people talk about range anxiety and then driving a car from one end of Scotland to the other and they get range anxiety. You get on a plane operated by battery and that's range anxiety. But right now there are just endless opportunities out there, and it's just about how people create the opportunity, create the pipeline, create the right structure to get the investor confidence coming through, and we'll see the investment come in, we'll see the cost drive down.
So just in terms of, obviously that's, in some way, perhaps there's good news for you there, Vivian, that there's money available that they can't spend in Britain. So what do you think some of the big opportunities in Kenya might be for investors as we look, 5, 10, 15 years ahead?
Yes, so that's for sure. I mean, there is a pipeline because obviously we have a backlog of projects that we need to develop, and not just for Kenya, I would speak for East Africa and for Africa. So in terms of opportunities for investment in the energy sector, particularly for renewables, I think that's vast in Africa. Of our geography and our climatic conditions that lend themselves to renewables. So if you're talking about solar or wind or geothermal, there are vast opportunities. I think what I would like to focus on really is that we need to get the structure right for those investments and the pricing right. See, that could be the biggest challenge that we'll have in getting the investment into the continent, and also in ensuring that we are able to reach the targets that have been set. And that may be around probably just creating structures that de-risk or remove the perception, because most often it's a perception, it's not a reality of risk, and that is what drives the price high for the various investments. So I think it's important that we create structures that give the comfort that is necessary, but also that investors come in with an open mind and willing to work within the environment that they are, as long as the regulatory framework is put together, is appropriate and well understood, and that the risks are managed.
Yeah.
But
no, that's
sorry. In terms of the opportunities, investment opportunities, I think that those are vast in terms of employment, in terms of creating small businesses, in terms of value chains, in terms of supply chains. I think this creates a whole new opportunity, to develop those particular markets.
Now, time is up against us, unfortunately, but I know, Keith, you mentioned government, and I think I've heard you say before, what's hydrogen for? And, obviously signalling is really important, so government signal what they want as they move into the long term. Just to wrap up then, what do you think you want from world leaders at COP26? It'd be just really interesting to hear, maybe from a Kenyan perspective or an East African perspective and the UK perspective. What do you want to hear from world leaders as they go into COP, and what would good look like at the end of the COP26 process? Do you want to go first, Keith?
Yeah, look, yeah, absolutely. God, there's so many things that would please. From if I look purely from from a UK perspective, then I think a great outcome for COP for the UK is the UK showing leadership and showing, here's what you can do, here's what we've achieved, looking at the technology, looking at the investment, looking at our route map and the way forward, and then the continuation of setting those frameworks and setting the markets. More widely than the UK, what am I looking for? I think the more we can get world leaders bought into trying to protect the 1.5 degrees, I think that's a fantastic signal, both for the public, but also again for investors and for future confidence. And then I think COP, why is COP important? To me, COP then becomes really, really important, I think, to tackle some of the issues that Vivian has raised and the others have raised about how do we get the investment being spread right across the whole of the world. Okay, so it's great and it's tickety-boo and it's nice for me that investors want to come and invest in the UK and but how is it we get that same level of investor confidence across Africa, across India, the Far East, etc., and spread the investment around the world? And I think that's where a COP can come into its own, by actually looking at how do we pull the investors of the world together, how do we help governments set the right frameworks, how do we help governments show investors that they should have confidence in the future of the framework and the future of investment. And that's where something like a COP can make a colossal difference, a colossal difference on a world stage, as opposed to just setting a nice target for me in the UK. I mean, I want nice targets in the UK, don't get me wrong, but if out of a COP you can set investor confidence for the African continent or for the Indian continent, or you can set confidence for the Far East and for other marketplaces, that really shifts the dial.
Yeah. And Vivian, what would be your sort of ask of world leaders in Glasgow when they meet later this year?
Yes, I think I'll take on board everything that Keith has said. But I'll add on to it the fact that we need to have very realistic and practical conversations. There are conversations around stranded assets. We see there'll be very many in Africa if we actually to endorse the net zero campaign and actually try to achieve it. There will be need to abandon certain industries that are very, very important for the economic and social benefit of Africa. So we need to have a conversation, not just Africa, but other similar natural resource countries. So we need to have that conversation and not just push it to one side, because it's very real. it will be also important to come up with a funding formula as to how we price some of these stranded assets and how we then be able to amortize them over a period of time and how that will be funded. Because if you ask me to shut down an oil well that still has 30 years life in it, you know, we have to have a conversation around that and how then we'll be able to fund the economy without that revenue stream. Because it doesn't mean that there will be savings, of course, in the renewables in terms of quality of life, better air, and that's extremely important. But there's also need to get revenue to actually develop those renewables. So the two are tied together. And so we need to have a conversation about that, how we do that on a global scale. Because net zero is not local. I think net zero is global. Yes. So you get net zero in one pocket and not the other, then it's not net zero. So we need to have a conversation. How do we get to net zero together as a global community, as a global family?
Well, that's an outstanding way, I think, to finish up our conversation. Thank you very much, both Vivian and Keith, for your enthusiasm and your engagement today. It's been a really outstanding contribution to our summit. So thank you.
Alan, Vivian, Keith, another really fascinating insight and very lively insight, and thank you, into how sustainability decisions are being made in real life. You've given us, alongside the previous session with Sahara Davis, a great balanced picture from one large systemically important global bank to major energy providers working very successfully with customers in their own environments on equally important transition projects, literally at grassroots level. Fascinating. Thank you very much indeed. Now we're going to welcome two people, Dr. Rhian Marie Thomas. She is CEO of the Green Finance Institute, an organisation in London backed by the UK government and the City of London Corporation. She spent 20 years in investment and corporate banking, latterly heading up this area at Barclays, and was awarded an OBE in 2019 for services to green banking. Well deserved too. She is meeting Alderman William Russell, who took office as Lord Mayor of the City of London in November 2019, and is serving a double term as a result of the pandemic. Makes it sound like a prison sentence. It's not quite. It's a great honour to be Lord Mayor, and serving in the Mansion House, the grand place opposite the Bank of England, is not like a prison sentence. But he is serving 2 years, at great cost to himself, of course, because of the pandemic. Alderman Russell has over 30 years' experience in the city, including holding senior positions in the national and international banking sectors. William started his career with First Boston before joining Merrill Lynch as an investment banker. He's currently chair of CDAM, a London-based asset management business. Rhian, welcome, and let me pose this question to you both. What are the most important considerations, do you think, looking forward in terms of leading the UK economy and the city into a post-COVID recovery?
Thank you very much, George, for that kind introduction. And thank you so much for inviting me here to say a few words in conversation with the Lord Mayor today. So in response to your question about the considerations, it'll come as no surprise to you that I'm going to emphasise the importance of a green recovery, ensuring that the stimulus measures that are currently being designed are also being designed to accelerate the transition to a resilient, low carbon real economy with an opportunity to create jobs, level up and increase prosperity. I've said it before, but I'll say it again, that there are no pathways, no logical, coherent, high carbon pathways to growth. There weren't before the COVID pandemic, and there certainly aren't anymore. So the pathways to prosperity are exactly those pathways that we need to go down in order to get to a net zero economy. And I would, before passing on to the Lord Mayor, who I know will have many comments to make on this point too, I just wanted to point to a report that came out a couple of months ago by Green New Deal UK, a non-profit group, that they proposed a stimulus programme focused on green and digital infrastructure, research and development, energy and care work. And their research suggested that more than 1.2 million jobs could be created within the next 2 years, and more than 2.7 million jobs during the next decade. And so those would those permanent job losses that we've seen due to COVID, which are, you know, expected to hit a couple of million over the next decade, could all be offset by such a strategy and the right amount of government investment, and be replaced during these vital upcoming recovery years through green and social jobs. And the proposals that were put forward in this report were costed at about 68 billion, which is about a third of the government's total COVID response spend of 190 billion to date. So an encouraging report that I think is very much food for thought. But Lord Mayor, something you and I've spoken about before, and very much interested in your views.
Yeah, absolutely. I mean, look, I think here in the city, you know, we're adjusting to the new norms. We want people to come back safely, but you know, how many times have we heard "Build Back Better"? I'll say it again, and it's out there, and everyone is looking at what we can do. We want to encourage, you know, the innovation within the city, and as you know, the city has a great role to play with the green finance, greening finance, financing green, and you know, I'm very excited about this. And COVID-19 has just highlighted that this is the next big issue, and we've got to do something about it. And I'm absolutely convinced that the city will address it, and we're doing it ourselves, as you know, with our own climate action plan, where we'll be net zero by 2040 within the square mile. But, you know, I can't stress enough how important it is. And look, we had some very big news just in the last 24 hours over you know, over some of the voting at some of the oil companies, which is going to make a big difference as well.
So pleased that you mentioned the city's great ambitions to green the square mile by 2040. As you know, that whole place-based investment and the focus on cities, local authorities, and actually channeling global capital towards local solutions is very much at the heart of our work at the Green Finance Institute, which is going to be even more important as we look to stimulate the recovery nationwide. So this is, you know, the solutions that we need to look for when it's, you know, creating jobs, decarbonising the real economy. These are highly granular, sector by sector solutions where we need to look at how we unblock the barriers to investment. And we do that by bringing stakeholders together to co-create those innovations and the intervention. So not only central government, and not only the finance sector, but also local government and academics and the NGOs and everyone in between that are needed in order for us to really efficiently use public balance sheet to provide those catalytic mechanisms that then support the developments of green technology and the rollout of green solutions. So now is a really exciting time with the launch of the UK Investment Bank to support both regional and local economic growth. And there are such parallels there, obviously, with the Scottish National Investment Bank. So, you know, this is a really exciting time to look at how do we channel more mainstream capital towards these local solutions and use these new public institutions to do that as efficiently as possible. And I think we've got an opportunity to provide a real blueprint here about how, green print maybe I should say, about how we best do this. And that's an opportunity for us in this really important COP year to showcase what a world-class business ecosystem looks like, you know, with the eyes of the world on us.
Yeah, no, I mean, look, Brianne-Marie, you know, you and I agree on most things when it comes to the green agenda, but we do have this ecosystem in the city. And, you know, the number of questions I've been asked about Brexit and what's going to happen, and I just point out there is a unique ecosystem here in the Square Mile, whether it's insurance, whether it's fintech, and now, as you say, green tech, and the whole financing agenda. But also the other thing which I've been saying to people, and I know you agree with me, is the green finance and the biodiversity go hand in hand. We're working on this across the board, and that, you know, whether it's getting involved in the agricultural side, making that better, what we're doing in various ways in backing businesses to help them become more green. I mean, I say, look, I mean, I'm probably the first Lord Mayor that drinks oat milk, you know, but you see the point I'm making, and that is something which is really important, and the ecosystem here in the city is going to help us get there, and whether it's funding the renewables or whatever it is. But also the other point I'll make is that this is critical, coming back to your point about the amounts of money the government's been spending. This is private and public together. And we can't do it on our own, and the government can't do it on their own. And I think that that collaborative nature, and what we've already heard from Rishi when we had that Green Horizon Summit, and he talked about, you know, the green bond, which is going to happen before COP26. And we talked about mandatory TCFD. These are all great things, and everyone's focused on it. You know, as you have said, this is the zero emissions COP, and it's a great moment for not only the City of London, but for the whole of the UK.
I'm quite partial to oat milk as well, so that's another thing we have in common. We're going to have some things to disagree on soon, Lord Mayor. No, I mean, look, London has such a fantastic track record of innovation in green finance and institutional innovation, which I think is really important. So, you know, the UK were the first to come out with the carbon budgets, and the Climate Change Committee is the audit group to oversee that and all the fantastic work they do. And then there was obviously the Green Finance Task Force, the Green Finance Initiative, and now the Green Finance Institute, all of which the City of London Corporation have been closely involved in. And so, and you know, as we're now looking forward, again, I think there's an opportunity for some real leadership around, you know, a race to the top on a taxonomy. So obviously we're at the Institute, we're working closely with the Treasury Department at the moment on how we onshore aspects of the EU taxonomy, tailor it to the needs of the UK, and actually address some of the challenges that have been raised since the work that has started in the EU around transition finance, etc. So I think we've got a real opportunity again to showcase how this could be a real enabling tool for financial services, for industry. And then there are also, you know, really pressing challenges that we're pushing ahead with the education charter around green finance skills. So we've got, I think, 11 or 12 of the main chartered bodies are signed up to ensure that professionals who are working in the financial sector undertake green training as part, green finance training as part of their professional qualification. So again, we're sort of leading the way on that and making sure that that's something that we export and share with partners overseas. And all of this absolutely critical in, you know, this COP year, when it's really bringing together the ambitions, as you say, across public and private sector. The Glasgow Financial Alliance on net zero is obviously something that we are hugely supportive, and you know, the numbers signing up to that from across the financial services obviously increase day by day. So you know, hopefully by the time we get to COP, that is going to be, and the momentum behind that is going to be genuinely tremendous. And then looking ahead post COP, where we're going to turn so many of these commitments into, you know, mobilizing capital, actually coming up with the right financial mechanisms, the public-private partnerships, and the interesting and creative opportunities that there are for financial services to really build on this work and channel money to where we need it in the real economy. So anyway, back to you. I know you have real vision and ambition.
No, I mean, I think, look, what you've said is exactly what we're all trying to do, and it's wonderful that you at the Green Finance Institute work so closely with the corporation, and we've come out with reports on London Recharged, the Recovery Task Force, you know, Square Mile, Future City. And as you say, we have history here. I mean, back in 1956, in the Clean Air Act, we were the first city to abolish coal fires. And you can see all the momentum and the news flow that is coming about around, you know, with the G7 on banning financing coal-fired power stations. And then, you know, whether it's also the different sectors. So one of the sectors that I focus on is asset management, and asset management is very much the conduit, you know, dealing with the shareholders and dealing with the corporates. And the message is getting out there. As I said earlier, we've had some of these, votes that have taken place from big fossil fuel companies where, you've got to change, and they are starting to change. And that comes back to the point about transition. And it's very important that we support that transition, which we are doing. And then you've got the other sectors. We mentioned insurance already, and then private equity. So I've held meetings with the private equity sector to work out what they're doing, and we need to make sure that there is not funding for some of these coal mines or going forward coming from some of the private equity. Now, the really large private equity companies won't be doing that, but some of the smaller ones might, and we need to encourage that. And we need to do a lot around what are the rules for private companies, because we all know what the corporates, because public shareholders can now give them a hard time, but the private companies, how do we help them as well? So, there is a lot to do. And as you quite rightly point out, this COP26 is just the start of our year presidency, and there's a great amount to do after that. But I think, what we're trying to do on the finance side is we've got a whole, the finance strategy, and Mark Carney's been instrumental in helping us with that. And as you know, with yourselves, the City of London Corporation and the Green Finance Institute, we have found a site in Glasgow. It's going to be very exciting. And after Alok Sharma's recent speech, we're intending to be there in person and to try and make a huge difference to get us where we need to be.
I'm really excited to go anywhere other than North London right now. So very much looking forward to going to COP. There was a point you made earlier that I failed to pick up on, which I think is really worth elaborating on, and that is the importance of biodiversity and nature loss. And this really is the sort of the frontier, if you like, in green finance and how we're thinking about the real challenges we have. I mean, in ESG to date, the E has very much been a sort of C for carbon and climate. And we do need to build on the great work that's already been done by so many in addressing climate change and recognizing that climate risk is financial risk, and expanding that to other aspects of environment and nature. So looking at water and soil degradation, biodiversity loss, air quality, and looking at how does that also translate into financial risk and the potential of stranded assets. And importantly, again, and I always like to emphasize the positive and the opportunity here, is what business and finance opportunities does a transition to a more nature positive economy actually translate into, and how do we go after them? And I just think that is another of the pillars in the COP dialogue. And again, I think a real opportunity for creative thinking and solutions from the financial community. So, exciting times for us to really, really lean into that whole agenda. I'm very proud to say at the Green Finance Institute that we have been co-chairing the informal working group for the Task Force on Nature-related Financial Disclosure. So picking up very much on the work of the TCFD and the sort of 4 pillars of disclosure. And that's going to be a big focus going forward as the task force is now launched in earnest.
So I met someone the other day who was telling me on that point that you've just brought up, is that we need to sort of go to look at the supply chains. And I'm interested to hear what, and I mean, look, I've learned a lot about avocados and almond milk, which I didn't know until, a while, a few weeks ago, that actually you think they're good, but if you look at the where they come from, the water that's used, etc., coming back to your point, and we should be looking, instead of the top down, looking at the bottom. Where does it start and where's the end game? Is that something that you've been focusing on when it comes to the biodiversity and what food? And obviously, there's lots of comments about we should eat less beef and methane and what's going on there. And now you'll be pleased to know that if I do eat beef, I haven't quite got to the vegan yet, despite my daughter's protestations. It's grass-fed beef. I mean, things like that. I mean, I'm really interested to learn more about that, because they do go hand in hand with finance, because finance is looking to finance those sort of things that are getting us to that greener environment.
So We have found somewhere that we don't agree, Lord Mayor, as well as the rugby. To be fair, I haven't used it for 25 years.
Yeah, well, that's very good. That's very good. I'm getting there. Eventually, I'm sure.
Yeah, I can't quite get there yet on the veganism, but I have been a vegetarian for a long time and thriving on it. But yes, on the supply chains point, you make a really good point, and that's one that is a big focus for financial services in particular, looking at the provenance of commodities that are coming through supply chains and ensuring that there is enough transparency, especially when it comes to points such as deforestation. And the amount of deforestation that is being imported through supply chains, and deforestation clearly a huge cause of biodiversity loss, but also of climate change and global warming. So that sort of nature-climate nexus is really an area for focus. We've been working for a while with various banks and government departments on looking at a potential financial mechanism that would provide a sustainable import guarantee. So providing actual pricing incentive for banks in their trade finance and supply chain finance products, so that they ask their clients and multinational organizations to provide diligence and transparency around the provenance of commodities in their supply chain, and in return give them a beneficial pricing in their supply chain and trade finance products. So that's an exciting area and quite a promising area that we're discussing with a number of major multinational banks. So yes, I think that's going to be an area of increased focus. That's one of the things COVID, the tragedy of COVID has made us very focused on the resilience of supply chains, and obviously taking those lessons forward as to how it applies to climate.
And the other thing, of course, is we have somewhere between 26 to 30 million homes that need to be retrofitted by 2050, and that is something I know you have done work on. And I was on a call the other day with the chairman of Barratt Homes, John Allen, and how they're looking at this whole sector. But there's huge amounts of money to be spent doing that. But coming back to your original point when we started this chat, is there are a huge number of jobs to be created, taking us forward on the Build Back Better strategy. And I think that's also exciting. It's not as if things are going to, and we're already hearing with coming out of lockdown, the number of jobs available and not enough people to go for them. So that may be an issue for us. But I'm always interested to hear more about that. And then the other point where we both think that the voluntary carbon markets, and this is a great opportunity for London to be the centre for carbon markets as well. But those 2 points. You're the expert more than me here. Here am I asking you the questions, not to say you're asking me, but it's a chat. It's not a Q&A, so to speak. But I'm going to pass those two over to you to hear your thoughts.
Well, I absolutely welcome those questions, especially on the retrofitting of buildings. That's been a big flagship project of ours, as you mentioned, since we established the Institute a couple of years ago now. And look, we know that £65 billion is needed to be invested in the sort of 29 million homes that need to be retrofitted, even to get them to the tighter minimum energy standards that the government have put in place for 2035. But there's research behind that, to your point, that suggests that just trying to achieve those interim targets could create 150,000 jobs. And we know that there are real blockers in the supply chain of skilled labour and in the construction industry and in the retrofitting industry of people that are skilled in the new retrofitting techniques. And so one of the things we always say at the Institute is we can't solve for all the issues that are necessary across the whole value chain, but we don't want finance to be the blocker. So, that's why we're currently, I think our Coalition on Energy Efficiency of Buildings now has over 320 members. I think something like 70% of the UK mortgage market is now covered in that particular coalition, which is coming up with some really valuable and innovative solutions to how we get over some of the barriers to channel capital towards retrofitting homes. So that's an ongoing piece of work. that we are delighted to be working on, and actually have started expanding into Europe as well, exporting that work and working with partners more broadly. So I won't bore everybody with some of the solutions. They're all available on our website, and they range from everything from green rental agreements to green ISAs to importing the US's Property Assessed Clean Energy Program, which I think has now successfully channeled over $9 billion of institutional capital into retrofitting both domestic and commercial properties. So no mean feat trying to import that sort of program into the UK, given some of the regulatory barriers. But none of this is easy, and that's why it requires all this sort of broad-based collaboration in order to tackle it. And
which we're seeing. I mean, just on that point, collaboration, which we're seeing. And I just the other day did a virtual trip to New Zealand, and they've created a sustainable finance forum, which is launching very soon. And look, New Zealand isn't quite where we are, awareness, etc. But this is where, in my role as ambassador for financial and professional services for the whole of the UK, and normally, as you know, I'd be 100 days of the year traveling, but I can assure you, as Lord Mayor, I think I've reached more people than any other Lord Mayor in the history because of the virtual world we're in. But that's a positive as far as talking about the collaborative nature and influencing countries around the world, which I know you have done as well, as the CEO of the Green Finance Institute. So now, sorry, back to carbon markets.
Back to carbon markets, but the point you make about making sure that the message about green finance and the imperative of greening finance and financing green sort of escapes the echo chamber and becomes a mainstream topic. That's something that's just really changed over the last couple of years. And well, thank you to all the work that you've been doing in your position of Lord Mayor and using that platform. And actually, one of the positives from this horrible pandemic has been the ability to, speak to a far broader audience. Remember our Green Horizons Summit, I can't remember exactly, 300,000 viewers and 9-point-something million Twitter impressions. So
I mean, that's right. And and I know I speak for you as well, but the one person I'd love to praise is Sir Roger Gifford, who has sadly passed away, because not only was he a mentor to both of us, but he was an inspiration in the way he led the Green Finance Institute as chairman and what he did as a previous Lord Mayor. So look, I think this is a good moment to praise Sir Roger as well, Rhiannon Marie.
I agree. He leaves an absolute indelible mark on all the work that we're doing on green finance, and his legacy will live on. And we were both very fortunate to be able to work as closely as we were able to with him. And I know he's been a supporter of this conference in previous years as well. So yes, thank you. I think it's an opportune moment for us to mention his work too. Maybe with that we can. Oh, we haven't mentioned carbon markets, and I think
let's finish on carbon markets. A big positive on carbon markets
before we close. In that, obviously, there is some fantastic work that's happening under the leadership of Dame Clara First, very much building on the work that Bill Winters at Standard Chartered and Mark Carney has been doing at looking how we scale the voluntary carbon markets and ensure that London and the UK in particular is the forefront of what is going to genuinely be the most impactful way of channeling capital towards nature and nature-based solutions over the coming decade, and doing so in a collaborative way with other financial centres around the world, which is again going back to the point that I think is at the heart of what we both do at City of London Corporation and Green Finance Institute, which is collaborate and bring people together. So exciting times on so many of these topics, and as we look to COP and beyond, a real opportunity for so many people to get involved. So it falls to me to bring the conversation to a close. Thank you very much, as always, Lord Mayor, for a very interesting conversation. I look forward to continuing it with you. And also, I'm sure on behalf of the two of us, we'd like to thank Jeffy today for hosting us and for enabling us to be part of this conference.
Thank you, Rhiannon Marie. It's been great fun.
Rhiannon, Lord Mayor, thank you so much for those great insights. Climate risk is financial risk, said Rhiannon, and too right. We were all, of course, deeply saddened to hear the news of Sir Roger Gifford's recent and too early death, to which you both referred. He was a great supporter of Geoffrey's work, and our condolences go to his family. This session, though, how Sir Roger brought the green agenda to the fore, the highest reaches of the city, a lasting tribute to a great man. He would have been most pleased to hear that one of his successors as Lord Mayor and the Chief Executive of his Green Finance Institute share a liking for oat milk, an important step to a planet-saving diet. Now, I welcome George Hay, an associate editor in Breaking Office, covering financial. Prior to his Reuters Breaking News' European financial editor, and also worked as a correspondent for News and United Business Media. He has, like so many others today, a degree from Edinburgh University, a graduate diploma from Birkbeck University of London, and his work has been recognized at the UK 2021.
Many thanks, George, and welcome to the concluding session of Ethical Finance 2021. I'm very pleased to say we're talking to one of the world's leading sustainable finance experts, Hiro Mizuno. Hiro is well known as the former Chief Investment Officer of Japan's Government Pension Investment Fund, during which time he became an outspoken advocate for ESG investing and an outspoken critic of short selling. Since leaving GPIF, he's taken non-executive roles at Danone and Tesla and is the United Nations Special Envoy on Innovative Finance and Sustainable Investments. Hiro, welcome. Thanks for joining us.
Well, thank you, George. And it's my real pleasure to speak at this event. And my thanks goes to Global Ethical Finance Initiative. So thank you for having me.
Excellent. Well, maybe we could start by referencing your time at the GPIF. While you were there, you warned that asset managers that took GPIF business, they would receive smaller checks if they didn't exhibit good governance, and that was all the way back in 2017. Do you think fund managers do a lot better on ESG issues in 2021?
Well, sure. Of course, they do it better as the time. You mentioned we are still fighting over the relevance of ESG factors as an investment of financial information, and there is also the battle if the ESG is just representing the my value, or just it's a my value statement, rather than financial analysis or decision-making information. So compared to that time, now I think it's become almost politically incorrect to argue against the ESG. So it's now very hard to come across somebody in our industry who really says like, I don't care about ESG, right? So from that, the perspective, obviously, there is a big progress made, between the time I started and now. When I first, came to GPIF asset managers asking, what do you think is your responsibility as the fund managers? And the most common reaction or response to me at that time was, "Oh, Mr. Mizuno, our role is for active manager deliver you alpha, and a passive manager tracking the index with lowest tracking error, and possibly at the lowest cost." Yeah. And then my journey started by questioning them, like, okay, so who's actually feeling responsible about their ownership? So GPIF is in the investment chain, called themselves and also called by others the biggest asset owner in the world. But the way we manage the fund is basically we outsource all the other fund to external asset managers, right? And those asset managers say, "Oh, we are just the agent, and we do what I just described for the benefit of GPIF." And then my question was, okay, who is exercising ownership? Who is, trying to be responsible as an owner? Because ownership should come with the responsibility, right? That's obvious in any part of our society. So that's exactly how I started. And throughout that discussion, we reached the point saying like, okay, if the asset manager doesn't agree that the importance of the long-termism and being represented in ESG, the factors, if they don't take it as a major part of their, the asset management practice, for GPIF, we should question that whether you have aligned interests with us. And then you step on to like, basically, even if you deliver the same extra return, in other words, alpha, or even if you, track the index perfectly, if you don't step up and play the role as the sort of like asset owner, because we entrust them with all the voting powers and etc. So then we will just revise our contract with you. So just to answer your question a bit a long way, is that just a reflection of, the thinking about through the system we use, the investment chain, where the responsibility, resides, and in the principal agent relationship, which role and which responsibility they should be held accountable. So that's what it was, yeah. And I think that part.
I suppose just in terms of, I mean, you raised the important part about asset owners. Do you think enough different asset owners are taking the path that you did at GPIF? Do you see that happening to your satisfaction?
Yeah, well, I think the most of the sizable and asset owners, they usually manage their portfolio mostly themselves, and so that kind of agency issue of the sort of what I call the vacuum of responsibility or non-existence of ownership, sense of ownership, does exist much less. And you can observe that a lot of like big asset owners now becoming more and more vocal, more and more active. What they are expecting from their portfolio companies, not only, the financial return or dividend, but also they expect the appropriate portfolios, the companies to perform or deliver, to serve the much higher level purpose of the fund managers or asset owners. So in those groups, it's easier to observe. It's easier to address. But in the GPIF, the case, and also the majority number, less sizable, less resource asset owner who has to depend on the asset manager as an agent, I think the situation remains very difficult to address. So I think the GPIF trying to be a pioneer, trying to address that agency problem. Right.
And I mean, the biggest asset manager, BlackRock, we saw them voting with Exxon's activists last week. It was quite a big move. And that kind of, and they've clearly kind of set out their stall as wanting to take environmental issues in particular seriously. But recently we also saw 15 US state treasurers saying they wouldn't be handing out business to asset managers that that just kind of don't do enough financing for existing fossil fuel players. So there's a kind of tension there. Do you I mean, and it's a kind of something happening in America as well. Do you worry that America as a capital market is still a bit behind the curve compared to Europe or on ESG issues?
Well, I think it's not like a black or white type of the answer I can give to your question, but just take Japan as an example. European thing, Japan is also behind the curve in terms of like the environmental issue, given Japan's dependence on a coal. For their, the energy mix. The one thing I just wanted to emphasize here is, when we talk about the ESG and the performance or like ethics or morale or the value in the financial decisions, the most common sort of like a defense the conventional minded investor or financial professional uses as a counter argument of fiduciary duty. And I always said like a fiduciary duty, if you interpret that in a more common language, that means you have to loyal to your customers, right? Yeah. So I can understand that the in some states in America where like a fossil fuel is a major industry, they will say like if the asset manager I give you your money and the manager we give money to, basically voting against those companies, they feel that's against they don't have a loyalty to their customer. That's understandable, right? So the one thing is like first of all, I always think that they really need to rather than just using fiduciary duty as an easy defense or easy like the easy line of defense, they should just talk to or face the what their the beneficiaries, what their customers. And then now I think it's becoming more and more global agenda that if we fail to address climate change, we are going to have the massive negative impact on the portfolio, whatever you have, right? So so I think BlackRock, the recent change reversal on their stance on those like the proxy voting, probably reflecting majority of their clients base is now thinking if the asset manager continue to act in the way they previously acted, it's probably not really supporting their future sustainability or future, the viability of their money, of their portfolio fund, whatever you call it. So I think that's actually what's happening. So the more customer, the more societal consensus about those issues, the asset manager, again, they are agent. So sometimes they try to sound like they are a principal, but actually they are agent. So if they fail to reflect what the principal is hoping for, that's really against the fiduciary duty, right? So I think in Europe, what I observe is even compared to Japan, there's much more solid consensus among the community. Yeah, those issues must be addressed by the government, also by the businesses. And when they expect the business to address those issues, they obviously expect the investor to accelerate it rather than the stopping it, right? Yeah. So I think in the US there are still much less sort of social consensus on the community level consensus on that issue. Yeah. So we just cannot judge by how the particular industry player acts, because at the end of the day that these climate change. Well, this is again what I really advocated when I was a GPL CIO. Whatever I do as a CIO, tilting the portfolio, changing the manager, at the end of the day, the long-term performance of the fund is much more, the vulnerable to the global climate change.
Absolutely, yeah, that's very interesting. I mean, it's a difficult one for the likes of BlackRock to a balance to strike between their stakeholders who want them to push more on ESG issues and the state treasurers I was talking about. It's a difficult balance one. But this is a kind of even wider question, but it refers to the fact that you sit on this thing at Danone called the Mission Committee, which is a really interesting and kind of way to kind of legally enshrine environmental and social considerations into their objectives on top of shareholder value. But that's really kind of the question, like, how do you combine those two things, the imperatives to generate economic value and kind of observe environmental and social considerations? And would you say that shareholder value and ethical considerations are now of equal importance? Because they certainly didn't used to be.
Yeah, well, I think that's probably my ultimate message to the audience today is basically like, most of us used to believe that, the ethical, being ethical and being profitable as a business are sort of mutually exclusive. Mm-hmm. So when I started the advocating the ESG consideration, another most common pushback saying like, oh, how do you explain about the trade-off? And my reaction was, first of all, there was no evidence those are there are trade-off relationship between those two, but we are kind of like a prejudiced. Those are the mutually exclusive or a trade-off relationship. So I think that's something that people start questioning. And the more we got deeper into the ESG analysis, the ESG research, it's becoming also very evident. The ESG, the consideration is actually improved the financial return. So 5 years ago, obviously, when I started, even academic research had us showing very mixed results.
Right.
Some of the research showed ESG is actually negative attribute, and the other says positive attribute. Now, if you keep an eye on all those researches done by academics and also the financial research company, it's becoming more and more clear those ESG factors are positive consideration to the financial performance for long term, right? So, talking about Danone went extreme by changing the article of incorporation and utilizing the French new legislation to create a company who serves multi-stakeholders, not only shareholders. So the way in the past and outside of Danone, the way I try to persuade the investors or shareholders to look after the ESG issues is, if the company failed to address those ESG issues, long-term financial value of that investment will be damaged. That's why talking about and the making sure corporate executive CEO takes care of those ESG factors are beneficial for long-term investor. That's how we kind of explain and persuaded the shareholders to act on ESG. And Danone went even further, saying, hey, our company is set up to serve multi-stakeholders, right? So first one, kind of trying to just, they make the case through the shareholders' value argument. The Danone's case is basically this is how our company is set up, right? But at the end of the day, we need to achieve both, right? Because if the CEO continue to fail to deliver the performance, I'm not talking about short term, but the reasonable time frame. Well, it's understandable shareholder lost the faith in that particular management. Yeah. But at the same time, let me put that this way. The reason why I really like the idea of Danone's a new corporate, the enterprise mission, or the other activism by the long-term asset owner is, ESG is something most of the CIO is not naturally incentivized to commit to, because the climate change, in many cases, if they really wanted to address the climate change, they may hit their bottom line negatively in the short term because they need to make additional investment, and they need to get rid of some a cash flow positive operation like a coal and those kind of things, right? Yeah. And Exxon is actually facing that situation. Exactly. The investor telling them not to expand the cash generative business, right? The cash cows, right? Absolutely. So that one is CEO is not naturally incentivized. Look at the agenda diversity. Everybody understand now the importance of diversity on the board or in a management team, but adding the one or two the female board member probably wouldn't improve the performance of the company for the next 6 months or the 1 year, right? So that's again, CEO is not financially or naturally incentivized to address those issues. So that's where the governance should kick in, because corporate governance should be responsible for something which the CEO is not naturally incentivized. Right. Particularly, the keeping the eyes on long-term agenda, because most of the ESG agenda, goes beyond incumbent tenure, right? Exactly. So I think that's the way I see the sort of the balances.
But and that longer term governance issue is completely critical, but how do you kind of combine? What do you do when you get a situation? It's not dissimilar to what I mean. Danone is a specific situation, but there was you had some kind of hedge funds who were more focused on the short-term performance, and the incumbent CEO Emmanuel Faber was seen as a kind of real champion of ESG issues. So there's a quite difficult balance to strike there, because both have a kind of valid argument, I would say. But like, how do you strike that balance? Because it was quite difficult to do.
Yeah, well, I just refrain from expressing my opinion on that particular, like the incident, because I serve on the board of the Danone's mission committee, and I have my personal opinion on the Emmanuel's performance and a respect for him, etc. But the way I saw that was, in the capital market, we just cannot deny the existence and sometimes benefit of having short-term investors, even traders, right? Yeah. These days we now have the machine, the trading at the nanosecond cycle, right? And as the other major, the participant of the capital market, I don't deny their roles and also sometimes their benefit to the whole capital market, but on the other hand, sometimes they goes too far, and sort of a short-termism, like just a kind of dictate the way the company is operating, and that's where I think the governance should kick in, trying to manage it. And also, I see the role of real long-term asset owners, like that's the behind the GPEF decision to suspend the stock lending, because we are the biggest and a literally long-term investor with the 100 years investment time horizon. And at the peak, like a 60-70% of our stock was lent to somebody who probably using to put the short-term pressure on a company. So I think it doesn't make much sense, because on one hand we are just trying to promote the long-termism and the focus on the long-term issues, but on the other hand we actually don't have the ownership most of the time, right? So that's quite
a good point. I mean, obviously you mentioned you sit on the board of Tesla, and the Tesla boss Elon Musk has also been critical of short sellers, and so that's an area of common ground. But I completely get your point.
Against the short sellers maybe a little bit different from the reason I was against short seller, because I was an owner of the Tesla, as institutional owner of the Tesla, so they have a bit different perspective. But
fair enough. But I suppose the wider point is, can short selling be kind of ethical if it unearths, it can, unearth a fraudulent company, for example, and kind of make it, and it can do a good in that way, perhaps. But do you think that doesn't necessarily outweigh the wider problem of too much short-termism?
Well, let me respond to your question a bit, the sort of like different ways. First, I think what is important for GPIF was whether our the stock lending practice was consistent with our other, like a stewardship principle and etc. So it's nothing to do with whether they are ethical or not, right? So that's one thing I just want to make it very clear. And the other things which bothers me was there's basically no transparency in that practice. Most of the time, I couldn't even tell whether GPIF stock today exists, who's holding that. It was not transparent. Right, so those kind of things that made the real reason why they reached the conclusion we probably need to suspend it to see how it develops. But I mean, short seller can be ethical or whatever, because to be honest, most of those short sellers, their holding time frame is too short to reflect whether the ethical behavior or non-ethical behavior. Right. They are just trying to make a financial investment, which is fine. And to your point of, and also I received that question a lot when we announced our decision was, short seller is effective to penalize the company who's not doing right things. And my argument is maybe, but that they will be penalized even without the short seller anyway, because if you say like if the company involved in a fraudulent like the business practice, we don't need a short seller to penalize them because that company's stock will penalize anyway, right? Okay. So those kind of things that I think it's probably not even appropriate to discuss the ethical behavior with that kind of short period of like the holding time. But the longer your investment horizon or holding period becomes, the more relevant to discuss those kind of things.
Yeah, fair enough. Just in terms of like sustainable investments and investors making those decisions, do you think investors have enough data and understanding of what is a sustainable investment and what isn't in order to kind of make those decisions? So in the European Union, we've got this taxonomy thing which it aims to kind of do that for you and kind of say this is green, this is not. What's your view? Do you think there is enough clarity out there at the moment?
Well, I think the 4 or 5 years ago, when I received that pushback from my own team or asset manager or whoever saying like, oh, Mr. Mizuno, there's a risk of greenwashing, risk of like ESG washing and etc. I usually trying to push them back saying like, hey, come on. First of all, you need to agree those are important. And then you worry about washing, right? Because interestingly, most of the, usually the people who use the greenwashing or ESG washing or lack of information as a counter argument not to integrate ESGs are not the believer of ESG to begin with. So I used to say like, you are using that as an excuse not to do that. But now, as I said, that battle was over. Everybody says ESG is relevant, ESG is important, ESG is critical. And then now they are saying, okay, we are ready to do that, but how can we do that? And then this is the debate on the lack of information, lack of standardization has its merit. So I think now we probably need to focus more on, having more standardized data set, more comprehensive data, and also creating a standardized reporting framework or like ESG matrix. Because now I think the people not arguing whether they should use it. And now they are saying like, hey, we need something which we can rely on. So I think that now becomes more relevant. And the one thing I'm trying to intervene in my special role as a special UN special envoy is particularly, about climate change. I believe in a free economy. Actually, I don't really like regulators, just believe it or not. So I think in many cases, free market usually come up with a better solution than regulator in many, many cases.
Right.
And this time I'm calling for regulatory intervention in the ESG matrix and the disclosure standard because we just don't have time to wait for the market to work out. Right. So I think when it comes to the, people talk about ESG matrix, but I'm more specifically concerned about and also crying for the government or regulatory intervention at the integrated and also higher level, like a G20, COP26 level, to really agree on a standard for those disclosure and investment matrix, because we just don't have to wait for the market to sort it out, which I think will sort it out someday.
Do you think there's a chance that we'll get something along the lines of what you want at COP26, later this year? Do you see good signs that something will happen there?
Well, we are focusing on, I'm working together with Mark Carney, and I advise the Japanese government to continue to be a champion of the TCFD disclosure. So Japan now, I'm very happy to see like Japan has the most number of the TCFD recommendation supporters. So I think the first step is, and also Japan is now finalizing the revised corporate governance code, and which is going to have the sort of comply or explain requirement on the TCFD disclosure. So I think that my focus so far is until the COP26, together with Mark Carney, is making TCFD is sort of quasi mandatory climate, disclosure, framework. And I am still hopeful that we'll get there. But the climate is something we really need to get that as quickly as possible. And it's probably now a lot of people understand this is not just ethical or like the choice, moral choice. I mean, people started seeing the actual the physical impact on their portfolio. So again, a lot of cases like what people think as is a sort of like a value statement. Once the society created their consensus on that particular value or particular items, that will become the financially the relevant information, and then the time difference getting shorter and shorter as the people have the general agreement on the ESG, the ESG integration. So, but the climate has to be the first one.
Okay, well, listen, I think we're going to leave it there. So many thanks, Hiro. That was really interesting. I think it was also an excellent way to round off what has been a fascinating 3-day summit. So back to you, George, to formally close Ethical Finance 2021.
Thank you.
Thank you both very much, and it's been great to consider the trajectory that we're all on by understanding, for instance, that only very recently some of the matters we all take as givens, like say board diversity, were considered outlandish by many in our sector, and how things change. And if we had longer, and we must get you back, we must give thought to how many stumbling blocks are still in our way and how to get rid of them. A really super upbeat way, though, to end our 3-day summit, because alas, that brings us to the end of our third and final session today, and also of the summit. We've covered a great deal and heard from some truly expert and inspiring speakers and panelists. If you missed any of the earlier sessions, would like to watch them, they'll be on Global Finance, Jeffy's EFX platform very soon. And do share your thoughts on the Twitter links, which you can find on there. We've had 100 speakers, 3,800 delegates from 90 countries, truly global event, which is why we at the Chartered Institute have been proud to support and co-host this together with our colleagues and friends at Jeffy and at the Chartered Banker Institute and many others. We've heard from some really terrific speakers, all committed to moving things forward. We must achieve soon our ambitious mid-century net zero targets and interim objectives, and embed sustainability and stewardship right across finance. As we were reminded by our speakers in our most recent sessions today, though, in our race to net zero, we mustn't speed past and ignore the many wider aspects of environmental sustainability and social sustainability beyond the climate challenge. So alas, that's the end of ethical finance for 2021. But as Scotland's First Minister said at the beginning of the day, indeed beforehand, and in the meantime, stay well, and as we say in Scotland, haste ye back.